Good morning, and welcome to day 2. Welcome to day 2 of our conference. We are beginning early today, noting the number of presentations that are lined up for the day. But the main thematic areas that we are focused on today include ESG, of course, elements around ESG integration in banking, leveraging climate risk assessment, sustainable finance and SME growth, and of course the extent to which this affects performance in the banking sector. Then again, we continue on our discussions around financing of SMEs and the general financial inclusion elements, so access to finance components. Then also, before we close the day, we will have a methodological session. As I mentioned yesterday, we onboard sessions that help us understand some developing trends, innovations that have come to the market to support the market, and of course it becomes then an opportunity for us to retool and build our knowledge base on various interventions that have come through the market. So today we are hosting a Credit Information Sharing Association of Kenya as they bring us a presentation on what they have seen from CRB data and some new developments in the CRB space that would support our data in terms of quality of data. So we look forward to this session. It would be very instrumental for us to appreciate some of the innovations that have come through, and even speaking again to the issues around credit scoring. How do we enhance it? We can only enhance it through quality data. So we look forward to that session later today. But to begin as of today, we have in the initial session, before we go to the tea break, we have 2 presentations. One is by David Ndwiga of NCBA Bank. That would be discussed by Dr. Steve Makambi of Kenyatta University. And the paper is on commercial banks, ESG integration, and MSME support, again, evidence from Kenya. So I want to invite David to take us through the presentation, and then we get the discussant on board before we open it up for questions. So, karibu, David.
Good morning, all. I'll be quite brief to the paper so that we can save time. All right, my name is David Ndwiga. So I'm taking you through a discussion around the paper that I worked on around the issue of commercial banks, ESG integration, and MSME support and evidence from Kenya. So basically what this paper is looking at is quite simple, if I may explain it in a very simpler way. We know that you have been in the helm whereby green financing, enhanced governance has been a core issue within the banking industry. And we know banks have been very proactive in this space. And as you look at through what has been happening in this space, much of the focus by the banks has been on MSMEs. So the inquest here we are trying to find out is, does actually integration of ESG, whereby ESG is environmental, social and governance practices within the bank's practices, does it really support MSMEs? in a number of ways. That is what the paper is actually trying to check, and therefore we can see whether there's something that needs to be done that is not being done right, and whatever is being done right, whether it can be scaled. So to start kicking off, we know that, as I've mentioned, that the issue of sustainability agenda has actually been the current issue of discussion, not only in the banking industry, but in the entire economy globally, based on the aspect of a circular economy or circularity, which has been very pronounced in the recent past. And therefore, as a result of this, the financial sector has not been left behind, especially the commercial banks, which have really geared their way in terms of adoption of environmental, social, and governance practices. And this integration we have seen actually being motivated by a number of factors. One of the factors is that with the green financing, commercial banks are aware that by integrating some of these practices, it unlocks some of the green financing that you need to access, especially from the development partners and from the DFIs. And secondly is actually the issue of inclusivity. That is in terms of financial and social inclusivity in driving the agenda for what you call banking for the society. And therefore, as a result of that, those two reasons have actually fueled the bank's participation in this space of ESG. But then the question is whether, when you come to the aspect of in trying to be ESG compliant, the banks are facing a lot of costs in terms of compliance because there's a lot of certification that needs to be done. But when you look at the outcome, the question is it justifiable the cost that the bank goes through to be certified in some of these ESG checkpoints for it to be able to qualify for a green financing? Vis-a-vis the benefit that comes into that. So there are some papers which have been done about the issue of ESG adoption and bank profitability. And to some extent, you have a positive effect and also negative effect being reported. But the results have not been conclusive that actually adoption of ESG leads to bank profitability. But then on the issue of the green financing, once the bank is able to mobilize these lines of credit because of adoption of ESG practices, the question is that this green finance, the argument of is the green finance inclusive or is it not inclusive? Yeah, because you've had an incidence whereby there's a lot of green finance mobilization. But when you look at how inclusive it is in terms of how it is dispersed to the required institutions, then there happens to be a gap. And therefore, the question has been, there's actually been an argument on the table that we need to reconsider how ESG adoption is being taken in the Kenyan context as well as globally. Back to the Kenyan context, we know that the leading organization, that is the umbrella body for commercial banks, KBA, in 2024 did actually give a commitment of 150 billion towards supporting the MSMEs. But also we know in this support, commercial banks have also rallied for different lines of credit, especially from DFIs, which are geared towards MSMEs. And some of them, we know that if you dig deeper into them singularly, you find that there has been the issue of how do you embed ESG so that you are able to access these lines of credit. So such kind of commitments have been there among the Kenyan banks. However, now the argument has been, despite all these efforts, we know that MSME financing and support has been a challenge, as you've heard from yesterday. And therefore, the argument has been, actually, is today's green finance inclusive? And the argument has been today's green finance is not inclusive, and inclusive finance is not green. So that brings us into paradox. Then why is this the scenario? Since if we have had a lot of mobilization of green financing through ESG adoptions, then we do expect the issue of MSME financing using this funding not to be a challenge at the moment. So that is the challenge that we are trying to unearth in this paper. So here we have three main objectives. We want to find out whether, number one, the effect of environmental safeguard principles adoption among commercial banks, how it affects MSME support. Secondly, how the social responsibility adoption affects the MSME support by commercial banks. And thirdly, how corporate governance principles adherence actually support MSMEs in Kenya among commercial banks. So I'll leave the literature because there's a lot of literature in this area. In the interest of time, I've actually reviewed substantial literature whereby you find much of the literature is towards ESG and bank profitability. But when you narrow down to the three aspects of ESG, that is environmental, social, and governance, singular, and how it affects MSME support, that there has been a gap given that much of the literature is just linking bank profitability to ESG. So we take the first attempt of trying to see how these individual, that is the E, S, and G, do affect not profitability, but this MSME support, which yesterday we remember we were being told by KBSEO that it's account for around 98% of the Kenyan businesses, that is terms of the bank lending. So what we do here is that we go back to the bank reporting. We know that we are using data for the methodology. We are using data for the early adopters of ESG. We all know that we are 40 plus banks, but there are those early adopters who even do have sustainability reports. Now, when you go through that bank sustainability report, there's a scorecard, which is normally attached at the back end. And some of them, I think they have started adhering to CBK, climate change reporting taxonomy. So we look at the banks which have been the early adopters of ESG, and they do have sustainability reports for a couple of years. And then when we get in there, we dig in data based on what we really want on the attributes around environmental issues. The other thing is the social issues and also governance issues. And then we extract the data from, because these banks, if you look at those sustainability report, they do give the scorecard every year, what they have achieved in terms of what is their green portfolio or their green lending, or what is their green book. They also do give some of the attributes around the issue of the number of MSMEs supported. In those reports, you'll also find the number of MSMEs, that is the MSME lending, specifically for what has been mobilized around the sustainable fund. You'll also find the issues around now, the social issues around the issue of the number of transactions which have been done digitally, that is outside the branch. And all these attributes are what we'll be picking as I'll be explaining soon. So, which means, therefore, we are using a panel data for the first 5 tier 1 banks which have been the early adopters for ESG in Kenya. And they do have a sustainability report for a couple of years. And then from there, from those reports, we go to ESG scorecard and we extract the data that we really want to use. And then from here, then we can run the fixed effects and the random effect model and do the necessary econometric analysis, which I don't need to dive in here. So let me now explain how this model is working. What is our dependent variable? What we really want to examine is MSME support. So the MSME support from these reports, we get it being, we are measuring it using 2 yardsticks. Number 1 is the number of MSMEs trained in the year, and not only training, but is the training on a number of issues. One is financial literacy. Number 2, they have been trained about the issue of ESG adoption and sustainability, that is in trying to embed sustainability models in their businesses. So that is one yardstick. Then number 2, the other measure of MSME support is the number of loans, not actually the loans given, that is the value that was the value that was lent to MSME in that specific year, arising from sustainable financing that was raised by commercial bank within that year. So those are the 2 measures of MSME support. Then we go to the environmental, social, and governance. So on E, we are using the yardstick of the green book, or what you call, we have the green book, which can be measured in terms of what percentage of your loan book is green, or you can also measure it using the green portfolio, which is a number. So that is what we are trying to use, because we know that this is what, as a result of adopting ESG, you have been able to mobilize a line of lending, which is likely to be a green credit line. Then on social, you look at inclusivity, how that scorecard is actually that scorecard is similar across all the banks. So we are using a number of issues. One is the number of branches, because we know as you increase more branches, then you are bringing the social inclusivity. Number two is the percentage of the total bank transactions which were done digitally, that is outside the branch network. We had also proposed a measure about the issue of the local supplier content, that is how much of your supply is actually being distributed to the local suppliers. And then on governance, when we use what we call the board independence, that is we look at the number of non-executive, that is the number of independent board directors in the year. We also use a measure of, on governance, the gender. We want to look at the gender diversity in the board. We also look at the number of women, the proportion of the number of women who are in senior management, and also the number of women who are in management. So those are a couple of some of the yardstick that I'll be showing in the results later. So what are the findings? The findings here, they do conform to a bit shocking revelation, given that banks have been very proactive in this ESG platform. So what we do find is that, and I'll look at these results here. When you look at E, that is on environmental, the environmental, when the bank has a high green portfolio, or the proportion of the green lending in the loan book as it increases, that has a positive effect on the number of MSMEs that are trained. Essentially what it's telling us that as the bank mobilizes more green financing by adoption of the E practices within ESG, then we are seeing that having a positive effect on the number of MSMEs who are trained. However, when you look at the other measure of MSE support, from not only training now to the lending, you find that as the green portfolio for the bank increases, the lending to MSMEs is actually not significant at all. And therefore, what it tells us is that a bank will mobilize a line of lending, which is a green line of lending. And then within that line, perhaps it has a training and capacity building or capacity enhancement component. And the banks will do that thinking that because I have 1 million MSMEs, that is what in economics you may call the potential demand, you come and train them. And you think that this potential demand will be turned into actual demand. That is, after you train them on sustainability issues, then they will come for the uptake of this facility. So we see the disconnect between the potential demand and the actual demand itself. So the fact that you have trained more MSMEs does not mean actually they will have it will have a direct uptick on that green financing. So that is first of all, now the disconnect between potential demand and the actual demand. On the social front, we find that the digital banking channel expansion, branch network expansion, and increase in local procurement, it has a positive effect on MSME support, both in terms of the number of MSMEs and also the lending, which is actually now the element of financial inclusion. So as the bank embed more of the S, then we are seeing that being replicated in terms of how many SMEs are supported. So it is as the bank embeds more of the S element within ESG, we are seeing more MSMEs being traded, and we are seeing more SMEs accessing financing. That is now the element of financial inclusion. We go to the governance. We find that in the governance front, management and board gender diversity have a positive and significant effect on MSME support, and MSME lending. And similar is reported for women and youth-owned MSMEs initiative programs likely to be championed by women in management. So what we are getting here is that if you have a board which is gender diverse, means it has more, how we are measuring gender diversity is the proportion of women in the board to the total number of board members. So a board that is having a bank which has more women in the board is likely to have more MSMEs being supported and being lent to. But when you go back and scrutinize this sustainability report, the reports are able to give you out of the total MSMEs which were supported, how many were women lent, and you find that a big chunk of them were women-owned enterprises. And that perhaps will tell us, then if you have more women in leadership, that is in senior management and in the board, there is likelihood of having the bank having more of women-tailored products, which are going to these women-owned enterprises. And that would explain the issue of why if you have more women representation in the board and the senior management, then you are likely to see more MSMEs and more lending to MSMEs being refilled. Just for the fact that majority of these MSMEs, if you scrutinize the sustainability report, they are actually women-owned. The same as when you have an independent board, that is, you have the dependent ratio, that is the ratio of independent board members to the total board members is high, then we do expect this to be happening. So the question in the room here tallies with the presentation done yesterday about the issue of when you have more women in leadership, then you are likely to have, and actually from the data it shows that if you scrutinize those reports, they even have specific women products or women lines of lending, if I may call it so, for the banks which have a high representation of women. But then the other question would be, could then the banks be embedding more women in leadership and in the board so that they would access some of the lines of borrowing or the line of lending from DFIs which are gender sensitive? Because you know there are some lines of, there are some DFIs and initiatives for you to be able to access the funding from them. They are actually more of pro-women empowerment. And if that would be the case, then could that be the motivating factor why a bank would have more women representation at the top management? So I'll note what I've explained in this slide is actually what is now entailed in this table. This is the table for recreation for we are adopting the random effect, not the fixed effect. I don't want to dwell into that much, so that econometrics may not, I may not want to, I want to assume that there are some econometrician in the room, but I think I'll dwell more on the findings and the policy. So this is what we get for the random and the fixed effect. So the results I explained for the random effect model. You can see those are the results that we do get. And then the next regression is for the MSME lending. You can see the first line here, whereby for the random effect model, that coefficient is not significant at all. So what are the policy suggestions? One is that in addition to capacity enhancement, a commercial bank needs to go beyond and find out, given that you have found that the fact that you have trained MSMEs, more MSMEs on sustainability issues, and also on financial and also entrepreneurial skills, that does not mean that if you have a line of credit which is green, you will actually disperse that line. And as a result of that, how does it depends with how the line of credit from a DFI is structured, because one of it, if it is, there's a way structured that it will refill itself in the bank's balance sheet. But there's also another line of credit which, if you're given by a DFI, it will never refill in the balance sheet, but it will still sit at the DFI and you draw down upon you actually getting the demand side. And we know that the lower the drawdown, the higher the commitment fee. And therefore that lines end up being very expensive for the bank. So sometimes it's actually a thought that as a bank, before you mobilize a line for green lending, You need to ascertain your effective demand and not your potential demand, because you may have that line of credit which has the training component, but you are not able to convert your potential demand into effective demand. And therefore that line ends up to be very expensive on you in terms of the commitment fee that you have to pay because of slow rate of drawdown. Then number 2 is the need for ESG reporting sensitization. And when I was doing the study, I realized there's only 5 banks which have sustainability report out of all the banks that we do have. And we do know that from the CBK climate change, the reporting taxonomy, there's a deadline. And therefore, there's need now for, and here is the umbrella body, KBA. I know in some years back, they even organized for what you call the nature-related financial disclosure trainings among the banks. So it is a high call to rally so that we don't see the banks rushing at the last minute. And actually, this is what I found with the banks. Those are early adopters. You find that you may not report on all issues in the scorecard. You identify which are the core, and then from there you go progressing. If you look at the report for those banks, the last year report, whatever they are reporting on the scorecard is more detailed from the first or the second year report they did have. Then the other one is the need for a phased adoption and implementation among the commercial bankers, as I've mentioned. It means that you may not need to adopt and report on all the issues on that ESG scorecard, but you have to identify which ones are key to you, and you start with that. And then the last one is the fast tracking of implementation of the nature-related disclosures among commercial banks. And this one will give the issue of the environmental and risk management. The reason I'm giving this recommendation is that you'll find out in that scorecard, much of the reporting, there is a lot of heavy of gains in the social practices and also in the governance practices. But when you look at the environmental, what the banks are reporting is only on how much of your loan book is green and how much you have as a green or sustainable finance portfolio, period. But you know there is quite much you can report, like the carbon footprint. I know there are some banks which are reporting, but it's not being reported by all. There's a lot of breaks in that. So with the issue of the last policy suggestion, we do feel that you'll have more reporting around the E, so that it can match the detailed reporting that is in S and G. So with that, I'll stop there, and I hope I've taken my 15 minutes or 20. Thanks.
Thank you, David. So I go straight into calling on the discussant. Dr. Steve Makambi is here. Please, Makambi, if you can come, and you can spend between 6 and 8 minutes. Thank you.
Good morning, everyone. I'm Steve Makambi from Kenyatta University. I'm humbled to be here and to be the discussant for this wonderful paper. So I prepared a few slides to basically give my views. I'll start with the strength of the paper. Number one, there's clear motivation. The paper starts with a well-articulated motivation. It situates ESG within the global shift to the circular economy and brings it down, funnels it down to the Kenyan context, and especially delves into the fact that MSMEs face credit constraints, and therefore any initiatives that the bank would take would be beneficial to the economy. And then it is even, therefore bringing it from an ESG lens is something that is that it should be championed. Next is the relevance. We know that micro institutions are the backbone to the extent that they employ the majority, yet from the banking perspective, they face financial exclusion for structural and systemic reasons. Therefore, given this lens from an ESG, I think the paper is relevant because you're not only looking at financing them, but we are focusing it from a green financing perspective. Therefore, this would be beneficial because of the scale of MSMEs. Introducing ESG within that conversation is very relevant to Kenya. So policy transition space, Kenya is a pioneer, especially in terms of our financial plumbing and architecture relative to Africa. Therefore, as a pioneer, we should start this conversation and help other African countries adopt. So using Kenya as a test case to start to introduce ESG framework would be important, and therefore making this conversation very relevant in terms of policy transition space. Research gap, as I mentioned, that there's a clear research gap because ESG is a relatively new concept that is being introduced for sustainability purposes, and therefore the paper well articulated the research gap and as it focused on relevant studies, featured relevant studies from China, India, and Brazil, and tailored the study to suit the African context and the Kenyan context. So in terms of research gap, it was well articulated. Theoretical framing, it was also well put. It relied on trade-off theory and situated ESG within the theory. Methodology, the paper used granular data, that is bank-specific data, and the models were appropriate. And I would want to emphasize, especially on breaking down ESG into the environmental, social, and governance angles would make the model quite informative. Because we need these three things, while they can be mapped together, they represent very distinct issues that should be therefore making the paper valid or the study valid from a methodological point of view. So those are the strengths, and I would want to reiterate something, is that ESG is a relatively new conversation, and therefore I would want to commend the author because delving into a new research realm is something, is like entering into a dark room. Therefore, there are a lot of, you'll make a lot of mistakes in that area. So, therefore, I have given some areas for improvement. There are critiques that are meant to help maybe bring in different perspectives. Number one, sample selection. The paper only dealt with the Tier 1 banks. I do understand that these are the banks, the data availability could be an issue, and also these are the banks that have taken the initiative and reports. I do appreciate that. But moving forward, it is a limitation nonetheless, because the truth is that the other banks, we mask the situation from the other banks. We need the data, and therefore there can be sample selection bias because the Tier 1 banks are well established and might bring in a very different picture compared to if we were to do the study and with all the other banks. Then measurement of variables. The measurement of variables, again, some of these unobserved social qualitative issues are very hard to measure. I do want to appreciate that. It's very hard to measure, but nonetheless, we need to also point out that the proxies used to measure quality, the idea, the validity, the idea that we want to measure here is the extent to which green financing, MSMEs, is supported from a green financing perspective. So using the number of farms that are trained or using the amount lent might not exactly be valid from a measurement point of view. But we do appreciate that we use what we have, so I understand that. Then the introduction of control variables, very important, of course, from a modeling perspective, but it might again lead to some kind of reliability of the estimates, because we might end up actually looking at another topic, which is the effect of bank characteristic or bank structure on lending to MSMEs. That word usually confuses me. So I'll use micro enterprises. So because when you introduce with a ROI, number of branches, etc., as control variables, they might end up explaining something that is totally different. But I do appreciate that these are control variables. And then again, as I said, some latent variables, qualitative variables such as social responsibility and governance might not be they are very difficult to measure. But so the variables that have been used there, we should try and see whether we can adopt better variables to capture these variables. So in the environmental factor, the social factor, and the governance factor, how do we measure them? So those are areas for improvement. The results also, I would want to say, the results were counterintuitive, but the author has well explained. Therefore, we need deeper exploration, and here mixed methods would be beneficial by going to the ground and talking to, having some qualitative interviews to back the findings would be very important. So I know, especially I'm an econometrician, we are really biased into quantitatives, but qualitative data from key personnel would be very, very important to enrich our interpretation and our understanding of the findings. There's another issue about the findings. The link between women in management and MS micro enterprises. A little bit, I think the author was drawing from the straws. And the question I would ask objectively is, can we really substantiate that? I'm really not trying to bring in the gender argument, but are you telling me that women-led decisions are more prone to environmental, social, and governance sustainable direction compared to men? Is that what we are saying? As in, just think about it. Okay, the gender issue is. I'm not dismissing it. I'm saying it should be substantiated. It's quite a revelation to say that men don't care about environment, so to speak. Okay, so we need to look at that. Theoretical gap. I would really be happy if just a little bit the theoretical anchoring could also focus on the micro enterprises side. I would want, because of the constraints and the vulnerability of this sector, I would want to see theories that look like pecking order of finance, financial constraint theory, etc., to strengthen the conceptual model and anchor the paper, given the thesis and the spirit that the paper is delving on. Lastly, on the same, in the same respect and spirit, I just want to give some suggestions for future research. Again, David, the paper was well articulated and well done, but these are just my thoughts. You focus from the bank side, and that is okay, that is a scope that you took, but I would think it would be beneficial if in the future we focus from the, we use the micro enterprises as the unit of analysis. So that now we would actually look at the behavioral approach and the behavioral modeling of if we give loans, green financing, we extend green financing to micro enterprises, do we really have an impact in terms of sustainability? And if not, what is the, what are the challenges, what are the limitations? So because at this point, this is when we will actually understand whether the loans we are giving are actually doing what we intend them to do, something of that sort. Then combine quantitative and experimental approaches. Here again, the limitations of models that look at the effect is that we cannot substantively answer the question of impact. Therefore, in the spirit of looking at the micro enterprises, we should consider impact models like randomized controlled trials, treatment groups. This one, and we link these programs like the training programs, the loans that are the green financing, and we study the impact. The outcome as ESG practice adoption and productivity and default rate would really, really inform policy and direction towards sustainability. So I believe that KBA should place itself, is strategically placed to kind of take that initiative and look at how these loans actually impact the community and also advise the banks accordingly. Okay, so again, in the same spirit, longitudinal tracking, we should track and see how these loans, the impact of these loans after some years. Then expand the bank selection to tier 2 and tier 3. And the issue of gender, again, I'm coming back, examine whether the micro enterprises owned and managed by women respond differently to ESG-linked financing, and whether banks with more women decision makers are more likely to offer such products. I think that is also important. Otherwise, thank you very much and congratulations. Back to you.
Thank you, Steve, for a very comprehensive discussion around the subject that David has brought to us in terms of ESG integration and MSME support. We now want to quickly get the first three. Yes, 1, 2, and the last one. 2 comments coming for this, so we can start us off. Keep it brief. Mike, please, here. Oh, you could start with the lady. Mike is...
Good morning. My name is Nema from ABC Bank. My question, I think it has been slightly dealt by the discussant, was seeing that the green portfolio could not easily translate to lending to the MSME. So I was wondering, could there be specific factors, noting that the training could have been done, meaning awareness is there, could there be specific factors that is hindering the absorption of this money? From our yesterday's discussion, we noted that the main challenge for the MSME is the access to financing. But here we have the money, but it's still not being absorbed. So could there be barriers which need to be addressed so that now we can see this? Even for you to assess the impact of this ESG finances in the community, those barriers need to be identified and dealt with so that we can fully support the MSME. Thank you.
Thank you, Nema.
Yes, thank you. My name is Silas from Kipra. Thank you for the good presentation. Some 2 or 3 quick questions. We as an audience, we are denied a bit of access. We should have been given the paper because I've seen some things that require some interrogation. When you are doing an econometric test and you are using a fixed effects or random effects, you make a decision, you don't show both of them. You show, let's say, fixed effects, and then you put for me the Hussman test. So, but when you put all of them like that, that one is not very good. That's one question. The second thing that I've observed from the result that you cited, just the basic of that fixed effects, some values that you have said are significant, and they are not. Like one value there, the value of T is 1.07. That one cannot be significant. That one is, we need to interrogate that because for it to be significant, the T should be above 1.7. That one is standard. So it varies when it is 2 stars, then 3 stars. But you see some of the 2 variables there have the stars and they are not correct. So that is another thing that I've observed there. Then another thing that I've observed also, we also need to understand give us the descriptive. Because what is the sample size? We don't know. We didn't know what is our sample size that we are dealing with here, where we are generating our result. We are not told of that. What is the multicollinearity? Was there some test around that? We are not told around that. I know it might be in the main paper, but it raises the issues because we want to see how the variables get into the model. Because immediately that is correct, then we know we are in the right path. But we can't be continuing and then we are in a wrong path. And then the last one is on the conclusion. The conclusion and recommendation that you are making should be based on the result that you have and the result that you have gotten. You see some conclusion that you're making on sensitization. Then I ask myself, which variable was capturing this lack of sensitization in the model so that what I see in the model is what I conclude with, is what I recommend. There was nothing capturing, I don't know if I get all the variables, you just selected some, that were capturing like those education thing. So that you say education was an important factor, so we recommend this more sensitization. I didn't see that. I don't know because I didn't have the paper, but I think we need to interrogate more, but it's a good first step. Thank you so much.
Thank you. Any final? I know. Yes, there's a hand up this side.
Thank you. Thank you very much. My name is Dr. Thomas Ongalo, Kasalome Consultancy. Now, thank you for the presentation that you have put before us. It's a very interesting area. However, I was left to be wondering when you managed to take us through that for those who have all been trained, not all of the MSMEs will be will be effective demand. Now, I think what you could have also taken us through is through tabulation, cross tabulations, so that we can see that yes, those who have been trained are not coming back for this loan. What could be the problem? Now again, going to governance, I like the way you measured them, independence and also the gender. Now I think you could have also taken us further through cross tabulation so that we could see some of the effect when now you are relating both of them. And again, finally, the correlation, very, very important. I was waiting to see the effect of the relationship between E with the G, and also relationship between E and S. I waited to see for that. To see that. But I didn't see. Otherwise, your presentation was cool, and thank you for this presentation. Thank you very much.
Thank you, thank you. Allow me to invite David back. David, please be very brief as we are already running late on the next presentation.
Thanks. Maybe 1 or 2 minutes to respond. I think I'll take the comment as well articulated. Was to mention the question about the issue of the funding not translating to the uptake. I'm sure if you actually have a real conversation with the banks, you may have a line of credit from a DFI, which is a green financing, but the uptake actually not among even the MSMEs, but even among the corporates, it's actually a challenge. Because the fact that I train you doesn't mean that there are some other, maybe, for example, qualification that you need for you to access. So training was part of it, maybe as a sensitization. But beyond that, maybe your books are not in order or there are some other issues that you need to address to. So that would mean maybe having an interview or key informant interviews about among the 5 banks and find out what be the reason. But from the data, we can't be able to tell. But for sure, I know actually a drawdown of these credit lines is not very easy, especially towards the MSMEs. I think from Kipra and Dr. the consultant, we're opening up a Pandora's box for econometric issues. I think we can discuss that over tea, because not everybody is an econometrician here. First of all, the issue of fixed effects, random effect, you can report them. I've never, for the years I've been in this field, I don't see any harm in actually, you should report the pooled regression, the fixed effects, and the random effects, and that is the practice. And then you give the Houseman test and which one it chooses. So I've never seen any crime for the years I've done research in reporting on both or 3 of them. Then about the issue of which one is significant or not, I think we'll have more discussion with the gentleman from Kipra. Because if you read the tables down there, it will give you what 1 star, 2 star, 3 stars give you. I know there's this school of thought, it's only that for those which ones are significant at 5% are the ones that you should report. But there are different thoughts of, so I don't want to open that Pandora's box around that issue, but I think we can have more discussion around that area. Then what Dr. has also mentioned, the interaction between ES and G. It's a valid point, but also when you are modeling as you interact with them, we need to find out what are we interacting and for what reason. For example, if I interact the number of digitally carried out transaction with green financing, what will I be testing? What will it give me? I think here the idea would be in that regression model, including what I may call, for example, the ESG index. I look at where the bank lies in terms of, so apart from doing them separately, I can involve one composite index, or if I may call it so, to tell this bank at this year it was at this level in terms of ESG, because that index is weighted from the all attribute of ESG. But when I interact them individually, then the question would be, what will I be testing? It's all about the issue of modeling issues, which I think we can have a discussion so that we can create time for the next presentation. Otherwise, thank you. I think I'll meet you and the gentleman from Kipra, because I'm not running away from econometric issues. I think that we can discuss over a cup of tea. Thank you.
Thank you, David. But we take the challenge on how best to avail the papers to all the participants in the conference without compromising on the copyright issues for the authors, especially before the papers are published. So we will innovate around that and make that data available. But also, just to be on the lookout, is the data points that will be coming through. I guess one of the constraints that the study, limitations of the study, is that there are not so many banks that are doing sustainability reporting. And that in itself, we need data for research. And now with the publication by the CBK of the Climate Risk Disclosure Framework, and of course the KBA coming up with templates for reporting, and beginning from early 2027, we will have all banks being able to report on this, and therefore that give gives us a lot of data points that we can start using for data, and I think that would be very instrumental. And coming from Kipra, I think that would interest you even the more as data becomes availed, and therefore studies can be well supported from that standpoint. So allow us now to transition to the next paper, which is leveraging data for climate risk assessment and green capital. As Ruben and the team comes up to make this presentation, this is a case study of the Africa Climate and Nature Data Platform. So Ruben is the Group MD and CEO of Climate Shapers Africa, and he has a team that is bringing us this paper today. The discussant, again, happy to note the presence of Brian Ochieng from NCBA Bank, who is a lead on sustainability at NCBA Bank. So Ruben, if we can work within the timelines provided, that would be best. For Brian, if you have any slides, please share with Davis so that the transition becomes smooth. Thank you.
Morning, everyone. So for this next paper, my name is Ruben from Climate Shapers Africa, and I'm joined by Francis, who until recently was...
For our online participants, please feel free to drop us. If you have any comments, questions, feel free to drop on the platform, and we'll be able to read it out to the rest, to the authors, and of course for all of us to appreciate any comments that are coming through. Thank you.
Thank you. Yeah, I was introducing Francis, who until recently was working with us full-time at Climate Shapers Africa and has now moved to banking. He works for Prime Bank. And we also have other members of our team from Climate Shapers Africa in the audience. Before I go into the slides, in the interest of time, I just want to contextualize what I will be doing for the next few minutes. Since yesterday, for those who were here yesterday, I think there are 3 conversations that have been happening in this room, at least from where I stand. One is around MSME financing, which is very core to this conference. But also secondly, there has been a conversation about risk-based pricing. And yesterday, the governor spoke so much into it together with Paul Russo. And we also had a KBA session yesterday about risk-based pricing. So that's conversation number 2. There has also been another conversation happening, which is around how can we actually enable MSME financing and how can we enable risk-based pricing. And a lot of the papers that have been presented in one way or another, they speak to that. Whether it's through credit guarantee schemes, how do you do analysis, how are elements, how can we, incentivize MSME financing. And we've seen, for example, yesterday, the use of dashboards just to be able to look into credit data and to try and unpack that. So our paper is a little different in the sense that it's a paper for the conference, but we focus on a case study that focuses on a product. And the product here is the Africa Climate and Nature Data Platform that we have built at Climate Shapers Africa. And the idea of this platform is to say, how can we enable climate and nature oriented practices in the banking sector, whether this means climate risk assessment, nature risk assessment, whether this means product development on the climate side and on the nature side. So our strength, I would say, and how I think we fit into the conversation of the conference we try to move and say knowledge is important, information is important, but how actually do we move from knowledge to building products that can be used, and we hope to intersect that in the conversation. So as I get started, I just summarized in one page, because I know I'm gonna go through the slides, but I'm also thinking of how to make this, a little bit more compact, is to say, with this conversation happening, there are two things that we are seeing. And one is to say, one takeaway from yesterday is that the issue of data challenges is really huge in the market. I remember yesterday we had the conversation around if the lending rate will be Kesonia plus K, what goes into this K? How do you get that data? If you want to do more women-oriented lending, what variables do you pick from customers that are going to go into that? And there is also the issue of MSME financing. And so the gap we are plugging is to say, sometimes the data is not available, especially if you're doing climate or nature-related lending. But two, where the data is available, sometimes, at least in this market, the African market, the data is not adequate. It's not hyperlocal. It's very generic macro data, and that is what we are trying to fix. And the last thing I would want to say is, in building this platform, and you'll see in our methodology shortly, we use a mixed method. So one is we are saying what is it that is in research. That's where all our literature review comes in. But also two is design thinking. So we'll show you example of 3 banks, which we shall not name, that we had conversations with when we have been building this platform, to give us feedback and to say, if we were to build this platform, would you use it as a bank? And if you would not use it, what would make you not use it? And if you were to use it, what would make your experience better as a bank? And that is what we are trying to do. And also today is the first time we're actually sharing this platform publicly. So everyone who has accessed it before is because they are part of our focus group. So, and today we'll give you public access. So we are also proud to say this is the first time we are giving it, we are making it public. So as I've contextualized, our problem statement is simple, is to say the conversation around ESG in the banking industry has happened for a very long time, but this ESG is not translating to more ESG-oriented loans. And part of the challenges is around this. Sometimes banks do not have the key metrics that would go into a KYC process or a climate risk assessment process to be able to advance these loans. And we find that at the core of this problem is issues to do with data. And even when the data is there, it's not local enough, there's issues of data integrity. And so to say, how can we make sure we translate ESG issues, like you can see the thermometer there, how do you translate these temperature issues, rainfall issues into bank-specific metrics? And just to say that, when you look at this market, when you look at something like the Notre Dame Gain Index on climate risk, Kenya is very much exposed to that climate risk, but within the banking loan book, the very high exposure of it is within the MSME segment, and mostly even within MSMEs, like Stephanie presented yesterday, the micro are very much underloaned or even not loaned at all. But also there is the issue around rural MSMEs. How do we bring them into the fold? And critical to this is building a data infrastructure. So I'll skip the literature review. This has been spoken about, dynamics around climate and the economy, the dynamics around MSME financing landscape. A lot of papers have done that. So please allow me to skip that in the interest of time. I have already mentioned about the methodology. So we came up with questions to say, which are the data metrics bankers would like to see in a data platform? How would those metrics feed into their climate risk assessment, their loan pricing? So what is the methodological component of moving from data to products, moving from data to loan pricing? And also now to do interviews with the specific banks, and to say there's a lot of the international data architecture around the AFDB, World Bank, IMF. How do we actually create more hyperlocal data that speaks maybe to the Kenyan market, the Uganda market, the Malawi market, and all that? And The current outlook, just to contextualize data, is to say there are at least 5 things happening. We have the international institutions, and we have the research institutes, and we have the data providers, we have the regulators, we have the rating agencies, but we have the data providers. So someone could ask, with all the data that is available in the market, why build another platform when I can get my temperature data, say, from Kenya Meteorological Department, or get it from World Meteorological Organization? And we want to say this is exactly what we are trying to do. So as far as data goes, there are two pain points. One is, if you look at some of the most credible or most popular data providers globally, people like our World in Data, World Resource Institute, MSCI for climate data, PCAF for carbon accounting financials, or the last one, which is CRS, Climate Risk Services, there are 2 gaps. You find some data providers, they have a lot of data, but that data in terms of the variables speaks to climate and nature variables and does not translate that data into metrics a bank would care for, because a bank wants to hear probability of default, loss given default, exposure at default. So we have institutions that have this data, but they don't speak to metrics relevant to the industry. And then that is one of the gaps. The other gaps is for providers who have metrics that speak to the industry, like MSCI, PCAF, and the rest. In terms of coverage of African countries, it's near 0. So we have these 2 gaps. Those who are speaking to climate and nature related metrics that speak to financial metrics, the coverage of this region is almost non-existent. And those who actually cover even Africa as part of their scope, they don't speak to banking metrics. And what we want to do with the platform is to make sure we speak to all these. And some of the things we heard from banks, before you invite Francis to show us the demo, is to say, banks are saying, if we are gonna use such a platform, we need to see the data has to be actionable, in the sense that if I'm a credit officer at a bank, the language I speak is not rainfall and temperature. I speak financial metrics. Does your platform help to translate climate and nature metrics to metrics that I care for as a bank? Issues around data privacy, data integrity, and these are some of the things we have kept in mind as we build the platform. So I'm gonna call Francis, who's gonna make some comments, and then we're gonna show the demo. Thank you.
Hi, I hope you guys can hear me. Nice. I did like that song playing though. So as my colleague mentioned, so I'm going to take you, just contextualize a bit more about the data we're kind of collected and how we wanted to now show that data, right? So this is going down. So this is modeling approaches banks usually use around the world, especially around materializing climate risk inside the credit formulas or even methodologies for how they collect this. So we have different things like macro level stress, which governments usually use just to see how certain sectors will act under different climate scenarios. So I think you know the different climate scenarios, right? Like you have optimistic, you have baseline, and then you have pessimistic. So optimistic is usually the net zero line. And that's actually used in a lot of different models, even scenario delta PD models. So it has PD models being changed according to the different scenarios. So IFRS 9, that's just the new accounting standards to basically take into account the losses or expected credit losses that will happen throughout the loan period. And CECL is now just for GAAP. But all in all, there are different methodologies, different models, and this is kind of widespread through a lot of different financial institutions. And just to contextualize this back to what we're here for today, which is MSME financing, and even the dashboard I'll be showing is around MSME financing, is the whole idea, first of all, we know MSMEs employ about 90% of Kenyan citizens, and the financing gap is huge, about 19.3 billion. Some data from CIS Kenya has actually shown that even though overall disbursement has increased, MSME disbursement has decreased greatly. And even Ruben mentioned about how rural MSMEs are also largely excluded from this. So the solution of ACNDP in this whole problem is the idea that a lot of platforms like Climate X, Deloitte, as mentioned before, there are a lot of platforms that do cover these issues, but they don't really go deep down into the details. A big conversation that has been mentioned, especially yesterday, was disaggregated data. So how do we handle that? The solution is actually building a unique tool that does cover what this is looking at, right? So you don't want to look at a huge corporate and use that same corporate tool for an MSME, right? MSMEs are different. So this is where we bring ACNDP and we look at an interesting kind of methodology, bottom-up and top-down approach. So yeah, the type of data we collect is mostly climate, transition risk, asset level, you can name it. And some of the data variables we are looking at, which inches of rainfall, GHG categories like scope 1, scope 3, and even transition variables like levelized cost of energy. So, okay, you've kind of seen those variables, right? Do they actually speak to you as bankers or financial institutions? What do they actually say? It's raining more. It's kind of hard, right? So you actually want to, and this is actually what he said and what banks have said to us, we want to actually translate that to something that actually makes sense to the banker. So, this is just an example of what most data platforms are. I had to go through like 50 of these. I can't lie, I'm still not a meteorological expert, but I'm almost there, I'm getting in there. But this is just an example of what we mean. If you look at this platform, do you feel it's usable? Do you feel it's giving you anything? What this platform is really great at is giving you a lot of data. But translating it directly into what you want is the gap we're trying to talk about. So I'm going to go through the demo, but firstly, if you can actually go through it yourselves as well. So please you can scan if you're able to. My phone has a few issues, so I won't be able to join you guys there. But yeah. By the way, this is pre-alpha stage development, meaning there's a lot of things you'll see missing, but this is the type of data and the way we want to show the data. All right, I'm gonna give it a bit more time, 10 seconds. It'd be nice if music was playing. Okay, never mind. I hope you guys managed to scan it. No, I'm still seeing guys scanning. I think we're good. Did you manage to scan it? So. All right, so I'm going to go through the part of the data platform, and then Ruben will kind of close off on it. So let us start. Hey, man, your keyboard. Sorry. Yeah, how do you...
I think we can move it this way. I think this should work. Let's do this. This should
oh.
Yeah, but now you have to duplicate. I don't know. This is
I'll just use that. It's fine. Interesting, great. Okay, so this is the African Climate and Nature Data Platform. Note, I said pre-alpha. This is not how it's going to look at the end. We just kind of used a baseline model. So some of the things I wanted to actually show is the different topics, right? So the different data we have. Because at the end of the, that is tough to click on. There we go. Some of the data we actually do have is just basically things you can download, right? Because at the end of the day, we're researchers, some of us can do econometrics and everything. So we want to actually make it able so you can download individual data. So temperature trends, rainfall patterns, renewable energy. Yeah, and just to show you just an example, let me go here. It looks something like this, right? So you get a nice kind of visualization, which you can download as a PNG, or you can download as a CSV, etc. So basically making individual data points that we actually collect on the platform through the different sources available. Now, the next thing actually I'd like to show before going to the dashboards is the nature data. Because something I think a lot of platforms usually, and a lot of banks and a lot of institutions, finance, really not really look into is biodiversity and how it affects, especially the fact we're in Kenya and Africa. That has a huge effect on the economy, especially if we suddenly see trends going downwards, the amount of elephants we have. That means tourism falls. That means the economy will start experiencing a lot of changes that may be positive, but most likely negative. So this is just some of the data we have. So the same kind of design, you can download specific. But yet again, I guess it doesn't really look into, well, what banks want, right? Yet again, that's still raw data like many of the other digital spaces. So instead, this is where we thought of dashboards. Dashboards tell a story, because data is a tool. By the end of the day, we want to actually visualize it into a story. We want it to give us more information, more context. And especially the dashboard for yesterday, like how they disaggregated the credit to gender, it really told me a lot. I had preconceptions, it gave me new ones. So here are just some of the dashboards we're thinking of. So I divided it by user case and use case. So user case is like, are you an insurance firm, right? Are you a bank? Are you the government? And then use case is now things like agriculture, buildings, and most likely MSMEs. Let me just look into the banking sector really quick. It's not the main thing. But see, maybe for a bank, we'd want to look at the green loan portfolio, the climate risk scores, the climate risk exposure by sector. So this is just a nice look into that. But the main thing we actually do want to talk about today, and it's why I even contextualize MSMEs, is, there we go. You know, it's actually really hard using this side of the screen. There we go. This is the MSME Climate Dashboard, and it's what we've actually been working on for the last few weeks towards this conference. And we thought, well, one, the fact that you can actually use it on your phone means you can actually take it to whichever client you're actually trying to assess the risk on, right? So portability is something really great. Another thing is maybe you're just in the office and you kind of have the client information. So something banks said they didn't want to give the data to us, they wanted that privacy. So instead we decided to have inputs. So we have things like the country, where we look at different ones. Is more, but for now we're using Kenya as a context. We're saying the regions Nairobi, you input the annual revenue of the business. So since we're focused on MSMEs, especially micro, let me put, let's say 250,000. So 250,000, is that 250,000? I can't read. Was that? No, yeah, there's 1 0 more, yeah? Yeah. 250,000, and let's say it has 5 employees. So the platform already kind of classifies it as micro. By the way, we're using the government's definition of micro, small, and medium. So in Tanzania, it's probably going to be different, and Egypt is going to be different. So the point is the dashboard should contextualize that already, based on whatever input you put in the first place. The next thing is it a physical premise? I'm going to say yes. And the asset location, I'm not so sure. Most MSMEs kind of move around a lot. And the one I'm actually going to pick today is a taxi. So I'm going to say it's a vehicle. And the asset value of that vehicle, I'm not a car person, so I'm just going to put 1 million, because I think that's what someone told me once, and I said, sure. Huh? That's it? Can't tell. But anyways, let's say it's 10 million or 1 million. So the industry I'm going to select, the point is all of these inputs kind of now contextualize that MSME specifically to what it's supposed to be. So I'm going to put transportation and storage, business sector, passenger transport. So for industry, this is based off also the government, okay. So yet again, it will be changed based on the context of which one you tapped first. If you tapped Tanzania, now it'll have to change to what Tanzania sees as MSMEs or the different sectors. So in this case, this is Kenya's sectors. Passenger transport, cash flow is very high. High volatility. And I think baseline case scenario, I think I explained it before, best case scenario. But something really great that also this platform does is that you can click to learn more. And that means like if you don't understand something, you can easily understand it. If you don't know what optimistic means, it'll give you a highlight of that. So just to quickly get into the risk of it all, let's analyze. And done. So it's taking all this different data, and remember when I say top down and bottom up? So somewhat is a bottom up because you had to input what that person's value was and where they're located. But then it still had a top down approach to look at whatever data we have and kind of bring it to the ground. So physical risk score, we have 53 out of 100, transitional risk score. And in short, most bankers then will now look at maybe the probability of default or the loss given default or expected credit loss. What I'm basically saying is that this platform takes in all that information, takes the information on the platform, and now contextualizes it in a way that bankers can use. By the way, we have not yet tested this out with bankers, so you guys are the first ones, and even researchers and finance people. So your comments will be very lovely. So the next thing is also transitional risk. You can see I kind of split it between physical risk and transitional risk. So now we can also look at what's happening in that industry. When it comes to policy risk, the government wants to move very green in Kenya, right? So policy risk is very high, and that's not a very good thing. And the carbon intensity that these vehicles have, even though we didn't put the exact one, is usually pretty not good. So it kind of now gives you that context of, all right, so we have a huge carbon footprint. Can we actually give this guy this type of loan? Maybe. And then finally, now we have the supply chain transition risk. This is just a work in progress, but just basically because MSMEs usually depend on a bigger chain of networks. So maybe like this car driver uses Uber app, and now that has issues. So the supply chain transition risk takes into account that. Climate literacy assessment now looks into, if you go to the client physically, let's say you're on your mobile phone and you use the app to kind of get an assessment, maybe if the manager isn't too aware about climate risk, that will probably give a terrible score. And it'll give climate literacy. So in short, this platform is just supposed to kind of help you make decisions on that fly. So instead of you having to go to, let's say, our world in data, get a bunch of data, feed it into your core banking system, and then come up with some sort of way to contextualize it to banking metrics, we've already done that contextualization for you. So that is a bit much more about that. I'd actually like him to finish up on the platform for the nature data.
So as Francis has mentioned, I just want to close 3 minutes, Dr. Tiongo, we are still in the pre-alpha phase. As you can tell, we still have, some dashboards that you still don't see things on them. And of course, today we made it open, but if you actually want to be part of the user group, please talk to us after this, because I think after today it's going to go back to a test group, so the link won't work. We just thought to make it open for the conference, but we are happy if you want to be a user. All we need is your email address so that we can whitelist it, and then you can be using your email to access it. The last thing I want to say is around the policy recommendations. the other thing to mention is, before I go to the policy, there's just a lot happening in the sustainable finance landscape in Kenya, especially around the new regulations issued by the central bank. We had the climate risk disclosure framework, the diagnostic tool, and the Kenya Green Finance Taxonomy. In fact, the industry classification we have on the platform uses the Kenya Green Finance Taxonomy. So one of the ways we are thinking this tool is going to be important is to help banks to be compliant with CBK supervisory guidelines, and also to help banks report IFRS S1, S2. In fact, one of the products we are going to have on the platform is a place where it asks you questions that relate to IFRS S1 and S2 compliance, and then once you input, it generates for you a report. So think of an AI agent inside the platform. So it's like a ChatGPT, which has been fed on information coming from IFRS S1, S2, Kenya Green Finance Taxonomy, Climate Risk Disclosure Framework. So we are also thinking of how to make banks compliant even as they do MSME financing. I'll pass. We also have another product that we offer called Kenya Climate Directory. Some of you may have heard about it. You can just Google Kenya Climate Directory, which is an information repository. So we have two products. Kenya Climate Directory is an information repository, has publications. Right now we are around 28,000 users. And now we are building the platform just to separate the data side from the repository side of things. Finally, I think our policy recommendations is just around three things. The last one is just to bring all together around collaboration, but to say we think there is value in using these even for policymakers and supervisory guidance. And just to say, while we want to boost MSME financing, while you're talking about data, how do we make sure that as banks leverage data, they are also boosting their lending practices, climate risk assessment, but also ties to supervision. Two is to say that as we do this, we want to move beyond carbon emissions, because I think a lot of people, when they hear about reporting, they're just thinking of scope 1, scope 2, scope 3. But as the dashboards have shown you, we really want to go beyond issues of carbon emissions, and to say there's just so much in the climate and nature data ecosystem that goes far beyond emission reporting. And thirdly is to say banks can leverage these for MSMEs, and that's why we want to create, MSME specific dashboards, and also to ask for collaboration. So just to conclude is to say the reason we're building a platform is threefold. One is to address data gaps. Two is to say we don't want Kenyan companies and banks using like ETA platforms in Europe. Let's build localized solutions that speak to Africa. And then how do we translate this data into banking language, into insurance language, into your client's language, manufacturers, trade. So how do we actually strengthen it for financial intelligence and to be able to strengthen financial practice? So I will stop there, and thank you very much.
Thank you very much. So I'll go straight into inviting Brian to give his reflections on this, but as he comes, I was just thinking wildly around this, an SME operating in Nairobi could also be facing political climate risks. Do we need to embed maandamano risks into our dashboards and look at it? Thank you.
Thank you. Thank you, Ruben and gentlemen, for this wonderful presentation. And for me, this was not just a research paper. As you mentioned, it was a product. So an opportunity to interact with your platform kind of threw me into a rabbit hole. More so at an era where they say data is the new gold. So competitive advantage is going to come from insights that are able to help businesses make informed decisions, particularly from a lending perspective. Doc, when you're just leaving the stage, you've now already picked a few ideas in terms of how this needs to be improved, particularly going beyond E to S data, just as you're mentioning on how do we integrate climate-related maandamano, that's a social issue, and of course other insights that are coming from other markets as regulators are coming through. So for me, I didn't really look at it from a research perspective paper, but of course from a product perspective in a way to help us deal with the challenges that we are dealing with. Because as a practitioner, I can tell you, we discuss methods, but because of time, people need answers, like how do we then get to address a problem? Because you are lending and you are being timed on TAT, and you have to go deep into research to get answers. But thank you, the answers came from the demo. So I believe that, I know it's still work in progress, but it's beautiful work in progress. So without much ado, even when you go into your research, you're able to put into perspective where even as a country, because basically when I was interacting with your paper, I like the fact that it's Africa focused. And when you talk about nature and the way Africa is disproportionately affected, then you'd realize that discussion around nature are local discussions. When we're talking about water stress, it is Kenya that's talking about water stress. When we are talking about forest cover, just as you highlighted, it's Kenya that is talking about forest cover. And maybe even from businesses that we support, regulations that are coming from the markets that we are accessing are demanding for this information. And just to come into this platform, be able to access that information at the touch of a button or finger, it becomes quite interesting and insightful. Particularly the discussion around EUDR, where if you are a coffee farmer, you are a tea farmer, for you to access that market, you'll have to prove that your land was not deforested. What a time to have such a platform to help banks, to help businesses, to also just align. So, and also just identifying, because when you talk about climate, you also look at the materiality of climate risks. And it's even beautiful that that platform goes beyond banks. You've seen talking about SMEs, talking about real estate, talking about construction. You've identified these sectors for us. So again, it becomes very easy. So even in terms of implication, because they're talking about MSME being the cog of this economy, and just by data showing that their contribution to the GDP well highlighted. So that for me was a key strength of your paper. We wake up every day for new standards, new regulations, maybe, and it's discussion that we've had, and of course your paper acknowledges the pressure that financial institutions or businesses now have to go through, and accessing this data again become a challenge. So to bring the Kenya Green Finance Taxonomy, to bring the climate-related disclosure framework, to again also blend the GHG protocol that helps you to do your determinations of emissions, to put them together, and also to guide such a score output that we've just seen, also just to make it very easy for us. So that data analytics for me was key. So I think you come at a right time, because this paper actually, or this product, helps us to have, one, localized solutions. Secondly, also just help us to understand better maybe how then we are going to do stress testing around specific aspects of climate that becomes. And again, even when you are able to interact, I will most definitely refer a lot to the dashboard that you've seen, because again, we are discussing this product. When you look at how you're able to structure conversation, we are not going to visit our clients and looking at them as risky. you're able to even now bring suggestions as to how then do we craft a sustainable or transition finance solution as part of helping you grow or helping you be resilient. So that for me was another big strength. So again, we have a lot of jargons. So the granularity of bringing data locally for me is very key, and that is something that you address. Interpretation in terms of this is the sector, this is the amount, this is what the outcome would look like for me. Again, it makes it very key. We are again able even now from a finance perspective, because now maybe I'm picking from an implication of the barriers that might make financial institutions not to go into these sectors. But again, it just helps you to address from credit scoring, from loan pricing, as we've just seen. Again, that is very, very important. So again, very beautiful, because you mentioned that you want to go beyond carbon emission accounting, and you've demonstrated how this solution is also going beyond carbon determination, validation and benchmark, to the point that you're able to pick a region, understand specific risk from a region, from a sector, and even from practice. So from practice is that we're going to now have conversation that is not far-fetched. You know, when people now talk about climate change, you know, it's very global, like maybe the meeting that we've just had in AU in Ethiopia, or the one that is coming in later in November in Brazil. But right now, we are going to have conversation with SMEs, drafting their local solutions and helping them to be resilient. I mean, that was very key. Well, I think, and this also is being addressed, because your method or methodology becomes very key. Again, you know, one thing about your paper or the product is the opportunity to take you beyond an output, to also just go further to try and understand, like particularly when you're doing your scenarios, what would the optimistic look like? So it again helps you inform like what you're doing. So again, that clarity is there. I would also just think that as you build on the paper, because I know it's work in progress, you're able to improve on it. Again, and because there's data challenge, I'm going to speak to it because I'm just about to wind up. Comparative benchmarking become very important. We have the MSIs, we have the climate risk services, we have the one world data. I mean, and even in your paper, you are keen on collaboration. How then do we strengthen collaboration from that perspective? Is it possible, even in that platform, that we're able to look at what is MSI saying, so that we have like a pool? You know, when you start getting something good, you demand for more. We didn't have it, now we have it. But we want to know what is MSI saying, what is CRS, Climate Risk Services saying, what is World Data saying, what is Aquadat saying. So we just want maybe for somebody who is interested to knowing, so that your paper is able to integrate further to help us just also get to such dashboard, because I know you are capable of doing that. We are keen on it, we are going to demand for it. Again, validation. We are going at an era where they are now speaking about limited assurance and compliance assurance. So, I mean, we also just need help around validation in terms of when whatever we are going out there to address the risk of whatever now they call non-compliance reporting. So again, you know, why I think this is important, because this is my last slide. And I believe these 4 institutions are very important in data. If you look at their relevance, you look at integrity, you look at granularity, privacy. You know, if you look at privacy, I mean, that now becomes a worry for me. At an era where we have data privacy issues, I mean, if and when this product is able to give assurance around data privacy, because, and again, you go beyond our market. If you read the Bank of Tanzania sustainability reporting requirement, they actually call out data privacy, and you need to report it as a material matter, and of course from our market. So this is very beautiful. If you are going to put private information there, then of course, I mean, in future, probably when you are selling this product, because it's a beautiful product, please just give us assurance in terms of, because it's open access, so give us assurance that our data would be safe. So without much ado, thank you so much for this wonderful product.
Thank you, Brian. That's feedback from the ground, the users of the data, and this is really concerns, comments for incorporation. I don't think you need to come back on it, so I think we can just pick a number of other comments that are coming through. Should you have any, please raise your hand. Yes, Elizabeth. Okay. Introduce yourself, then we... If you can be brief, that would be very helpful.
Fine, okay. Before, so my name is John. So I also major in engineering as well. So this issue of scope 1 and scope 2 emissions is something I'm quite conversant with. So I just wanted to make like a comment or compliment regarding the software that's being made. So what we could be keen on, like there is companies we work with together with the Siemens. They have like aside from the AI models, three-dimensional software that could be really helpful in gathering that what the discussant mentioned about qualitative data. So what we're keen on examining is how we could be able to have collaboration, as in going beyond the scope 1 and 2 emissions, because there are also other hazards like noise pollutions, like even companies that do quarry and mining, that there are some regions it was a vegetative landscape, but now if it's a bit destituted, it could also be a climatic aspect as well. So we'll just talk further on further collaborations. Thank you.
Thank you, Elizabeth. Mike, please.
Good morning. My name is Elizabeth from Kipra. So I just want to thank you for this innovative work on sustainable financing, but just a few maybe like thoughts. It's very interesting, but I think it would also be very good if you would try to bring it down to the point where even somebody who's not a finance specialist or in this area would be able to understand what this platform is and how it would work. So maybe you tell us, like now you are saying there are some metrics which are available out there, but they are not relevant to banking. So could you show us what are these metrics that are out there and the ones that the banking sector would be interested in, and what would be the outcomes? Because you talked about issues of MSME lending, which is also very critical. And then the aspect of MSMEs, I thought that was very interesting. So I'm just wondering, how are you collecting this information from MSMEs, especially the micro and small? Because from experience, it's usually not very easy. You really have to get down to the ground and dirty to get information from micro and small. Because I've seen interesting aspects like cash flow volatility, climate scenario. How do you explain this to a micro and small so that you're able to correctly capture this? Yeah, thank you.
Okay, thank you. Okay, there is a hand out there to our left, extreme left. Madam Tuse.
Thank you. Good morning. I'd like to join the previous speakers on congratulating the dual assignment people who are behind this, the brain behind this innovation. I'm from Tanzania, and I've seen Tanzania is one of the options in your platform. Just to connect from the last speaker on how are you going to access the MSME information from Tanzania market, because we are also struggling. So through this platform, I'm interested to know how you're going to collect the data from Tanzania, and for that matter, even from Uganda. But you said I just need to submit my email address and I'll be able to access the information. Is that what you meant? Because I saw that we just need your email address. I've already provided my email address. I'm looking forward to this platform to be live so that we can also share with our member banks in Tanzania. But just to get the comfort on how are you going to collect the MSME information from the Tanzanian market in Uganda. Thank you. Congrats.
Thank you. Ruben, you received comments from this. You want to comment? Yeah. 1 minute. Yes. Okay.
Thank you so much for your very graceful feedback and compliments. We really appreciate that. I think I'm just, so to the question, and of course, this gentleman, to your queue for collaboration, we are very open to that, so happy to have a conversation on that. So on the data, what I think we're gonna do much more on the MSMEs is to become more clear on our methodology. So currently, like the exercise Francis did, you put in these variables and it gives you this vulnerability assessment. Definitely there must be data in the background working and models to arrive at that, right? So in the background we have 24,000 variables. So the back end of the model is 24,000 variables, emission intensity and all that, which we don't want the consumer to face, because that is what banks are saying they don't want. They want what speaks to them. On the MSMEs specifically, so for people like MSMEs, what you are doing is collecting data that helps us to know if you have this number of workers, you're in this sector like transport. So what it's doing in the back end, it knows what is the emission intensity on average of a car that is being operated in Kenya or Tanzania and all that. So we have all these metrics happening in the background leading to that vulnerability assessment. So, and to Brian's point, we are going to document the methodology much better. But the way we are building the platform in phase one, and goes to that question, we don't want users to input information. We don't want MSMEs inputting. We are collecting data from, WMO, Kenya Meteorological Department. We are currently in negotiation even for a partnership. And then now, for us is like to use that to cook in the back end and then say, as an MSME, if you're in this industry, your car is this type, this is your emission intensity. So based on your revenue or based on your distance of travel, we can help you know what is your average scope 1 intensity. So for this phase, we are not collecting from them. We are collecting data from different sources for each of the industry and having this work in the back end. Because we realize if we tell people to input into the platform, they actually don't even understand the language of this. So, and also the last thing I'm gonna say, yes, in terms of access for Tanzania Bank Association, you're welcome to that. So the email address is just simple. Once I get your email, we are going to whitelist it, because when you go to the actual platform, the link we use, it tells you to sign in at the bottom. It tells you this is beta or pre-alpha phase, and then you use your email to sign in. So everyone in the focus group, all we do is we get your email, so that when you use it to log in, it just sends you like a code to put in. So we just whitelist. So anyone who is interested to use the platform after today, maybe you can give your email to myself or Francis, or Wayne is in the room, or Wayne, who is one of our analysts, and we'll just whitelist it. Then you can be able to use the platform, because the link is different. This link, we just created it for the purpose of the conference. Thank you very much.
Thank you very much, Ruben. I think we'll proceed on a short break. We will not have the 30 minutes break as earlier planned, because the next presenter has a very limited time. He's dialing in from another country. And to enable that integration, we will take, suggest 10 minutes break. And as we take the 10 minutes break, please let it be 10 minutes so that we get back exactly at 10:35, and we begin off that presentation soon after that. But I was just thinking, where I come from, and this is in the interest of Ruben, I come from an ecological zone that is protected by government. So what happened is 10 years ago, there was suspension on logging in a forest, in a catchment area. And as a result of that, temperatures have dropped. We were known previously for producing maize. Now it takes about 1 month. There's a 1 month delay in the maize production. What does that mean for a banker, especially when you're talking about grace period for a loan? I'm imagining an agri-MSME. We used to say climate risk aggravates the conventional risks. What happens when mitigative action is introducing a new risk? How do we look at that? Is that transition risk or the inverse of a transition risk? So we can consider looking at that. So let's please proceed on a 10 minutes break. It's desirous that if the coffee is too hot, you can carry it into the room so that we begin exactly at 10:35 and allow our next presenter to progress to other activities. Thank you.
Hello. Hello, John. Can you hear us? Mic testing, mic testing, mic testing. Hello, John.
Yes, I can hear you.
Davis, I can hear you.
Okay, you can turn on your camera so that we... Oh, that's fine. Can see you. Okay, just hold on, John.
Okay.
Thank you. Oh, okay. John, could you maybe project your slides so that we try see whether they are moving on our screen?
Okay.
Okay, you can put in presentation mode. Maybe, yes. Okay, try moving them so that we are sure that they are moving. Yeah, that's fine, that's fine. So we would like you to stay at that point. Yes, just give us about 10 minutes. Then we can begin. Dr. Tiriongo will prompt you. Then we can begin. Thank you so much, John.
Okay. Thank you.
Okay. Iko sawa. Okay. So I welcome all who are outside. Please bring your tea in. If we could begin the next session so that we are not inconveniencing the next presenter. We are going to host a paper by Dr. Uroj Malik and John Muika from University of Canada West, Vancouver. And privileged that we have a discussant from Absa Bank, Fred Andugo, who is here with us today. So maybe we could just confirm, John and Malik, you can get me, please confirm.
Yeah, I can get you, if you can hear me.
Thank you, thank you. So we proceed on to listen to your presentation, and then now we can invite the discussant soon after the presentation. So if you can take about maximum of 20 minutes, take us through the presentation, and then we have a discussant again given a maximum of 10 minutes. So okay. So please feel free to share the slides, and then we can receive your presentation, progress from there, introduce yourself, and then you just proceed to make the presentation. Thank you.
Thank you very much, Dr. Tirongo. I'm pleased to participate in this year's annual conference. My name is John Muika, and I'm presenting our research paper, which has been co-authored by Dr. Uroj Malik. Uroj is not able to attend today's conference due to some other personal commitments, so I'll be taking you through the presentation. We both from University Canada West in Vancouver, Canada, and our presentation topic is sustainable finance and SME growth in Kenya, assessing the impact of ESG integration on credit access, resilience, and asset quality. This relates to the conference, that theme, which is on the role of banks in integrating ESG considerations into SME financing. And I will go straight, start my presentation, and I will begin by noting that businesses today they are operating in a very volatile and dynamic environment. SMEs are part of the businesses, and I also note that as we will all agree, we are operating in a global economy where shifts in technology, geopolitics, and climate risk, whenever they happen in one region of the economy, they affect all the other continents. One of the scholars noted that SMEs are vulnerable to economic shocks. They lack access to cheap capital and struggle to adopt sustainable finance models. In our Kenyan context, this is not different. SMEs represent 90% of the businesses, and they contribute around 34% of the GDP, employing 80% of the total workforce. While data from the central bank shows that banks supply 82% of the private sector credit, and it is due to this link between the most important sector of our economy and the credit supplier. That we are motivated to do the research. Despite of their importance, their economic role, only 23% of the SMEs also access to loans, and that was also data from the Central Bank of Kenya in 2021. Right now, the Kenya's policy and the financial sector are shifting their focus towards the SME support and stability, and I think that's part of the reason we are here in the conference, trying to look for solutions for funding of SMEs. Another study established that sustainability in banking is a risk-based financing model that not only evaluates the creditworthiness, but also integrates resilient metrics, aligning decision-making to long-term stability. And that also forms part of our motivation for this research. Due to our desire to participate in formulating of our solution, risk-based solution, which is a model that improves SME resilience and also enhances their access to credit. In our research, we are looking to answer some of these questions, and the first question is, how do ESG finance principles adopted by Kenyan banks influence the SME access to credit? Another question which we will be answering in our study is, how does ESG screening impact SME resilience to global economic shocks? And the third question we will be answering in our study is, what is the impact of ESG-driven finance on bank asset quality? Moving on to the literature review, and some of the existing studies which we reviewed. First, we reviewed studies that relate to sustainability finance and credit access, and one of the global scholar noted that high ESG scores are related to reduced idiosyncratic risk, lower cost of capital, and more stable return. And these firms are more attractive to investors. Then also another global scholar using regional bank survey data and lending records concluded that ESG screening lowers perceptions of risk on the part of lenders, that's increasing access to credit. On the regional side, in Nigeria, a scholar in Nigeria noted that using Nigerian SME data also found that basic ESG compliance improved lending terms. And in Kenya, in 2022, Maina and Kibati linked SME disclosures to improved credit access among listed firms. Also, we also reviewed literature relating to sustainable finance and SME resilience, and one of in the developed economy, Ahmed identified noted that diversified revenue and contingency planning as resilient factors during COVID-19. Then Kato established that venture capital sustainable finance can offer growth capital to SMEs, enabling them to scale up their operations and increase resilience to economic shocks. Nyamongo, a study in focusing on Kenyan economy, noted that no studies linking sustainable finance to credit risk reduction and NPL performance in Kenya. And unlike all these studies which are based on the developed economies, and also most of them are focused on the supply side, which is the banking sector. Our research focuses on both supply and the demand side, where we are looking at the SMEs, and also we are looking at we are also getting data from the banks. The research also is tailored on to the banking, Kenyan banking context. And also one of the key contributions to our research is the development of the ESG performance index, which is tailored to Kenyan banks. Some of the guiding theoretical frameworks includes the asset liability management theory, which facilitates the matching of long-term assets and short-term liabilities. Another guiding theory is the triple bottom line framework, which states that ESG-driven lending policies should improve not only the financial performance of our banks, but also the environment and social welfare. And the third theory is the stakeholder theory, and based on this theory, it states that it is the role of financial institutions, SME, policymakers, and regulators to work together to formulate sustainable finance strategies. Conceptual framework. Our independent variable is sustainable finance, which we will be developing there. The ESG index based on the Kenyan context. Dependent variable we are measuring the SME growth. That is measured through access to credit, operational resilience, and also loan asset quality. And the control variables, were based on the existing literature, which highlighted that there is linkage between the independent variable and there's a connection between the interest rates and the inflation and the SME access to credit, and that's why we use control variables, control variables which are interest rates and the inflation rate. Moving forward, our methodology is based on a mixed research methods approach, where we collected both, we used both primary and secondary data. Primary data was on surveys and interviews to SMEs owners and bank executive, while secondary data we extracted from publicly available financial reports. Sample size, we used the Yamune formula to come up with a sample size of 100 SMEs out of the 1.7 million. Then sampling, we employed stratified and purposive sampling. purpose is sampling for SME owners and also the 10 bank executive we interviewed. Then data analysis, we used SPSS for analyzing qualitative data and semantic analysis to interpret the qualitative data from the interviews. Some of the limitations of our study is the data availability. As we know, SMEs, most of the SMEs, they don't have good records for their data, and this was mitigated by looking at the publications in the regulators' publications and other volunteer publications from the SMEs. Response bias, especially when we were interviewing the bank executive. This was also mitigated by looking at some of the banks are currently reporting on sustainability. So we also used the bank reports, both the regulatory and the sustainability, volunteer sustainability reports they are reporting to mitigate the response bias and also cultural and knowledge bias. So we made sure we first informed the SMEs that the data we are collecting is only used for the research, and also we got consent from all the SMEs we took information from. Some of the demographics and the reason we did this is just to showcase the kind of SMEs we got information from, and some of the demographics is the farm size, which was measured by the number of employees. This is based on the fact that evidence has shown that very small farms may lack ESG capacity as opposed to the larger ones. Then years of experience, and this is also speaking to the farm's maturity, and evidence has also shown that the farms which have been in operation for a longer period, they have more potential to adopt ESG than the farms which are in the growth stage, and also annual turnover. I think this speaks to the financial stability of the SMEs, because also in one of the findings is that ESG adoption also requires financial capacity to integrate ESG. Moving to the findings of our research, and the first finding is the development of the sustainable finance index, and our aggregate mean score for sustainable finance came at that 7.75%, and this suggested that Kenyan SMEs exhibit only very moderate level of engagement with the SMEs. So based on this, we are recommending that capacity building programs are required so that we can have more SMEs start engaging into sustainability practices or ESG practices. Another finding is ESG screening improves SME resilient. And from the regression analysis, ESG screening had a significantly positive effect on SME resilience. Looking at the qualitative data, SMEs with the strong community engagement and employee support were able to sustain local supplies during COVID-19. And this one, I remember this was based on one of the SME owners during the COVID-19 indicated that even the employees were able to support them to get local supplies from the community because of the engagement, the close engagement they had. So this enabled them to have control over their supply chains and also retain employees during the COVID period. The other finding is that ESG finance improves banks' asset quality, and regression analysis showed that ESG-driven finance significantly enhanced loan asset quality. On the qualitative side, banks, one of the bank executive we interviewed indicated that banks practicing ESG, they reported better quality loan portfolios. However, ESG is still treated as qualitative and not yet integrated in their mainstream risk models. And the comment here is there is need to integrate the ESG into mainstream risk models for long-term impact and credit quality. Another finding was that there was limited impact of ESG on credit access, and regression returned that ESG lending had a positive but statistically insignificant effect on credit access. On the qualitative data, it showed that ESG adoption required upfront investment, which poses a challenge for small and the informal SMEs. And this also, I remember when we were engaging with the SME, is an SME who was practicing farming, and they wanted to install some water pans and also practice sort of circular economy in their farm, and they couldn't have finances. And this creates an opportunity for banks to approach such customers and also create a sustainable portfolio by supporting these ventures. The last finding is on the macroeconomic constraint, and ESG benefits are mitigated. It showed that ESG benefits mitigate macroeconomic constraints, and we are measuring the interest rates and the inflation. So high interest rates significantly impeded both credit access and the resilience. And inflation had a significant impact on credit access, but statistically had no statistically significant effect on resilience or asset quality. So on the qualitative data, It showed that SMEs with high adoption of ESG factors such as energy efficiency, and this was this is another group of SMEs who had installed solar energy and also on operational efficiency, that is drip irrigation, and they were practicing drip irrigation. Had also a bit of strong governance structures, which reduced reliance on fuel prices when the fuel prices were fluctuating and they went high because of the installation of solar energy. They were able to have stable cash flows because they were not affected by the volatility in the exchange rates and the fuel prices. Our recommendations, policy recommendations. Our first recommendation is the development of a national ESG framework, specifically for SMEs. And we are recommending tiered reporting standards where we can have 3 tiers in reporting. We can have informal checklist for the informal. We can categorize the SMEs as the informal, semi-formal, and now they are also the formal SMEs. So for the informal SMEs, we can have just an informal checklist. Then for semi-formal SMEs, we can have a sort of semi-formal scorecard, and also now for the formal SMEs, we can even go to the international standards, maybe applying the IFRS and the GRI. We are also recommending this reporting be phased out in 1 to 5 years. So for the informal SMEs, they can be given up to 5 years for implementation, 2 years for 3 years for the semi-formal, and now the formal SMEs around a year or 2. Another recommendation is the development of digital ESG scoring tools, because evidence also showed that most of SMEs are using the digital channels in finance. So banks should develop digital ESG scoring tools, maybe by use of proxies like energy efficiency and safety practices. Then on the fiscal side, we can have incentives on ESG compliance, which might be in form of tax rebates and interest rate subsidies. Then on the part of the regulatory side, because banks are also required to take collateral while they are lending, we can have a modified collateral requirement, maybe less stringent collateral requirement for ESG compliant SMEs, just to encourage them. For future studies, we acknowledge that we had a response rate of 79% out of the 100 SMEs which we interviewed, and that is 79 firms. So we acknowledge that might not be an optimal representation of the SMEs in Kenya, and also the time taken to carry out the research was around maybe 6 months. So for future research, we are recommending expanding this research using a longitudinal research design with more diverse and larger sample size. That brings me to the end of my presentation, and thank you very much. And back to
Thank you, John. A round of applause to John for that presentation. I now want to invite the discussant to this paper, who is Fred Dungo from Absa Bank. Fred is a senior sustainability manager at Absa Bank. So you could come through.
So can I stop sharing?
Yes, you can. You can stop sharing.
Okay, thank you. Okay.
Good morning. Yeah, as it has already been mentioned, so I don't want to add more. But mostly, I'm really very happy and privileged to have you in this forum. I won't have slides, but I'll be able to go through my presentation, and I believe that we'll also be able to take a keen ear on this. So maybe to begin with, I also felt like it's good you also see what Absa is doing from a sustainable finance perspective. So we have embedded sustainable finance into SME lending by linking green and inclusive products, ecosystem banking partnerships, and digital channels, disbursing large volumes of sustainable finance to MSMEs, coupling finance with capacity building and product innovation. So we've got quite a number of both social and environment products, which we are working on, especially from a financial inclusion perspective. We're really embracing digital, especially when looking at the Timiza platform, whereby we even introduced just the other day, not only Timiza Interest, but also we have got Timiza Lariba, just looking at our Muslim brothers in the name of financial inclusion. We're also looking at mostly women, youth, and persons with disabilities or businesses that are run by people with disabilities and marginalized communities, as well as just trying to ensure that we look at it specifically for those businesses that have a 1 million and below turnover. So concerning this aspect of sustainable finance and SME growth in Kenya, there are gaps that I'm looking at. For instance, when you're looking at the E aspect, and these are the things that are still ongoing even for us as Absa Bank. From an environment perspective, we're looking at two major things. We're looking at nature-based financing, and also we're looking at climate-based financing. From a climate perspective, we're looking at climate-smart agriculture. So in that aspect, the leveraging of partnerships across the market, especially even looking at how we de-risk the portfolio from a guarantee risk-sharing perspective. We do quite very well in terms of ensuring that the asset book is of quality. It's for nature-based financing, something we're looking at it. Of course, it is when you're looking at like the agri portfolio, we're looking at the horticulture, we're looking at afforestation. So those are the things that we're still working on. From a social perspective, I think I've mentioned from the social inclusion, the vulnerable groups, and all that. So from a governance perspective, the gaps we're looking at is especially on the financial literacy, looking at access to finance, access to markets, access to information. So information is knowledge. And that matter, we're just not only looking at how do you run your business, but also how do you grow that kind of business. And also we are looking at a situation or a scenario whereby ESG is not only focused to the corporates, but it trickles down to SMEs, and I'll address a number of challenges. For instance, when you're looking at the corporate side, we're looking at quite a number of standards really favoring the corporate side. IFRS S1, S2, we have got the NSE ESG disclosure framework, we have got GRI framework, so most of these frameworks are really targeting big corporates. But how about the small, medium-sized businesses? So there's a big gap there. It's something that the research paper can also be looking at. And as we all know, when you look at the Kenyan landscape, most of these SME businesses are duplicates. So how do we ensure that they embrace what we call blue ocean strategy, looking at untapped markets, looking at untapped products, and untapped segment of customers, and ESG is the solution. From an ESG perspective, of course, we'll be looking at the asset classes like energy efficiency, renewable energy, green building, climate smart agriculture. So looking at the discussion today, which really looks at access to cheap capital, because that is something that the industry is grappling with, because when you are doing a risk rating and pricing, we always look at SMEs and also those individuals as high risk. So how do we de-risk and even reduce the interest rates? So I would like the paper to be able to look at a risk-based financial model, especially the one that has been rolled out by the Central Bank of Kenya, Kesonia. And this will really give us a very good insights in terms of how do we even calculate the K and be able to offer affordable interest rates to our SME. Another thing the paper can also be enriched is the ESG screening, especially when you're looking at environment and social risk assessment. Again, ESRA has always been favoring the corporate because it is well organized. We have got the human rights policy, we've got environment plan, we have got waste management policy and all that. So how do we ensure that the SMEs also embrace that? So that should come out clearly. And in terms of screening, it is really not very easy to screen SMEs because of the volumes and also in relation to our workforce, the resourcing. So I would like the paper also to just to give maybe thresholds where we can start with in terms of environment and social risks assessments for the SMEs. Another thing on asset quality, the vulnerability assessment. So how resilient are these SMEs when you're looking at georeferencing of these portfolios? Where are they located in the country based on physical and climate, physical climate and transition climate risks? So those are the two aspects that we also want the paper just to look at from a vulnerability assessment to ensure that there is resilience, to ensure that there are lower NPLs, and also to ensure that they tap into ESG opportunities. Another thing I'm looking at the paper could also address is what they have mentioned, the development of ESG performance index. So for us, we will be looking at this ESG performance index as a key driver to lower interest rates, especially also if it means also partnering with the credit reference agencies in Kenya. How can that also trickle to our, for instance, our CRB report? How is that rating? So that it can also help us gauge the resilience, and hence these SMEs can also be able to enjoy lower interest rates. Another thing on growth, so how do we measure this growth? Really needs to come out very clearly. Are we measuring growth in terms of size so that we say within a period, these are the SMEs that have transitioned to large corporates? So if that's the case, please, also that needs to be very clear. So the growth metrics should also be clearly stated. And then lastly, development of ESG framework. So I believe this framework should from a recommendation perspective, I believe this framework will be looking at sustainable finance issuance mechanism, and also rating and resilience and impact measurements. So I'm really very keen to see this kind of framework, so that it will help our SME department to be able to grapple whatever they have and to scale up, and ensuring that the market in Kenya, the SMEs do not remain SMEs forever, because the essence here is for them to grow. We would like to have them in future offering employment to most of our youth, most of our women, persons with disabilities, or anyone else who wants to join the corporate world. So how do we also grapple that growth aspect of them just being stagnant as SMEs forever? Thank you.
Thank you, Fred, for those insights coming again from the ground in terms of the practice, what is important to inform the paper. Maybe before I open it up for all of us, I think just to give you some feedback also, John, is of course the need to make sure that the recommendations are tied directly to the results that we generate, and therefore tied to the objectives of the study. We're talking about ESG and credit access and asset quality. So the question that we ask ourselves is, how do we make sure that whatever we do on ESG screening, how does it enhance credit access? What's sort of, and I think David did mention earlier in the day, that a lot of these sustainable finance carry with them some incentives. They carry with them some concessional funding elements that come with it. So to what extent can we embed those incentive structures that come with sustainable finance to support credit access? Then of course, even as we talk about also building on asset quality, what do we need to do with ESG screening and ESG mainstreaming that can build the resilience of the borrower to the extent that then eventually the quality of our assets that they hold from the lender's perspective is enhanced. So we could sharpen that part just to make sure that the recommendations we are making are tied to the results that you find in your study, and I think that would be very important. So we'd want to open it up for any questions for John and Uroj that they could pick up from this study. If there are any also comments online, we will be able to share them directly with the authors. If you also have additional comments that you want to supplement what the discussant has given, I think there's a hand up. Yeah.
Hello, good morning.
Good morning.
So 2 quick points.
You could introduce yourself.
Jane Garia is my name, Strathmore University. I think a quick one is to add GDP as a macroeconomic constraint. That would be very important, considering that SMEs contribute 34% to GDP. The second one for future research area would be to break down the SMEs to sector-based, since banks have, or they extend credit to different sectors. That would be important as well.
Thank you, Jen. Yes, there is a hand up here. Yeah, so perhaps we could take him and then we progress. Thank you.
Yeah, thank you so much. I think it was a good presentation. I think I introduced myself, so I need not to, but I'm still Silas from Kipra. So I have some 2-3 questions that I want to raise. Let's look at the topic. The topic is an impact assessment. But what are we being presented is not an impact assessment. That is not an impact assessment. Because in an impact assessment, you need to have the treated and the counterfactual. The student is not having both of them. You're only seeing the treated group. So this is not an impact assessment study. So that topic should relax the determinants. So that's the first thing that I want to raise. Then the second thing where I would be interested so much is how the student or the author calculated the indexes. There are indexes that are being explained there. Although I don't have the preview of the paper, but the way the indexes are calculated is very key, because does it follow some chronology, or is it their own way of calculating it? And how are the questions framed? Because these are questions that are framed. So that when we construct an index, you tell me they framed this question this way, this one this way, then you construct an index. Then we have a story, if you are following any theory or any otherwise, because that one impacts the result and the recommendation that you have. Then another thing that I also realized that would be a bit interesting, to explain to us on what is resilience, the impact of this, what they are calling impact, which is not impact, of ESG on resilience. So how do we measure resilience? I think it might have been explained in the paper, although I don't have the preview of the paper, but it will be very interesting to see how you measure the resilience, because there are a lot of different ways of measuring it. And then I would be seeing which method did you follow when you're measuring resilience, because that one also has an impact on how you do the conclusion. Then another thing is on the result, because the sample size is a bit smaller, 100 only. I don't know the distribution Kenya-wide, because they are only 100, so I don't know how distributed they are. I would be interested to see the distribution of that. And then something that is interesting, I was not given in the result, the summary statistic, although it is a summary. The author is trying to discuss the result, let's say ESG lending. ESG lending is not significant, but the author still point it out. We don't, in a discussion, we don't pinpoint non-significant result. So that is not correct. So I think that one should be a bit avoided so that it doesn't bring a lot of confusion there. Then there is the issue you're saying ESG finance, ESG screening. How are they measured? Because I was interested in ESG, there was an ESG index, but now when I'm coming to the result, you now see another term, sustainable finance index, then there is another ESG screening. So there are terms that are being thrown in and out, which I don't know how they were measured, so it makes it very hard for somebody to try to understand. And then conclusion, understanding on the shoulder of my senior Tirongo, the conclusion, you don't see them coming from the paper, because the paper is just like a determinants. You see what is being put there, then something like, I just picked one, develop ESG framework. Then I ask myself, which variable was picking the policy? How was it framed? Was there a question like, do you have policy that guide this sector? Something like that. Then when you say there's no policy, then there was yes or no, then I can come to say there was this policy, it's missing. Then you recommend that. But you don't see that as a variable inside that. So then it makes it very hard that the conclusion and the recommendation are hanging on their own and the paper is on the other side. So thank you so much.
Thank you, thank you, thank you. Any other additional comments? Okay. John, if you could come back briefly for where you take note of what needs to be clarified, you can carry them forward. You don't need to clarify everything in this forum. We also take comments for further improvement now that these are working papers under construction. So, John, do you want to comment?
Yeah, I think I will be answering the comments on right now, but I've taken note of all the comments. Some I'm able to answer, but I have, because some of them are already answered in the main paper, like the ESG performance index, and how it was developed. So I think I've taken note of all the comments, and I'll be working on it, and also I'll work with some of the discussants to just iron out some of the issues they have mentioned.
Okay, okay. So we'll be happy to make the comments much more elaborate to you as we share them back for improvement of the paper, for the comfort of all the readers that will be keen to know more about the contents carried in the paper. So allow me now to transition to the next paper. And, which is by Lucy Maru of KCB, and it's on the mediating role of ESG on the interaction between green banking and financial performance of banks in Kenya. The paper will be discussed by Dr. Ruth Muinga from the University of Nairobi. I was told I need to say the University of Nairobi. Lucy.
Good morning. First, I want to appreciate KBA for giving me this opportunity to be here with you today, and I'm happy to be here. This paper is titled The Mediating Role of ESG on the Interaction Between Green Banking and Financial Performance of Commercial Banks in Kenya. I'll go to the introduction stroke background. We realize that financial institutions have a fundamental role in growth and development through mobilization and circulation of finances. This is also alluded by Vargas and Joseph in 2014. A stable financial system facilitates liquidity and funds factors of production. And in the banking sector, we have unforeseeable risks due to unforeseeable challenges which are economic and environmental in nature. This was also put forward by Dickow and Foles in 2021. Research that was conducted by MISRA in 2014 indicates that climate risk is a critical problem that is facing the world. Climate and nature-related risks can affect financial stability through physical risks, that's like submergence of cities and hinterlands, and loss of livelihoods and damage to collaterals that banks hold, and liability risks, where we have lawsuits and litigation, and we have transition risks adjusting to decarbonation of the economy. Banks as creditors, investors, advisors, and heads of supply chain can have an exponential corporate emissions reduction that could follow their practice that influence client and supplier networks. This was put forward by Bowman in 2010. And therefore, banks have a potential to mitigate risks and facilitate adaptation to nature and climate-related risks. In different markets, there are different levels of implementation of sustainable banking programs. China, for example, has adopted a policy-based approach to sustainable banking to help tackle profound environmental problems and support transition to a green, inclusive, and resilient sustainable growth path. In Indonesia, the OJK, that's the Financial Service Authority, launched Sustainable Roadmap in 2014, and it enlists the financial sector players to contribute to the national commitment to address climate change and support the transition to a competitive, low-carbon economy. When we go to Mexico, the Mexican Banking Association has led a voluntary industry approach through the development of sustainability protocol, which was formally signed in April 2016. It aligns the national priorities, such as government climate change targets for the next 15 years, that is from 2016. When it comes to Kenya, the sustainability agenda in the banking industry was launched by Kenya Bankers Association in 2012, and in year 2015, the SFI, that is Sustainable Finance Institutions, guiding principles were adopted by the banking industry. So the purpose of this study is to investigate the mediating role of ESG on the relationship between green banking and financial performance for the banking industry in Kenya, and show the interaction between green banking and ESG and the influence they have on NPLs and return on assets. NPLs is non-performing loans. And also, just show how banks can contribute to, green banking can contribute to stability and profitability in the banking sector, and review the Kenya banking sector financial performance in line with the green banking and ESG performance. The objective, somehow, just repeating the same, so the objective is tied to the topic, and the research question is, what is the mediating role of ESG on the interaction between green banking practices and financial performance of commercial banks in Kenya? So there are two hypotheses to be tested. The first hypothesis, the null hypothesis, that negates the objective, and the alternate hypothesis that indicates that the interaction between green banking practices and financial performance of commercial banks in Kenya is mediated by ESG. That is environmental, social, and governance. The literature review, there was a study that was done by Salem et al. 2024. It recorded inconsistent results regarding ESG and financial performance. Another study that was done in 2022 by Aslam and Jawad emphasizes that green banking adoption practices have a positive impact on environmental performance, operational performance, and financial performance. Other studies which have been done by Shakil 2019, Edogmas et al. 2022, and Velt 2017, they show that ESG can improve financial performance, including profitability, market performance, and operational efficiency. And it shows a positive relationship. There was a study done by D. Tomaso and Thornton 2020. It shows a negative relationship between green banking and bank performance. There were other studies done by Lamanda, by Salem, by Shan et al. 2024. They find a neutral relationship and suggest the need for further studies on the same interaction between ESG and bank performance. Then there's evidence by Abrantes that policy and practice are set to prevent financial and environmental rebound because they are symbiotic. There are two theories that anchor this study. The first one is the stakeholder theory, and the second one is the resource-based theory. So I'll just go direct into methodology. In order to arrive at the independent variables, that is green banking indicator, secondary data was sourced from books of accounts and websites of commercial banks. In order to arrive at ESG factor, ESG was calculated by assessing a company's performance across environmental, social, and governance criteria. The data that was collected from commercial banks, books of accounts, and websites was from 2013 to 2024. 2012 to 2024, that makes 13 years, and key performance indicators were scored and weighted. The scores were aggregated and the results were normalized to provide a comprehensive rating. Criteria for assessing of GBI and ESG was based on existing literature and compared with GRI, Global Reporting Initiative standards, and ISSB, that's International Sustainability and Standards Board, and also the IFC performance standards. And some of the control variables were sourced from CBK reports. To break down the indicators of green banking and ESG, the independent variable being green banking, literature. As you can see in the presentation, the literature was sourced from existing papers that are published, and some of the indicators are online banking, online financing practices, mobile banking, ATM, disclosure policies, green procurement, ESG practices being incorporated in lending, reduction of carbon footprint in internal operations, energy efficiency, green banking, green operational daily practices, green loans, green projects, and training. When it comes now to the ESG, the environment, based on existing literature and the comparison that was done, we have energy consumption, water usage, waste management, and carbon footprint. For social, we have employee diversity, workplace safety, community engagement, also known as CSR, labor practices, customer privacy, employee training, and financial inclusion. And for governance, there's board diversity, that is percentage of female board members, corporate ethics, disclosures in reporting, and auditors. Then we have the mediating, the other variables where we have the controls, and the dependent variable being performance, we checked NPLs and ROAs. So for mediation, I'll not dwell on these formulas, but these are the paths that we were trying to check: the direct path, the indirect path. The direct path is the path between green banking and financial performance. The indirect goes through mediation process, ESG, to bank performance, and then checking whether there's a mediation between ESG and green banking. So I don't know, it could be quite small, but those are the descriptive statistics. That shows the variables that were used and the population. We have a population of 39 banks, but there were some banks that had missing data. There were also banks that were merged during the study period, there are banks that were put on receivership and banks that were incorporated within that period. So the same was omitted. Then the results, I'll also not dwell on that. I want just to go to the discussions. And the discussions, the first is that green banking adoption improves financial performance. Green banking to ROA, the results were significant. So there's significant evidence that green banking improves financial performance, but when we add ESG, the effect drops, suggesting a partial mediation. Then when we look at green banking and credit risk, there was no significance between green banking indicators and NPLs. So other factors could be affecting NPLs and not green banking in this study that was taken at this time. But with the controls, there's significance, but it's negative. So we conclude that green banking lowers NPLs, especially when firm-specific controls are included. However, the mediation effect of ESG is not significant in this path. Then there's also mixed evidence for ESG as a mediator. For example, between GBI and ESG, there's strong indication. However, when we put ESG directly to a return on assets, there's a statistical significance, but it's negative. So maybe explained by some of the studies that we have seen before. So I will go to just a high-level conclusion that ESG performance partially mediates that relationship between green banking adoption and financial performance. And there's no evidence that ESG mediation mediates the relationship between green banking and credit risk. The policy recommendation, ESG criteria in the banking sector helps banks to identify certain nature and climate-related risks in their assets portfolio and their operation, which helps institutions identify suitable models that can withstand the emerging risks. The industry may also focus on sustainability dimensions that create shareholder and investor value in the future. And then by embracing ESG, banks are able to navigate green banking more easily and look critically at banking sector specific climate-related risks and opportunities. This paper therefore persuades commercial banks to report on their green banking asset portfolios, which will allow performance measurement and benchmarking. To the regulator, the paper persuades the regulator to develop and advise banks on a standard criterion for ESG and green banking reporting within the banking sector, that is sector-specific. And this will address the existing gaps on data availability. Like one of the limitations that we noted when we went to do content analysis, some of the banks who are practicing ESG, but they're not reporting. So the scores were low for them because we are basing on secondary data, but when now you go to what are they are doing so much, but it's not being reported. Then to the government, this paper persuades governments to develop laws and regulations that encourage commercial banks to provide finance for climate and nature-related solutions in order to enable pathways towards net zero and climate risk, resilient economies. Thank you for listening.
Okay, I now invite Ruth to give her discussion of this paper, and then we open it up for comments and questions. Thank you.
Good morning. Is it afternoon? Still morning. Good morning. My name is Ruth Mwinga from University of Nairobi. I can say mimi ni mwalimu wa economics. So first I want to congratulate Lucy. It was a nice presentation. And to be honest, this topic of your research is very timely and relevant, and especially to African context, and specifically to our country, Kenya, looking at the performance of commercial banks, because it is from the performance of commercial banks where they are able to touch the citizens, or I would say common mwananchi, through micro financing. So I've just said that it is relevant looking at how green banking practices interact with ESG, and also looking at the profitability or the performance of the commercial banks. But what I've also noticed from the work, what stands out is that you not only look at profitability of the banks, but we also look at the credit risk of the banks, which is very important. And using ESG, not just as a variable there as a determinant of the performance of the banks, using it as a mediator is a very good job on that. Again, when you look at use of, sorry for that. When you look at the context where you are using Kenyan banks, and as I said before, this provides the much needed evidence, and especially in African context, and not just African context, we're also looking at other developing countries. It is very important, and this will add to the existing knowledge, which is kind of limited when it comes to developing countries, because most of the studies that have been done on mediating effects and the interaction between green banking and performance of the commercial banks, it has been dominated by the developed economies, and now bringing it to African context, it makes it better. Again, the length of your data set coming from 13 years, it is also good because it provides a solid foundation. for interpreting the results, and for sure that will be a good study period to enrich your results. Again, you also apply mediation analysis in your estimation, which is very good, and this will try to show us how green banking influence performance, and also how the how the ESG, which is the mediator, affects the relationship between the two. Again, we've seen from your results, the discussion, that there's partial mediation for profitability, and there's no mediation for credit risk. And this one can also try to add to the existing literature and make people discuss more about the role of ESG, and especially as a mediating, variable. And overall, we can say that this work is credible, and it adds to existing knowledge, and it is good not just for academics, and even for policy discussions, and especially how to pursue sustainability of the commercial banks. So I have a detailed report on areas where you can improve the work, but I'll just go to the final page because of the time, and I'll be able to share my comments, my detailed comments with the KBA, who will share with you to improve the work. But just before I start with the first one, I would encourage you to look at, the organization of the work, coming from the introduction, going to the literature, going to the methodology, and also the results. It is good to see, what comes before the other, like looking at objectives. The objectives of your study and even the questions, they should not come, after the literature or discussion of the literature review. So it is something you need to improve the work, because it is just work in progress when it comes to the organization of the work. And also when you look at the research questions, they also come before the objectives. Again, something on organization. You cannot discuss theoretical literature after you already discussed empirical literature. Again, something that comes out on organization. So please later check on that. Okay, just to summarize this, a few areas on improvement, looking at the abstract. From the abstract is where you understand what the author is working on, and it's where you get so much information. In fact, most of the times when we are writing our literature review, we rely heavily on the abstract, and therefore it means that the abstract should be comprehensive enough to cover the critical aspects of the paper. And this includes the scope of your paper, the methodology, and even the results, and the conclusion, and recommendations. So that was lacking in your paper, and please, as you work towards completing the paper, please consider that, because it is very clear. Again, in the background or introduction, it was a bit comprehensive, which was good. But when you look at the focus, it was focusing, on shifts between empirical findings, climate risks, organizational dependencies, and even global protocols. It needs to be a bit structured. You can start with the global debates on green banking and ESG. Then you narrow down to the regional, context, going to the African context. And then you can also be followed by the Kenyan context. And this will make this work to be smooth for the reader to understand the flow of your ideas. So please, you can consider that. And at the end of the day, from the background of the study, it is good to also introduce the research gap, at least try to elaborate it very clear. Again, in the background, it is important to highlight what these ESGs are. and the applicability, and especially in the Kenyan context, because you are talking about Kenya, so it is important to have, a brief overview of ESGs, especially in Kenya, and also looking at the banking industry in Kenya with respect to the green banking, and also the way the banks are adopting the ESG practices. So it is very key, especially in the background of the study. And talking about the background of the study, and when I'm talking about, your focus was more on the shifts between the empirical findings and all that. Also look at the citations and try to use the APA style for your referencing. It will make the work more credible. Research objectives, ideally they should come before the literature review. I think I've just talked about that. So it is all about the organization of the work, so I'll not repeat that again. The Kenyan context here, you talked about, I think in page 2, about climate change shocks and, and the savings and the impact on it. But, you could have done a bit more and try to see how this impacts, the performance of commercial banks in Kenya and why it is so important in Kenya. And you have an example there, Kenya's reliance on agriculture, exposure to droughts and floods, which are climate-related situations, dependency on international finance, and evolving regulatory environment, all make it unique and critical context in examining green banking, which could have been very important, and especially in the background of the study. The other aspect on area of improvement is on the literature review. So it was diverse and broad, and it captured ESG aspects, green banking, and even performance of commercial banks. But when you looked at it, it is not well organized, and I would encourage you that you try to, arrange your work systematically, using themes. Maybe you can try to link them to theory and try to explain any contradictions from the theories. So it is important if you are linking on maybe the resource-based view, then you can try to discuss the empirical studies that are based on that, or any other theory, so that you can see the review of your literature is kind of systematic in that. And again, I think I don't know what is the justification for using only 2 theories. Maybe you can try to do it later in your paper and elaborate why it was important to use just 2 theory. Okay, so I'm trying to go to the next line, sorry for that. The next comment is on theoretical foundation, and I think I've just talked it, about it when I was talking about the literature review, why you need to justify your theoretical foundation. Why are you why is it just based on these 2 theories? And again, here I noticed with the stakeholder theory, there was a bit of confusion between stakeholders and shareholders. Maybe you can try to check that for the final paper to be a bit clean. Then we have something on methodology. I would say that it was well thought out. It was great, but there is need to have clear justification and transparency. And here is why are you using mediation analysis? And this is panel. Why are you not using, random effects or fixed effects? So there's need for you to be clear on why you are using only mediation analysis. And apart from that, also, what informed the sample of, you said 36 commercial banks. And again, there was something about the way you collected data from the commercial banks' books. I think it was not very clear. Then you need really to justify that and also elaborate on that, and that will make the work better. So you also need to define the green banking, and I think in the presentation it was there, but also something that I really wanted to know, and it is not in the work, is are we using ESG as the aggregate index, or are you separating, and what informed you to not to use it as a aggregate index? So that is something that needs to clearly come out in your work. Again, you also need to justify why 2012 to 2024. It is good for the reader to know why you need to use that particular period. Okay. Again, on analysis, the estimation technique that you choose to use, I think you also need to say why you need to really use it, and you also want to tell the reader why do you think only using that estimation technique makes your work robust. So there are other things that you can do to check for robustness of your work. You can try to check whether it is applicable. So there is a lot of justification, especially on the analysis that estimation technique that you are using. I don't think stating that you are using Stata 2013 is good, because it can raise questions. Because someone might ask you, were you able to test for robustness? Does Stata 2013 has, the same modeling? Is it there? So please, for the future, avoid you writing Stata, whatever software you use, and specifically 13. So that one, not that. Also, you need to justify the choice of return on assets and also non-performing loans in Kenyan context. It is important to make it really come out. And before I go to the findings in the methodology, you also need to really show in terms of theoretical model how these variables are linked, just for clarity, and also trying to make the future researchers replicate your work. So please make some form of theoretical modeling. On findings, I'll not talk much, but what's peculiar about the results was the negative coefficient of ESG on profitability. And this tells you that it deserves more discussion. And I just hope as you finish your work, you will be able to discuss that, because the question here is, does this suggest that, the costs of ESG implementation outweigh any short-term benefits to the commercial banks? And this is something you really need to reflect on. About policy and practical implications, I think they are so broad, you need to be kind of specific on it. And I think I also explained every item that I've discussed here, I explained on how you can do it better. So I just hope you'll get my detailed comments. They are there on areas you can improve and how you can do that. But with that, it is a good area that you are focusing on. And I can't wait to see the final document. Thank you.
Thank you, Ruth, for that comprehensive discussion of the paper. It's a proof that you've read between the lines. Want to open it up for comments, general comments, questions, any additional comments? Yes, so there are 2 hands up. Okay, we could start with...
Good afternoon. It was a wonderful presentation, Lucy. I really enjoyed how you were able to structure specifically the recommendations for the banking and the regulators. So mainly the comment that I'd like to put forth, you mentioned that the paper persuades banks regarding the reporting of their banking practices and portfolios. You mentioned that in some occasions the banks don't report what the detailed aspects of how they're incorporating ESG. So maybe a recommendation is that at times maybe it could be like that aspect of expertise. Like for instance, banks are good at accounting, but they could be doing something like regarding it could be energy, or maybe there's an aspect that they are not quite skilled in. So maybe you could examine that there could be need of when they're doing the reporting, like having a multidisciplinary team, like people who are maybe in the insurance, water management, because if they have knowledge of how ESG is being done, then they are more in a better suited to do the reporting. So that's it for me. Thank you.
Thank you. Suggestion on how best to report. Steve Makambi, there was a hand up on the other side. Yes.
Thank you, Lucy, for the presentation. I just want to say that there's this animal that you've unleashed called ESG. And it's very important for us to talk about how do we measure ESG, because you've used self-reporting mechanisms that the bank use, and we're not challenging that because that is what we have right now. But to KBA and Ruben, can you hear me? Can we come up with a way, a framework of measuring that can standardize how we measure ESG? Because what do we mean by ESG? How do we measure it? What do we weight? Do we weight environment more than social responsibility and governance? What are we considering? If we standardize that, this particular animal you're calling ESG, then it will give us a very good platform to do comparative analysis and across organizations and over time. But because it's a new conversation, let us really think about how we're going to quantify this beautiful variable that we're calling ESG, tailored to the needs of our country and our sectors. Thank you.
Thank you. Thank you, Steve. Yes, Elizabeth.
Thank you so much to the author for this paper. But just a few comments that you could work on the paper. When you look at your introduction, you really need to give us a flow of how all the variables that you've captured are coming through. ESG, the green banking, the financial performance. We need to see that coming out clearly, even as you follow what they usually call the funnel approach, so that we can actually see what is the rationale for this study, what's the problem statement, what are you trying to address, because that didn't come out clearly. And then also, somewhere in your hypothesis, as I saw you mentioning the alternate, I don't think there's any need for that. And then in your literature review, you just give us two theories, but we are not able to link like your variables. How are all these connected? How are they coming out of this theory? And then I think the key part, which is the methodology, for us, for me who was listening, it was almost non-existent. You just briefly mentioned the mediating aspect, but we didn't even see it, and also the variables. You need to show us how did you operationalize these variables, because I'm left wondering, at some point you're talking about ROA for performance, then NPL somewhere else. Yeah, so we need to see those very clearly so that we can see what models did you use, and then how did you conclude, so that now you give us the recommendations. Thank you.
Okay. Yes, so yeah, there's
Just one question. I think the presentation is good enough. The ESG is measured like there are different indicators that you showed there. I think the best thing should be, because let's say you go for E only, there are indicators under that. Then you go G, there are indicators under that. Then now you want to put them into the equation. Then you see now, do they go there as an index or they enter the model individually? That would be a bit interesting to see how they enter the model, because they might be like 5 or 4 measures of the way we have been told. Then another thing is also on the way you said that around 37 banks, but then the first study that on ESG told us their reportings are not so much. So I don't know if these things were the person who constructed them using on something, because he said there are only like very few banks that are doing it. But for you, from what I heard from you, you have done it for almost all the banks. Then the last time that I've just picked from the discussant is that you didn't do a panel regression. I don't know if that is correct from the discussion that you just do. I was thinking this is a panel, then you should do some playing around with it. I saw some playing around with it, but I didn't know which model. Was it an OLS? Was it a fixed effects, a random effect? Something like that would be a bit interesting to see. Then to help, just to help to how to improve it. Because let's say you have a model and then you have run some regressions here and there. We want to see, is there any correlation on those multicollinearity issues and endogeneity, and then if there are theirs and how they were addressed. Some more playing around with the data set, but it's a good trial. Thank you so much.
Okay, thank you. 2 minutes for Lucy, for where you pick suggestions on how to improve the paper. You can also indicate the same.
Once again, thank you for your comments. The comments by the discussant, Dr. Ruth, I'll take them to improve the paper because I can see they're quite detailed. Then there are some questions that were asked and some suggestions. I'll take most of them to improve the paper and to maybe answer on operationalization of variables and how ESG was arrived at. There was that slide that showed the indicators that we were looking at, the data points. And most of the information, even if some banks are not reporting on integrated reports and sustainability reports, the information like on auditors, on governance and board diversity, on online banking, number of ATMs, you'll find them on the books of accounts. So that's partly on green banking. But maybe what I can add as one of the proponents have said, we need a context-based indicators. For example, when you look at what banks are doing, like carbon reduction, they may not be able to report, but they are doing a lot of carbon credit through planting of trees. Some are even paying, through carbon credit. So we need a context-based criteria for ESG. As it was said, actually back to KBA, concerning NPLs and the results that they are presenting. There was a presentation yesterday about credit guarantees. Probably if we had credit guarantees and we had portfolios that are critically just for green banking, we can be able to analyze that. But now we're looking at data, panel data, that is for all banks, all types of loans. So it's a call for there to be portfolios that are clearly green banking so that we can be able to assess performance. For the others, I'll take them as key takeaways and I'll incorporate in the paper where possible. And I hope that you'll be able to read the paper. Thank you.
Thank you. For the comment from Steve, I think KB8 actually took up that suggestion of trying to standardize reporting. About 2 years ago, we published a template that standardizes reporting based on the Task Force for Climate-Related Financial Disclosures, and even when the central bank issued the climate-related disclosures, we also partnered with ISPAC to develop a template for, because of the IFRS, the extensions to the IFRS S1 and S2 for climate-related and sustainability-related financial disclosures. So all that was trying to standardize reporting, and then by reporting so that it eases the comparability from one bank to the other. It also supports banks in making sure that they include all the elements that are needed in a more structured way. So all that has been taken, and that was taken up as a challenge by KBA, and now banks are well versed. Trainings also have been done on how best to report on that. We cannot wait as researchers for reports to come out based on that, so that it gives us standardized indicators that we can use for our studies, and also the questions around operationalizing the definition of terms would also be very much made clear for purposes of research, so that researchers can tap onto them for analysis as we go. In the interest of time, yet again, we do not close the sharing of comments. Please, even during lunchtime, and you have additional thoughts that have come to mind, and the authors are still here with us, please share them directly. The overall objective is to really have papers that speak to the issues in the best way they should. Before lunch, we have another interesting paper on bridging the financing gap in MSME financing in Kenya. It's a unique paper. It's a collabo between a commercial bank and a microfinance bank. So we will have a hybrid of thoughts coming our way shortly. This is a paper presented by Doris Kirago of Consolidated Bank and Salome Wairimu of Caritas Microfinance Bank. Again, this paper is going to be discussed by none other than Hilary Mulindi of KBA, who is also around. So I want to invite Doris and Salome to take us through this presentation. And remember, you're sitting between us and the afternoon.
Policymakers, delegates, distinguished bankers, online participants, and the convener of this meeting, Kenya Bankers Association, good afternoon. Good afternoon once again. Let's take a moment, truly a moment, to celebrate our heroes, the micro, small, medium entrepreneurs. Our research today is based on bridging the financial gap in MSME financing in Kenya. I am together with my co-author, Sally, and this is because of some stories that have been demanded to that we needed to write down. I stand before you not only as a banker, but as someone that has walked the fields, sat with farmers, and listened sometimes uncomfortably to their truth. I have met farmers who have soiled their hands, faced loss, and yet stood with resilience. This is a truth that cannot be ignored. Meeting farmers from different counties, I will name Nyandarua County, who are in business in terms of growing potatoes and carrots. That is Nyandarua County. Then we also have Embu County, watermelon and tomato farming, and Meru County for banana farming. They are the backbone of our economy, generating 40% of our GDP and employing nearly 15 million people. Yet, they are often unheard. I sit with these farmers, and it's very interesting that you get to understand that they have similar questions, and this begs the question this afternoon: how do we bridge that financial gap? And the 4 interesting questions stood out within the 4 counties. One was, why do banks ask for titles? And yet, how can I be able to access a facility without this particular title? The other question has been, do banks even understand our challenges as farmers? That prompted me to think even deeper, and as something that I'm passionate about, I realized that we need to get to the level whereby we are able to understand our MSMEs, especially our farmers, and that also they can also be able to understand the other aspect in terms of the financial institutions and also the microfinance institutions. Another question that stood out: even when I deposit money, why can't I access a loan? I have cash flows of 500,000, yet I could not qualify for a loan. One farmer asked me clearly, I have banked with you for more than 1 year, and yet I cannot be able to access a facility. And for sure, we know the people in the room as bankers, we will classify our MSMEs in different categories, either early stage, maturity, or growth stage. But with this particular farmer, we would classify her as a farmer who is a startup. And we ignore that. And the last statement she made was, let me get back to M-Shwari, let me get back to table banking, because it's easy, it's fast, and there's no documentation that is required. Wow. These are some of the questions that have arisen in my experience with these farmers on a one-on-one basis, and have challenged me also to think through this paper. When SMEs understand our language, and we also get to understand the language of the SMEs, then we get to a win-win situation. And indeed, the economy grows. The reality is 77% of our SMEs in Kenya report difficulty in accessing credit from formal institutions. This isn't just my story. This is a report that has been published by CBK with SMEs that have fallen from 1 trillion shillings in 2022 to 771 billion this year. And from my presentation, you will note that our SMEs create the largest job opportunities and indeed promote economic growth, which cannot be overemphasized. And some of the challenges that most of our SMEs are facing are related either to cost of credit, inadequate documentation, access to financial constraints, limited information, sharing, and collateral requirements. I, as a banker, having worked in a particular unit within the bank, I would like to highlight that 95% of landed security is either male-owned or corporates, whereby 5% is women-owned. This begs the question, how do we get to a position whereby we are able to support our MSMEs? Within the CBK SME survey, which I have just highlighted, the loan applications were 1 billion in 2022, and in 2024, they were 873 billion. While the loans approved were 830 billion, and in 2024, they were 771 billion. You will notice from this presentation is that most of the SME active accounts, most of the SMEs have either taken facilities through the Hustler Fund. This is a report that we were able to get through FinAccess, the MSME survey report 2023, which was at 44%. Mobile banking was at 28%. Chamas, 23%. Mobile money, that's overdrafts, for example, Fuliza, which was at 23%. And here we are, banks and microfinance banks at 15%. What can we do differently to be able to accommodate our SMEs? That's the big challenge within this room. A recent World Bank survey states that what will shape the future most is AI and innovation at 45%, education and training at 34%, while sustainable finance is ranked at 12%. What I would need to emphasize on is we realize there's a really huge need for our SMEs to get access to affordable finance, not just finance, but affordable finance. The estimated SME credit demand in Kenya is 2.98 trillion shillings. While the credit supply in Kenya currently is at 495 billion. However, we realize that there is a financial gap, which is 2.4 trillion Kenya shillings. This is such a significant barrier. Yet, we as bankers in the room, we as microfinance banks, we as policymakers have the opportunity to provide solutions that can be accessible, solutions that can drive our SMEs to become better persons, the next companies, the next SMEs as they grow within their businesses. Our research question is, what are the key constraints hindering MSMEs access to external financing in Kenya, and how do these constraints contribute to the financing gap? This paper was done as a result of this passion that I had to just get to understand the dynamics within the MSME space and try and get solutions so that we are able to make profits as financial institutions, but also improve on the key policies that are required, including unlocking growth to this economy. I will request my co-author, Sally, to proceed. Thank you very much.
Good morning. Good afternoon, sir. So from that rich background, I would like to proceed to how we went ahead and did a paper with our main research question being, what are the key constraints that are hindering MSME access to finance, and how do these constraints contribute to finance gap? So we had a theoretical literature review where we looked at some theories and other empirical literature. And the first two, the credit rationing theory and the asymmetric information theory, really answer the question of why banks hesitate to lend to MSMEs. Where we see that the credit rationing theory, banks deny borrowers funds, though they might be credit-worthy, due to perceived high risks. And in this sense, we are talking about the MSMEs, where banks look at them and see like they are really risky, and thus they just put them aside and they don't give them, they deny them funds. The second one is a matter of looking at the available information between the borrowers and the lenders, and having a situation of adverse selection and moral hazard, where the unreliable information makes banks deny these MSMEs or borrowers funds. And we have two other theories that emphasize on the need of banks to know their role in giving supplying credit to MSMEs. And this is the financial intermediation theory, which says that financial institutions have the critical role to facilitate access to credit to MSMEs and any other borrowers. This is through mobilization of savings and supplying these savings in terms of loans or credit to borrowers. Then we have the pecking order theory, where we say that MSMEs might have the capability, might be willing to finance themselves from internally using their retained earnings, but they may be, they may not have the ability to do so, so they are required, they end up looking for credit from somewhere else externally. And that is where we come in as financial institution to give this credit to them. From the empirical standpoint, we look at some authors who have listed some of the constraints that MSMEs face when they are looking for credit. Like you see Brixiova, Kangoe, and Diogo in 2020, and also an IMF paper in 2024 that stated stringent documentation requirements, lack of collateral, informality, and poor record keeping. Also, limited entrepreneurial skills are major barriers to MSMEs. Also, we have a paper that talks about access to credit by MSMEs helps them improve their productivity and also their sustainability in the market. We also have a paper by Kiringa et al. In 2021 that recommends relationship lending as a way of easing financial access for MSMEs. And to go into our methodology, we used data from FinAccess 2024, which is farm level secondary data, and we used a model, a logistic model, regression model for estimation. Some of the variables that we decided to use are listed there, with access to finance as our dependent variable, and the others are constraints that we decided to test to see how they influence the access to finance by MSMEs in Kenya. Without going into the details, because we have a more comprehensive outline of how we came up with this in the major paper. So these are the findings in summary, and we used the marginal effect as a way of testing. So we grouped some of the barriers as bank-related. These are the requirements that majorly banks ask for when they are appraising MSMEs. And the others are farm level, which are our control variables. That is the location of the business and gender. So the findings say that for business records, probability of being denied a loan is at 4.6 percentage points when you don't have business records with you. So this includes formal documentation and financial statements that MSMEs are asked for when they are asking for loans in the banks. This shows that this reflects when MSMEs don't have these records, it shows that they're not sharing enough information with the banks, such that the bank cannot be able to really tell if that loan they are giving to them is going to really perform or not. So it is a major requirement, and I can say maybe from our experience as bankers, you can attest to this, that for an MSMEs to be given credit, they have to have really thorough business records. Our second point is on guarantorship, and we realize this is peer guarantors, where when a MSME is looking for credit, sometimes they might be asked for their peers to guarantee them, and we see that probability of being denied a loan if you lack a guarantor is up to, which is quite high, 35.7 percentage points. And the guarantorship, I will tie this with the collateral also, because we see almost 10% denial probability if you lack collateral. Maybe this is a way that banks tend to view MSMEs, that they are high risk and they might not be able to repay loans. They may not be able to repay loans when they are granted. So these are major requirements that we look for, and from these results we can see that they are still key for banks. And the other one is this negatively listed firms by a CRB, and we see that the probability of being denied a loan if you're negatively listed is 6.2 percentage points. And maybe this is to pose a question on how quick banks are open to adapting to maybe changes in behavior of a customer. Maybe they were listed due to some of the reasons that in the past, and you look at their credit score and see their history is not really good. So how are banks big on giving second chances to MSMEs? So on our farm level characteristics, we were looking at location, where we decided to look at rural-based MSMEs and also urban-based ones. And we see that for MSMEs that are located in the rural areas, the percentage of being denied loans is 13.4 percentage points. And compared to those that have businesses in the urban areas. And I don't know if it is a perception that banks maybe have of MSMEs that are located in the rural areas, where they may be seen as less profitable or informal or high risk. Or maybe it is internal bank practices that make them kind of averse to lending to MSMEs in the rural areas. Maybe we can think about that as we continue. And then the other one is on gender, the gender effect, where we see that if you're a woman who is asking for a loan, a lady who is asking for a loan and you're the owner of the MSMEs, you're likely to be denied loan, and the percentage is 32.6 percentage points. Maybe this is, maybe when we look at maybe presentations that were done yesterday and the dashboards that show that women are excluded from financing in all areas, maybe this is an area that we need to look at as bankers. And we had several recommendations based on those findings, and we grouped them. One of the major recommendations that we are seeking to discuss here is on the blended financing options. And this is like banks being open to adopting more concessional funding for MSMEs compared to commercial lending. And I would say that concessional loans, when you look at them, they are favorable in matters term, pricing, repayment periods, and also collateralization. And they have an aspect of risk sharing between the person who is giving the funds and also the bank. So here, when we look at our findings, where we find that most banks may deny loans to MSMEs because of their risk profiles, maybe concessional funding is a way that we can be able to mitigate that. Because when you have like a program that is targeting MSMEs and has less stringent measures, you might end up attracting a larger pool of MSMEs who are going to apply for that. I'll give an example, and probably this is for the agribusiness farmers. We have the value chain financing by MEST, where you see they finance several value chains by farmers, but at favorable terms. And these farmers are seen to be more open to take up these loans. At the same time, they have better repayments compared to other people who are taking commercial loans. Maybe this is an option that banks can think of exploring as a way of bridging the financial gap for MSME lending. And the second one is on single customer view. This is majorly on data capturing at our banks. And it's a solution that we are proposing for information between the borrowers and the lenders, where you have a 360-degree profile view of MSMEs, of the customer as an individual. This way you're able to, you get their KYC documentation, you know where they live, their name, their contacts, and also maybe their next of kin. At the same time, maybe leveraging on some of the solutions, some of the suggestions that we had yesterday, like AI, you can be able to check maybe their statements to see how these people, their financial statements are in one, like you aggregate from all kinds of businesses that they have, or on the other hand, so that you can be able to improve the profiling and also the appraisals in the bank. This is a bank recommendation, bank-related recommendation. And also we want to suggest expanding capacity building and financial literacy. And this way we want to shift the focus from banks themselves offering the capacity building sessions or programs and financial literacy, because especially when you look at some of the smaller banks like the Tier 3 and the microfinance banks, might not have the capability to do both financing and at the same time train. So maybe these programs can be done from a centralized way where you invite bankers as partners, so that an independent group does the financial literacy and capacity building, and bankers are invited as partners to offer the financial bit of it. And finally, on the farm level characteristics, we are talking about especially for the gender bit, we focus more on developing products that are gender sensitive, and not only by talk but by doing, because you find that in practice, most of the time you say you have a women-led or youth-led or something product, but in practice you find that this is not practical when you go to the banks. So maybe having more emphasis on that and making sure that it is practical. Also, location-sensitive risk models, and this is where we say that sometimes we might be excluding people who are living in the rural areas because of how we view them, but probably just thinking, these people, when you compare businesses that are done in the urban areas and those that are in rural areas in terms of permanency, today you might lend to somebody at maybe Kamukunji, and tomorrow you come and find the business is no longer existent. But in the rural areas, however, that person lives there. There's the community around him. There's the reputation. Maybe when you think about it, these people are not as risky as we view them. So banks, this is a call to maybe look at how you are appraising these people in the urban areas and in the rural areas, and note the differences between them so that you can incorporate them in your lending. Thank you.
Thank you, Doris. Another round of applause, please, for Doris and Salome. I was just thinking as Salome mentioned about Kamukunji and no longer there. Perhaps our businesses also take our digitization to the next level. They become virtual soon after they open, and therefore we need to find them in virtual spaces sometimes when they disappear physically. Discussant, Hilary, please feel free to come and take us through your discussion. Hope you keep it very brief. Lunch is ahead of us.
Ladies and gentlemen, good afternoon. It's indeed an honor to discuss the paper that has been done by these two distinguished professionals. They were actually looking at how to bridge financing gap in MSME financing in Kenya. And if you read the paper, what comes out is the expertise and knowledge they've been able to get from the industry and how they're trying to use theory to be able to address some of the key issues that we are really struggling with at the industry. So as I was reading that paper, there's a proverbial story that came to my mind. Imagine of having two villages, one on this side and another one on this other side. Between these two villages, they are separated by a very big river that has crocodiles. And for those you've read a book by Ngugi wa Thiong'o, The River Between. We have two ridges, Makuyu and Kameno, separated by a river between them. So basically, from my first analogy of the two villages, so on one village you have the MSMEs, on the second village you have the banks. But now, how can these MSMEs cross the river to get this other side of the banks? And then the second question is, how can the banks cross from this other end to get to this other side of the MSME? So an attempt to do that is met by frustrations. We have collateral requirements, you have high interest rates. So the moment these MSMEs try to cross, they're either carried away by the water or swallowed by the crocodile. So basically, to be able to address some of these challenges, two people stepped forward. One of them is called Salome, and the other one is called Doris. And basically, as they step forward, they are trying to see how best they can be able to assist this MSME to move forward. So to be able to address that issue, they came to the KBA annual research conference, and then we ask ourselves, to what extent is the problem that they're trying to solve aligned to the research conference? And what came out, the problem they're trying to address is very well aligned to the theme of this year's conference, which is the banking and economic growth dynamics, whereby we are focusing on the risks and opportunities. And in trying to get the solution, they're actually trying to answer the common paradox that we're having in Kenya, whereby if you look at the results by the FinAccess, we are being told that Kenya is, the level of financial inclusion has risen to around 86%. And yet, if you look on the other side, we are saying MSMEs are really struggling to access bank financing. So at the core of their whole motivation and trying to bring the paper to light, they are looking at 4 key issues that are actually being faced by MSMEs. So one of the challenges they are looking at is the collateral shortages, the perceived cost of credit, the need to have business records, and the issue of CRB listing, which are actually great impediments to these MSMEs. So having looked at the paper, the key strength that comes out from the paper is the kind of data they're able to use. They anchor the entire paper on FinAccess survey, which is a good representation, and it's a good face of enterprises across the country, because being done by the Kenya National Bureau of Statistics, we have footprints across all the counties. So I felt having used that survey to try to address this problem was a strong thing. But now, having done all that, there are some few issues that I would like to bring to their attention, which they would really like to, which they should actually consider to make the paper strong. So if you read the paper, they bring on board something to do with the partial credit guarantees within their literature, which they reviewed. However, that does not infiltrate into the modeling bit. So I feel for the paper to be more informative and to have more policy relevance with the current shift towards having guarantees to try to offset or try to de-risk the MSMEs, being able to bring this aspect within the model, it would be very, very handy for the paper. And then number 2, we have the micro, small, and medium enterprises. Based on their operations and the financial needs, they are not homogeneous. So there's the need to actually disaggregate the impact of the dimensional differences in their model so that that can come out strongly, whether they are facing the same challenges or there are some kind of enterprises which are actually having less burden compared to the others. And then lastly, as I had earlier indicated, they based their study on the 2024 MSMEs, the FinAccess survey. But for any insightful information, we need to have like a time period so that we can be able to compare period by period. What are we observing in the market? Are the constraints gradually increasing, or are we consistently addressing the constraints? So that at the end of the day, we target our policies towards the aspect that seems not to be unlocked by the current or existing policies. Now, as I move towards the end, I would like to ask myself 3 things in terms of the relevance of their paper to the banking sector. Majority of us have been able to read the recent report released by the Central Bank on the MSME survey. And if you are very keen, there's something interesting from the survey, from the report. The report indicated that out of all MSMEs which have been applying for credit, 88% of them have been gotten approvals from the bank. But if you read it into details, you get that because they are comparing 2024 and 2022, there was a decline, a 13% decline in the number of loan applications by the MSME. Then the question is, are we having self-selection in the economy? Are we having less demand for bank credit? So that's why I feel this conversation is so much relevant to the current conversation. The second aspect, it's an area that actually portends a risk to the banking sector. If the MSME continue to be underfunded, and we argue that 98% of enterprises in Kenya are comprised of MSMEs. So what do we mean in terms of job creations and the economic growth? So the ripple effects of underfunding MSMEs will gradually infiltrate into the economy, and we expect even the banking sector to start grappling with the effects of underfunding MSMEs. And then the last question, which builds into their recommendation, is what opportunities that the banking sector have based on this situation. So for me, I look at it in terms of providing a platform to innovate products, ranging from how do you finance the various value chains across the MSMEs, How do you leverage on fintech to be able to unlock some of these challenges, and how do you strengthen the guarantee issues? All of these have been very well reinforced within their recommendations. And then finally, as I conclude, I would like to say that the paper is timely and very policy relevant. It speaks to Kenya's MSME financing challenges directly. In terms of strength, I've alluded to the FinAccess survey data, which all of you will agree is a good representation of survey, a good representation survey that captures the dynamics of various counties across the country. And from their recommendation, which I call the call to action, there's the need to relook at the collateral requirements on how can we reduce them, how can we lower the cost of credit through blended finance, how can we strengthen financial infrastructure to be able to assist these enterprises to access bank funding, and then the issue of capacity building. And she was very elaborate to explain about having a centralized training, which I know the Inuka program has been doing, and now we have a center that is doing that within the Kenya Bankers Association. And then finally, I would like to encourage all of you to read the paper once it's been polished. Thank you so much.
Thank you, Hilary, for not only comprehensively discussing the paper, placing it within the context of our theme, but also making sure that you kept within the time provided. At this point, we would want to invite any comments, views, questions, suggestions. Yes, Jared. Mike, please.
Thank you. Thank you. First of all, mine is really to commend Doris and Salome for the paper. I think this is one of those coincidences where the passion and practice coincides with the call for paper. So I think the timeliness is really there, and you could see even from the way the paper was presented. I'll not speak to methodology issues because I think Hilary has spoken to them. I'll probably point to, and these are not really for answering, but things that you can consider as you polish the paper. The first one is really how you framed the conversation in terms of giving the motivation for your analysis, whereby you argue that to the extent that SMEs are not able to access resources from banks or formally or prudentially regulated financial agencies, they end up going elsewhere. They end up doing fleas and all that. To me, that means that it is a case of finance at whichever cost, so long as they're able to get finance. How you can reinforce that into your argument is by saying that because of that kind of characteristic, some of these MSMEs are seeking finance and they end up being trapped. So essentially, they end up being trapped in a vicious cycle where you want finance, that finance is expensive, and it's expensive because you're not able to get it from a formally or prudentially regulated agency, and then you go around the circle. So I think that will make your case even more stronger as to why whichever policy recommendations you make or market reform recommendations you make is really trying to break that vicious cycle. And linked to that is really a conversation that I've not had since yesterday around the infrastructure, the financial infrastructure. A long time ago, we used to imagine that, the microfinance model was the solution to lending to SMEs because banks were shying away from lending to SMEs, and therefore the microfinancing model came in, especially on one attribute called taking collateral substitutes, group lending and stuff like that, so long as those group lendings are linked to SMEs. And everybody was talking about the Grameen model and how the Grameen model has been able to boost not just credit, but with a very good repayment record. But literature is abundant with the evaluations of how the Grameen model itself ended up, trapping the same beneficiaries in that cycle of expensive debt and all that. I think some of those experiences can easily make your case more compelling in terms of what recommendations you make. I like the fact that you used the FinAccess data. Of course, if you address the limitation of going back in time, as Hilary has said, that will make your empirical findings convincing. And I think that's something that you can easily remedy. But there's one limitation that is within the FinAccess data that I think maybe you may need to look at, because it has a direct implication to your findings. The FinAccess data is rich in terms of many of the attributes that you've highlighted in your paper, at least from the presentation, whether the gender of the borrower, the location, and all those other attributes. But it doesn't speak to a very important thing called, if you're an SME, which is your market. And the reason why that's important is because when you start talking about concessional funding, much of the concessional funding that comes is probably from DFIs through commercial banks. And therefore, it probably is more amenable to SMEs that are export-oriented and not necessarily those that are indulging in what you can call non-tradables, as we can call it in economics, in economic speak. And therefore, if you're able to interrogate where the market for the SMEs is, then that is where you'll probably have to start persuading the argument around the need for concessional funding. And just on the aspect of concessional funding, I think you may have to couch your recommendation more carefully, because if the SMEs are going to be sustainable on the basis of funding being concessional and not necessarily being at market level, then their true viability as business entities can only be determined if you are to remove the concession. You get my point? And therefore, the recommendation as to concessional funding may have the same attributes as the one of being trapped in the same high interest rate. Therefore, you may actually make a recommendation on concessional funding, and you end up trapping these SMEs in concession, because the moment you yank the concession, are they going to operate? So I think those are some of the things that you can try to see how you can incorporate in the paper. But otherwise, this is a very commendable piece of work, and I applaud you for taking the courage and the time to do the paper. Thank you.
Thank you, Jared. You introduced something very interesting. I remember the time when, I think about 2 years ago, when the government ordered that some of the outstanding digital loans should be forgiven. And but that was conditional that a customer was, if they are able to afford half of the facility, then the other half should be forgiven. So when that was made available to some customers, some clever customers actually refused the offer, because it sent a very bad message that you needed support, and therefore the next loan would have to be rated on the basis that you could only afford half of that. And so the clever customers refused and said, no, let it be, I'll take care of it fully, because it reflects on your ability to pay and your limits then going forward at the end of the day. So again, as we embed concessional funding, there is the other side of it, that are you the type of customer that can only benefit from form of finance if it is a blended finance at the end of the day. So it's a give and take if you look at it from the standpoint of being able to access sizable amounts of money for scale operations. So, but while at that, the lenders on the other side can still deploy concessional funding at lower rates without necessarily customer being aware about it, especially where it affects the cost of lending. So, it's a risk sharing arrangement that is not made available, or at least to the customer is not made aware about it to that extent. So it's an interesting paper, again, calling on a lot of customer-centric design of products, because it talked about even including location-sensitive product designs. So again, I think the theme for the conference is there are a lot of good things in the detail, and detail carries a lot that we need to start embedding in the strategies that we use for financing of MSMEs. I want to, in the light of what has been raised, Salome and Doris, do you want to say something before we close? Or you're taking fully the comments that have been given? By nodding, I guess it means you're fully taking all the comments and the appreciation that comes with it, of course. But again, feel free, even as we engage over lunch, that you can exchange further comments for this. A disclaimer: where product names have been used in this room, they are just used for purposes of research and not for anything else. I know Doris has mentioned about Mshwari. It's just for demonstration purposes, and as we go for lunch, we forget the product names. We carry the message that comes with the rest of the paper. So it's just for demonstration purposes. So thank you very much. Enjoy your lunch. I think it's served at the same place on 3rd floor. I'm looking at Hillary because 3rd floor. So again, meal cards are issued as we exit. It is 13 minutes past 1. So if we could regroup exactly at 2:15 to receive a paper by another set of interesting papers. Paper by Professor Kodongo Odongo from Wits Business School, and another one by another veteran, Josiah from KMRC, on, I don't know why he chose discouraged borrowers. Could we have encouraged borrowers also? But insights again to come soon after lunch. Then finally, a methodological session from the Credit Information Sharing Association of Kenya. Enjoy your lunch, and see you at 2:15. Thank you.
Hello, Prof. Hello, Prof. Hello, Prof. Mic test, mic test, mic test.
Hello, sorry I was muted. How are you?
Hello, Prof.
Done.
Mic test, mic test. Professor
Hello,
Odongo,
can
can
you hear
you?
me?
Oh, you can hear me?
Yeah, I can hear you.
Oh, thank you so much. We'll be having your presentation from from 2:15, I believe. 2:15 years, we could be having you after lunch, after the lunch break. So we're just doing some testing whether you would, how you come online. So for that matter, could you probably put your camera on so that we see whether you can be able to see you and even the slides, whether they are able to move.
Okay, let me do that.
Yeah, we are testing.
Are the slides now?
Yeah, yes, they are. Maybe you can put in slideshow view.
Yeah.
Okay. Can they move from one to the next? Just try moving from, yes. Can see motivation next. Oh. Okay, thank you. We are able to see. I don't know if you can also put your camera on to just yes, I can see you are. I can see Prof. Yes.
I can't see myself.
Yeah.
I hope.
Yeah, from our end we are able to see Prof. Now, and I think we can also hear you well.
Okay.
Yes. No.
Prof, just a quick one. On your presentation slide, okay, could you be able to increase it to make it bigger?
Bigger? It's on presentation mode.
It's on presentation. Then there's that slide for next slide, which is also visible.
I see. So maybe that's what I need to work on.
I think, Prof, you just move to the next slide. I think it will move on our end also. Just move next slide. We'll be able to see whether it moves on your end. Yes. It's
that next slide, I have no idea how to remove it. Maybe somebody can tell me how to do it.
Okay. Is it on presentation mode, Prof?
Yeah, that's when it shows.
Okay. Okay, it's in presentation.
So, okay, just give me a moment because I'm using two screens. Maybe if I remove one screen, it won't show, right? Does it show now?
There it's perfect. It's okay like that.
Okay.
Okay, so thank you, Prof. We do it at after lunch. That's at 2, starting at 2.
Okay.
Yes, thank you, thank you.
And God said, "Let there be light."
I'm the founder of Plate Post. We make video menus for restaurants. It's kind of like TikTok and
Hey, how's that New Year's resolution going?
What are you talking about?
You know, that YouTube channel you say you're gonna start?
Well, yeah, I'd love.
Okay, good afternoon and welcome back to our last session of the day, which will actually carry 3 different presentations. One is a paper by Professor Odongo Kodongo of Wheat Business School in South Africa, and the discussant is Peter Wamalwa from CBK, followed by a paper by Josiah Kiplagat from KMRC, and then a methodological session from CIS Kenya. So, Prof, if you can hear me, please indicate you can hear me. Prof, can you get me?
Yes, I can hear you. Sorry. I was muted. Can you hear me?
Yes. Thank you.
Okay.
So we are ready to progress. Apologies, we are 15 minutes past the hour. So we invite you to make your presentation for about 20 or so minutes, then we get the discussion views before we open it for further comments and questions. So feel free to introduce yourself and then progress to make the presentation.
Okay, thank you very much. My name is Odongo, and I'm at the Business School in Johannesburg. So my presentation is an encompassing analysis, if you like. It touches on practically everything that has been discussed at the conference yesterday and today. So I'm trying to see whether there is the possibility that we can develop an overriding framework for the financing of SMEs by banks in Kenya. And I need to emphasize that the study focuses only on bank financing and not other forms of financing. For example, private equity is not covered, and neither do we cover private money lenders, table banking, and that kind of thing. So it's focusing only on bank finance. And the word sustainable is used here to refer only to persistence rather than sustainability in the context of environmental degradation or protection. So it's about persistence in successful provisioning of credit by banks to SMEs in Kenya. Also, the focus is on small and micro enterprises. The study does not cover medium-sized enterprises. The approach that I take is that of so there's literature starting from the theoretical literature and then looking at the practice of lending by banks to small and micro enterprises. And then marrying the two to come up with suggestions on how to possibly enhance lending to SMEs in the Kenyan context. So there is a contextual information that I'm going to go through to very quickly demonstrate the problems of SMEs in regard to funding, in regard to credit provisioning by banks in Kenya. And that is how I motivate the study. So I first make this observation that SMEs account for a huge proportion of private sector enterprises in the country, and they contribute almost 1/4 of the country's GDP and practically almost everything on the total labor force. So that is to say that SMEs are an important segment of the Kenyan economy. But the trends as far as lending by banks and lending by other credit providers has not been very encouraging. And I show, I make mention of studies, surveys that have been done by various entities in Kenya in the recent past. Those surveys generally indicate that SMEs have difficulties accessing external finance, especially bank credit, and especially on favorable terms. So a quick look at the context, like I mentioned. The figure here shows, this is from the Finland case study, although I got the data from, I think it's a collaboration between FSD and FinAccess. So the overall access to credit stood at around 55% of the SMEs as of October 2022, and there was a marginal change to 56% of SMEs by June 2023. But what also comes out is the gender disparity in SME provisioning of credit. So SMEs owned and operated by women appear to be advantaged in the credit market. Who lends to SMEs? Again, this comes from the FinAccess study in 2023. It shows that mobile banking credit used to be an important source of credit to SMEs, but that seems to be giving way to the Hustler Fund, at least as of 2023. So the Hustler Fund seems to have displaced a mobile banking loan as far as SME access to finance was concerned. But importantly, we see that banks and microfinance banks allocate very small proportions of their credit to SMEs, despite the fact that a good part of their profit comes from this sector. So there is this asymmetry between what you receive from the SMEs and your willingness to advance them credit on favorable terms. And I'm speaking to banks here. So what is the reason that makes SME owners go to the credit providers? And the data indicates two important things. One, that most of the time SMEs go to lenders if they need banks to support their inventory acquisitions. And second, that they go if they need to expand their business. Now, I'm picking on the two for two reasons. One, because the two of them jointly constitute the bulk of the reasons that SMEs go to lenders. But importantly, because these two reasons speak clearly to SMEs' desire to improve their performance and therefore to positively contribute to output. This is to say that there is need for banks because, like I said at the beginning, I'm trying to address banks here. There is need for banks to recognize that SMEs are in need of financing because they need to make a positive contribution to the economy and therefore possibly find ways by which they can be able to increase lending to this sector. And evidence from elsewhere, which I haven't shown here, shows that SMEs generally provide a sustainable contribution to the economy when you're talking long term. And that some of them eventually, of course, under favorable conditions, are the ones that will grow into medium-sized and large enterprises of the subsequent periods. And so it is important to nurture them at this point when they are still small and micro, with a view to converting them to more important contributors to the economic growth and development going forward. So the questions that we are trying to address in this paper are given the observations that I've made. The first is what explains bank lending to SMEs. So notice that I'm leaving out in Kenya in that question because the approach, like I mentioned, is that of a broad-based literature review that cuts across lending to the SME sector across the globe. So asking the question of what it is that explains bank lending to SMEs. But once we get those reasons, we then ask the question of how can we be able to increase our lending to SMEs as banks in Kenya. So what do the lessons that we learn from a global review of the literature tell us that we can do as banks resident in Kenya to improve lending to SMEs? So, but I start with a quick look at the policy framework. So On the table that I'm showing now, I depict capital adequacy ratios of banks on average for the entire economy between 2017 and 2023. I also show the regulatory minimum. So notice that the regulatory minimum over this period averaged 14.5% total capital to total risk-weighted assets, 10.5% core capital to total risk-weighted assets, and 8% core capital to total deposits. And also notice that in each of these periods, banks on average exceeded these regulatory minimums by more than 3 percentage points in each of those cases. In the case of total capital to total deposits, we are looking at a difference of at least 7 percentage points, which is very high, compared to the regulatory minimum requirement. So this is important because there is a possibility that these high ratios are not because banks improve their capitalization. It could be that banks reduced their total risk-weighted assets, and that reduction can possibly partly explain the starvation of credit to SMEs, because banks generally perceive the SME segment as more risky than your traditional sectors of the economy. So we would be saying that as far as the health of the financial sector is concerned, these statistics are pleasant to look at. But if they represent a reduction in total risk-weighted assets, then we may have a way by which we can argue for a marginal reduction at the very worst in these ratios in order to better accommodate the ability to lend to riskier segments of business, as opposed to keeping them at a high level to maintaining bank stability, while at the same time rationing credit to sectors that would possibly engender additional economic output and create employment. So there's a policy framework that is currently under revision. The last version of it was done in 2020, and that framework lays out quote-unquote an affirmative action plan for the SME sector as far as provisioning of credit is concerned, among other things that it addresses. So I begin my literature review from a theoretical perspective. When I looked at the literature, what stands out in the literature is that there is a need to think of the relationship between lenders and creditors in a given context. And that context says that the most important, possibly theoretical relationship between the two, what Hillary was calling the river. So the river between SMEs and banks in the theoretical context happens to be information. So we can look at information in two contexts. There is information. So we think about information in terms of who has more information between the lenders and the people that are borrowing about the projects against which the borrowing is being undertaken. And in general, there's an agreement in the theoretical literature that borrowers have more information about the projects against which they are borrowing than lenders do. And so lenders try to bridge the gap by requiring that borrowers provide certain pieces of information that can enable lenders to make an informed decision. Now, if a firm is large, and especially if that firm is listed on the stock market or listed in the bond market, then chances are that the kind of information that the banks look for is already out there in the public domain, and therefore that reduces information tension between the bank and the firm. But for SMEs, one, there is no requirement that SMEs must produce information about the operations and put it out in the public domain. And second is that a number of SMEs are operated by individuals who may not be cognizant of the need to put information out, enable and enhance those who are looking to dealing with them to have a better understanding of their operations. So they may not be cognizant of that need, but also there is need for them to protect their information, given their limited understanding of the reporting framework, protect their information from competition. And therefore, it happens that relative to more established enterprises, SMEs have limited information about their operations out there compared to the relatively established enterprises. So that creates what I'm calling information tension between the SME and the bank. And so that information tension can explain why banks are generally hesitant to provide credit to SMEs, and if they do, providing it at a higher price, the higher price being necessitated by the desire by the banks to maintain a different expected return, given that they are lending to segments that they do not have accurate understanding about their operations. So there are two aspects of this information tension. One, we are calling it adverse selection, where we are saying that on the average, a bank will attract, for lending purposes, entities and individuals that are generally more adversely exposed to misappropriate the money that they will have borrowed than those who are less adversely exposed. So those who approach the bank are likely to be those that have the tendency, or they have the proclivity not to honor the obligations in the future. But then there is also another aspect of information tension, where you have done your part as a bank and done your analysis, and then you provide credit to the credit applicant, and at the end of the day, the credit applicant then does not use the money for purposes that had been intended at the time that they approached the bank to request for the credit. We are going to dig a little deeper on this as we move on. So the moral hazard aspect happens after the fact, but the adverse selection happens before the fact, where the fact is the lending transaction between the bank and the borrower. So how do banks, so before I go to these mitigation strategies, what I'm trying to say is that a close examination of theory suggests that the most important way of understanding the lending relationship between the bank and the SME is that of information. And so we look at banks as a little more information opaque compared to, we look at SMEs as a little more information opaque compared to more established larger enterprises. So given that understanding, we ask the question of, so what should banks do to reduce their exposure to information opacity? So we've got a lot of theoretical suggestions. Some of them came up in the papers that have been presented earlier today. Some colleagues, presenters, call them credit rationing theory. So I'm looking at credit rationing as a way of mitigating asymmetric information or information tension between the two sides of the lending divide. So under credit rationing, without necessarily boiling ourselves down with the theoretical diagrams on the slide, what we are saying is that there are firms, for example, SMEs, that are willing to pay more interest on credit, on the credit that we are seeking. But banks are hesitant to give them a loan, even at those higher rates of interest that they are willing to pay. So banks are happier to provide a loan at a lower rate of interest than the rate of interest that some of the SMEs are willing to pay, because those SMEs that are willing to pay higher interest are likely to subject the banks to greater adverse selection risk. And so the lending rate may be lower than the rate that some segments of the market are willing to pay, because that lending rate that is lower enables the bank to make a higher profit than if they were to lend at that higher rate. The reduced profit coming from the additional risk that they have to bear when they take the decision to lend at that higher interest rate. And because of that, therefore, they end up supplying less loan to the market than the total loan demanded by the market. So the total demand could be 10,000, but the banks end up supplying only 8,000 in value, total value of loans dispensed. So the difference between the 10,000 that the market needs and the 8,000 that the bank is offering is an excess demand. And we say that the bank will effectively have rationed out a segment of the market from the credit provisioning. So SMEs happen to constitute the larger proportion of that segment of the market that is rationed out of credit provisioning. So that is one way of reducing risk, simply by not taking it, not giving credit to riskier applicants, loan applicants. Now, the other way of reducing risk as a bank is to ask for collateral. Collateral is an asset that you take hold of as a bank in name. So in law, the lawyers will say you have a lien on this asset. The SME or the firm that is borrowing is still using that asset, but the bank will have the first right of claim on that asset in the event that the firm does not honor its obligation to the bank. So it could be, for example, that the SME owns the premises in which the SME is trading. So the bank then takes the ownership document of that particular premises, puts it in trust in the event that the SME is unable to honor its obligation to the bank. Then the bank will reach out to the trust to facilitate the disposal of that of the premises. So collateral is an asset that is pledged to back the issuance of a debt instrument, like in this case, a loan. So this helps to take care of moral hazard. So the loan has been given, but the bank, the SME may decide to gamble with the loan, and the gambling may fail. And when it fails, the SME is unable to honor the obligation. And so the bank resorts to selling the asset that was pledged to back the issuance of the loan. So collateral, of course, has its shortcomings. One is that when I pledge an asset, for example, if I pledge inventory, I can decide to not to take good care of inventory and therefore subjecting it to the risk of deterioration in value over time. So that is gambling with the asset. Or I can decide to gamble with the loan, in which case I took the loan to put in an asset with a risk level maybe equal to 8. But now, because the bank has taken collateral, I say, okay, after all, I've got some security on this loan. I'm going to take on a project with a risk level of 15 instead of the 8 that I showed the bank when I went to look for the loan. So that is gambling with the loan itself in terms of changing the nature and the characteristics of the asset or the project that I need to put the loan to use on. So generally, therefore, collateral does not adequately address the risk of moral hazard, which is supposed to address. So the other way of mitigating information tension is to engage in relationship lending. So here is where the bank engages with the SME over time, and therefore over time it gets to understand more about this SME. And so it has what we call soft information about the SME. Soft information goes beyond the typical financial statements that we get from borrowers when they want to borrow. So we understand them in a deeper sense than just the physical aspects of trading, which they present to us when we require them. So that cannot be possible if you don't have a close relationship with the borrower. So relationship lending, therefore, is one way, an important way of addressing information problems. Relationship lending is easier when a bank has local presence than when a bank operates from Nairobi, for example, and just has customers in Mombasa, but no serious presence in Mombasa, or it operates largely from Nairobi. But if you have a bank that is situated in Mombasa, as a community bank, for example, or some kind of bank, like a SACCO that converts into a bank, that SACCO has better understanding of the membership, which are ultimately going to be the borrowers, even if they have small enterprises on whose behalf they are coming to borrow, than a bank that is situated in Nairobi but with a small presence in Mombasa. So relationship lending works better with the locally oriented banks and with the smaller banks that are still seeking to establish a modicum, a reasonable amount of presence in a given context. So linked relationship lending is soft information, like I've indicated. So I've in the process talked about it. So, but there is incentive contracts that also enable banks to reduce their exposure to information tension. And one example that we can give is guarantees, which again has come up since yesterday. I think the paper by Rogers, for example, yesterday was largely talking about guarantees and how they have been used to mitigate information problems in the lending market. Finally, I talk about technology and how it can be used, for example, in credit scoring to soften hard information. So we can be able to not necessarily approach information softness from a relationship lending perspective. If we have technology that can help us to bridge that gap, that would be quicker and also more affordable than establishing banks everywhere in the country for the purposes of achieving information softness. So technology can be used, for example, in credit scoring. And then we have innovative ways of mitigating asymmetric information, and I'm giving the example of blended finance. So this reminds me of a critic earlier today, just before lunch, that some types of lending, for example, I think the example that was given was that of concessional funding. So blended finance is an aspect of concessional lending. So the critics say that there's a danger in that, that it may also amount to a trapping of the borrower in certain types of loans and may not necessarily work in the long term. I tend not to agree with that criticism. So when you look at concessional finance, the main focus, and that includes blended finance, is in de-risking of the client, de-risking of the SME. And that is one way by which you can address information asymmetry. So there is de-risking that can be done in two ways. If it is blended finance, the de-risking comes from the price of credit. So therefore you are addressing the information asymmetry before the act, which is adverse selection. But there are other ways of achieving concessional lending, for example, guarantees, which are necessarily addressing the other side of the information divide. So we are looking at moral hazard. So the government or the DFI, Development Finance Bank, comes in to say that in the event that the borrower defaults, then we stand ready to pay a part of or all of what is due from the borrower. So in the event that the borrower defaults. So now, if it happens in that way, in the form of a credit guarantee, for example, you are not necessarily implying that the borrower is not able to afford the loan, or that they can only be able to achieve the lending objective if the loan is subsidized. The focus is on de-risking them for the time being, so that, because a good part of the information problem is perception. And this perception arises because of the fact that SMEs are information opaque compared to the traditional firms that banks are accustomed to lending to. So that information opacity creates a perception in the bank that this borrower is a higher risk borrower, and therefore we need to slap a higher rate of interest on them for them to be able to take the loan. And that higher rate of interest protects us, the bank, against the perceived risk, adverse selection risk, and perceived moral hazard risk. And that perception is because there is limited information about them. So the DFI and the government and other entities that participate in converting an otherwise commercial loan into a concessional loan, they do this to try to address that perception, and therefore we call it de-risking of the SME. So the de-risking doesn't mean that the SME will not be able to afford the loan in the absence of de-risking. The de-risking is to take away the excess risk perception, and therefore to be able to price the SME at a level that is potentially consistent with the risk inherent in that SME. So I don't subscribe to the argument that concessional funding and anathema to sustainable lending to this SME in a small enterprise that is in need of funding. So I'm going to talk about this again when I get to recommendations. So before that, I take a quick look at a demand-side perspective. I think there's a paper coming up later today that says discourage borrowers. The question is, what happens? Why do they get discouraged? They get discouraged partly because of imperfect screening by lenders. And this addresses the point that I've just made about concessional lending. So screening by lenders is generally imperfect because banks and all lenders do not have complete information about the borrowers, and therefore you cannot attain perfection in the screening without having complete information. So because of this, the screening exercise may lead to the conclusion by the bank that the borrower is of a higher level of risk than necessarily is the case if they had acquired all the information that speaks to the ability and the willingness of the borrower to honor the obligations. Also, application costs may be high. And then there is the issue of the difference between the interest rate of the bank and the interest rate of the informal money lender. The informal money lender is that table banking, it's that Shylock, and so on and so forth. So generally, the interest rate of the bank will be lower. But if the difference is, for example, 0.5%, then there isn't a substantial difference between the two to incentivize the SME to go to the bank, especially because there are additional requirements that they have to meet, which they don't have to if they approach the money lender. So the greater this difference, the more attractive the bank is likely to be. But the smaller that difference, the less attractive, the more discouraged the borrower is going to be as far as approaching a formal credit provider is concerned. So what happens when borrowers are discouraged is that there is self-rationing. Borrowers simply do not approach formal lenders to seek borrowing. And so they're giving the impression that the demand for loanable funds is lower in that segment of the market. Okay, and then quickly on the issue of bank competition, we have two hypotheses at the theoretical level that have been proposed. The market power hypothesis that says that banks, large banks, will have the tendency to abuse their largeness by outpricing the competitors. We call it predatory pricing, and therefore, as soon as the competitors fall off, these large banks will then try to exploit their monopoly position to charge higher prices on the loans. So in that regard, reduced competition is not good for SME lending. But then there's the information-based hypothesis that says that banks that have stronger market power can exploit, instead of doing this to engage in predatory pricing, they can decide to use their market power to their advantage of the borrower by building a strong relationship with the borrower. So in practice, what do we see? We see, in terms of reducing information asymmetry, there are interventions. And so what I'm going to do in this section is to provide examples quickly to demonstrate how, in practice, reducing information tensions has happened. So I start with the insurance type interventions that look at Afeli Africa. So they do what is akin to concessional lending, because they stand in to provide the first loss cover in the event that the SME defaults on the obligation. They stand ready to take the first loss or to compensate the lender in the second instance for the higher cost of lending to the SMEs through cash subsidies. So the first loss cover addresses moral hazard. The cash subsidies address information asymmetry. In both cases, we end up with a subsidized loan. But the subsidy, like I was saying, is to the extent it uses the perception of the SME so that the SME is appropriately priced. Then there's blended finance, which we have also mentioned in our literature. And I give the example of the West African Initiative for Climate Smart Agriculture, which has used the blended finance model, one, to subsidize interest rates, and also in the second instance, build capacity of banks to design suitable credit products. So they are targeting the supply side. In the second instance, they traditionally target the demand side, but they choose a different approach where the target is for them to enable credit providers to develop products that are more appropriate for the SME segment. We have lines of credit, and I'm giving the example of African Development Bank's line of credit facility. This also targets the supply side. The main target is to achieve higher liquidity and also to provide technical assistance to the supply side so that they can be able to provide or to participate in a relationship with the SME that is more fulfilling. Government intervention, I also mentioned this in my discussion of concessional lending. It can be in different forms. I've given the example of the Hustler Fund, where you intervene as a government by providing the service, the lending service to the SMEs, or in the form of interest subsidies or guarantees and so forth. And I'll give the example of the South Africa Bounce Back Scheme. This scheme was initiated shortly after the COVID problem and was meant to be or to serve as a part of the stimulus package of bringing businesses back to life after COVID ensured that a lot of them are struggling or actually died. So what the government did in this instance was also to stand in the way that Aceli Africa is doing by taking the first loss in the event that the SMEs default. So in this case, they take the first 20.5% of the loss. So if an SME owes 100 shillings and they default on 100 shillings, then the government stands in to pay the bank at 20 shillings 50. And then the bank takes care of the remaining loss. Securitization is a method that is not widely used. Most of the methods that I've talked about are commonly used, but securitization is not very common. So what happens under securitization is that there are two ways of doing it. One is that you can securitize the credit itself, so you end up with a collateralized mortgage obligation akin to collateralized mortgage obligation. But essentially, you are collateralizing the obligation itself, the loan that you have extended to the SME. So by collateralization, you're saying those loans, you look at the ones that are of a high quality, you put them together in a pool, and that pool is then sold to investors in the stock market, in the debt market, for example. So investors buy them and give you money so that you can continue lending instead of waiting for the SMEs to later come back and repay. So that way you can mobilize additional funding for SME lending. But the alternative to collateralizing the obligation is to collateralize the cash flows of the SME. So SMEs will have, in that case, to develop bankable proposals. And based on the bankable proposals, you can be able to go beyond what the SME is forecasting. For example, they are forecasting 5 years. You can extend it using new technologies out of sample, maybe 7 years. And then the forecast of cash flows of the SME is then collateralized, is then put in a pool, and then is sold to investors, and the money so generated can be used to extend additional lending to SMEs. So that way, through securitization, you can mobilize more funds than you would ordinarily have as a bank to lend to SMEs. And this approach has been tried in Cote d'Ivoire successfully. Okay. The last way in practice is to address the fundamental factors that inhibit lending. We have looked at two already, where AFDB, for example, is providing capacity building to banks. So that capacity building enables the bank to come up with products that are more attuned to the SME segment. So that addresses fundamental shortage of appropriate products. But you can also target the SMEs by providing education to the SMEs so that they can be able to, for example, develop bankable proposals before they approach the lenders. So I think that is a good way of ensuring sustainability in the lending relationship. So what are the policy options available? Given what we have said, there are many policy options. One is to review agent banking regulations. And I looked at the agent banking guidelines issued by CBK, and I found at least one instance where this kind of intervention might be useful. So there's a segment of those guidelines that says agent banks are not allowed to carry out any appraisal function for purposes of granting of a loan to another entity. And my thinking is, if you have a bank headquartered in Nairobi and it's operating in Kwale, then this bank that is operating in Kwale with thin staff, maybe 3 people on the ground, may not be adequately capacitated to understand, especially in terms of gathering soft information from the people that are going to approach them for loans. So why not empower agent banks? Because agent banks are a lot more closer to these people than the thinly staffed office in Ukunda, for example. So empower the agent bank to be able to gather this soft information and then use it to analyze loan applications. Currently, the guidelines do not allow agents to analyze and appraise loans. Suppose you ask them to do so, empower them, give them the information, the knowledge, enable them to analyze this information and then make recommendations, as opposed to making the decision, make the recommendation to the bank's loan officer. I believe this is a good way of activating agency relationships, activating relationship lending, and therefore activating a more appropriate way of gathering soft information from the borrowers. Okay, the other one is closely related to the soft information, is the relationship lending. So my recommendation is, when I checked, there are many banks in Kenya that are already doing SME-centric lending to SMEs, and they have an SME division that specifically tries to ensure an improvement in the SME lending. So for such banks, this recommendation may not be very useful, but there are quite a few other banks that are not yet in this space. So the recommendation therefore targets those other banks, and I'm saying emphasize SME-centric approaches, and those approaches need to be adequately supported by bank work plans and well-reasoned teams to lead the effort. So there should be ideally a dedicated division that just services the SME segment of the market. That way, that division can be able to go beyond what the bank otherwise would do in the absence of a specialized division, as far as building relationships is concerned. The other one is a recommendation that I think came up earlier. I'm just therefore emphasizing it. There are value-added services, and I'll give the example. The example may come from, let's say, export credit. So under export credit, you have additional value-added services like insurance, maritime insurance, for example. So you are not just providing export credit, you are also going beyond to facilitate the transportation of these goods from one country to the other. So that value addition may be attractive to the SME who may not ordinarily be aware, for example, that the bank can be able to facilitate them in that way. And since the bank is therefore doing both the financing of the export and the insurance for the same entity, the bank can be able to achieve scale, and therefore one or both of the services can be provided at a lower price. The lower price emanating from the benefits of scale. But for the SME, there's the attractiveness of the bank because the bank is giving more than just provisioning financial support. So value-added services would be a good way to attract SMEs and therefore to facilitate their loan provisioning. Blended finance, I'm looking at one recent case in a paper authored by Khan and Baji that advocates Islamic principles of banking to come up with a zero interest blended finance model that is especially useful for SMEs that are operating in the sustainability space. So this model addresses the additional cost of ensuring sustainability. So by essentially driving the interest rate to zero, and to operationalize this concept requires a bank that is operating in Islamic finance principles. Quite a few banks in Kenya are already doing this. So that bank should team up with the development financier that is also operating in Islamic finance principles, or an Islamic social fund that is obviously operating on Islamic principles. So by teaming up in this way, both of them can be able to drive the interest rate to zero. And that means that the SMEs that are willing to go the extra mile as far as sustainability, in the other context that I was saying, for example, the environmental and social sustainability, they can be able to afford the additional costs associated with sustainability-minded business. The issue of technology, I think, need not be overemphasized. Lending infrastructure, I think, has come up a lot of times. Also, I don't have to overemphasize that. I want to emphasize capacity building for SMEs because I think this is the truest way to guaranteeing sustainable SME lending. So training and support programs, the Kenya Bankers Association, Strathmore University are already in this space. But there are also incubation centers that are operated by the government that are also in this space. The problem with the government entities generally is that they are, in some cases, probably in most cases, not run on commercial principles. And that means that they are not financially sustainable most of the time. So my emphasis here would be on the idea that those programs should be run on commercial principles to ensure that they have financial sustainability, and therefore they can be able to extend their services to places in the country that have hitherto not been reached by those services. So they can empower more SMEs. They can enable more of them to achieve a situation where they can sustainably approach financing institutions for funding. When I talked about loan securitization earlier, so putting it together, this is a proposed framework for sustainable financing. There are interventions that address the demand side, and we have mentioned strengthening loan credit guarantee schemes, SME capacity building efforts, application of modern technology, relationship lending, and so forth. All these are tools that we can use to intervene on the demand side. And then there are tools that you can use to intervene on the supply side, like blended finance applications, including technical assistance coming in through the blended finance approach to the banks. Update of banking regulations, like the one I've mentioned about agency banking by the Central Bank of Kenya, and so forth. So all these put together can make the supply side provision additional credit to the SMEs. Then the demand side interventions will capacitate the SME side of the transaction to be able to increase the magnitude of those SMEs that approach financials for formal credit. So if you put them together, the SME finance gap can be eliminated, and we end up with a more sustainable SME financing. I want to end there. Thank you very much for the time and for listening to me.
Thank you, Prof, for a very comprehensive presentation. We'll go straight into receiving the discussants' comments and any views on this subject matter. Peter Omalwa from Central Bank.
Good afternoon. Well, thank you so much, Prof, for this paper. And it's always exciting when the demand side meets the supply side in terms of credit. Well, this paper tries to answer a very pertinent question that is central to the theme of this conference, to our society and to our economy, on how best the banking sector and the government can finance that's small and micro enterprises in Kenya. So the paper tries to answer a question why there is suboptimal lending to small, micro, small and micro enterprises in Kenya. So the analysis identifies what I would say 3 main issues. First is what is known as SMEs being risky. Secondly, this paper identifies infrastructure, market access, trade policy, innovation, and by extension, ambition of the entrepreneur. Then it goes further to try to explain how these challenges can be overcome. Finding solutions, so providing solutions to SME access to credit is what our government has grappled with. And for anybody on the market has to think about how to address this, because one, it is a very niche market. There are high returns, but it is also very risky. So, well, the SMEs are risky because the lenders have no good information about their riskiness. In economic terms, we say we don't know the type of SMEs that works into the banking sector or to any financer. So we don't know. So what do we do to make an SME reveal itself? First, we advertise the loan contracts, right? The loan contract will specify this. I have a loan of 10,000, and if you qualify, you're going to pay me an interest rate of 10%. You take it or leave it, right? So the SME that feels it's a good one will take it, and if it feels that the terms are too stringent, it will leave. So this paper looks into this issue, why the SMEs that reveals itself to be safe, it is not able to get affordable credit. One of the reasons why it can't get affordable credit is, one, it is essentially priced out of the market. You know, if you're offered credit at 20% and you take it, it is okay because the returns from investment could be more than 20% for your needs. But if you are willing to pay 20% and you don't get, then you are rationed out of the market. So the critical question that this paper tries to answer is, why is it that SMEs that come to the credit market to get credit do not get optimal amount of credit? One of the issues that this paper actually talks about that is within the purview of the banking sector and the regulator is the issue of information asymmetry and using innovations to reduce information asymmetry. But unfortunately, the SMEs do not have a transactional data, trade data, and collateral. So there is no sufficient information. Even with the gains in financial inclusion, there isn't. So SMEs are operating formally. So there's no way we can get hold of hard facts to inform lending. So if Mr. Ndunda was here, would say that inform your members to at least try to formalize transactions. Encourage them, despite the fact that there is KRA with the pay bills and what. Try to get this. Then, of course, this paper also alludes to the issue of the risk weights. So if we can have a reduction in the risk weight of loans that are granted to SMEs, especially those that are guaranteed, then we can catalyze investment or lending to the SMEs. Of course, the paper has spoken to all these things. And the paper also tries to answer why it's underfunded. So they are risky, the banks require collateral, and banks need to develop a relationship with SMEs, then the risk weights. You see, these are standard issues, right? But fortunately, we are here to think outside what needs to be done to increase lending to SMEs. So the paper provides these recommendations. But again, looking at these recommendations and the recommended framework, what is missing here is the fact that, one, it is not easy to overcome information asymmetry. Information asymmetry is that once you lend to the SME, you are not sure whether the well-behaved lender will continue behaving well after he receives the loan. Secondly, if at all you have selected a best borrower, you can't know. So that we have to live with. So it's upon us to design policies that try to overcome those weaknesses and also assure banks that even if we lend and the circumstances to the borrower changes and is not able to lend, the bank is still able to recover its money and have a return. So part of the recommended framework, yes, they do work. But I'm going to give you the hindsight of it that will complement this framework that will help us. One of the ways in which we can catalyze lending to the SMEs and integrate this framework with the framework in the paper is having an integrated approach towards providing financial solutions to SMEs. One of the ways to reduce information asymmetry is to organize the SMEs into cooperative societies and self-help groups. Why is this important? If loans are extended to self-help group or cooperative societies, you reduce, first of all, loan administration cost. 2, you reduce loan delinquency. 3, the group acts as collateral because the cooperative society will not disappear. But if you found me as an individual, for sure it's easy to disappear, right? And you can't find me. So then there is need to address the issue of productivity, improvement, and their growth. Then extension services. Extension services, he has mentioned them. Yeah. Thirdly, there is need to have a comprehensive financing package that starts from the inputs, the stock, technologies, all the way to the customer. So this comprehensive approach can be conceptualized as value chain financing. And in this value chain financing, you have the financer recover the loan at the point of paying. So this will assure the lender that indeed I have lent to a cooperative society. I can hold it accountable. It's a collective charge, and no one wants to risk to risk because of one individual. Actually, they will find him and bring to you. And that's what has happened with the matatu industry and also for the farmers' cooperative society. So what is this value chain financing and integrated approach towards providing solutions to access to credit? So, well, there are a couple of players in the financial sector. So the bank may find it difficult to finance probably a cooperative society, but there are SACCOs. So we can have an arrangement with the SACCO So you channel these funds to the SACCO for onward lending to the cooperative society, because SACCO is a specialized entity that knows how to deal with the cooperatives, right? It's much better. So the end game is, have the SMEs obtained financing? So we can also have, we can integrate this, we can have integrated lending through value chain financing all the way to the inputs, to the suppliers, and even we can partner with the government entities. And the good example is the credit guarantee scheme by the National Treasury, the Commercial Bank. These are valid frameworks that can be used to catalyze lending to the SMEs. But then, if we go down to these other issues, it is not, we can't wait for the for finished products on the market so that we get, so that they are sold so that we can recover our money. Yet, there could be financing constraints at the input level. So where do we start? We have to start from even the conceptualization of the ideas that SMEs have and finance them. So as goods move into the value chain, we can find a way of financing them. One is that we can finance when implements move from the supplier to the for example, farmer, or to the cooperative society in the Juakali industry. There are corresponding flow of financial services. So if the financial package flows into the value chain, we are able to account for the shortfalls, and we can even take remedial actions to reduce losses. So in all this, we need to understand the role of property rights. We need to strengthen the property rights. We need our society to understand that when you borrow somebody's money, you have to pay. When you take somebody's equipment on credit, you have to pay. And are these property rights enforceable? Yes, they need to be enforceable and at the least cost possible. So if we have this comprehensive framework, we will have addressed some of the problems that SMEs face. But remember, when we were not born even 1963, we were talking about access to finance as a challenge to the SMEs. But still we are speaking to it. For sure, if credit was an issue, we should have solved this. It means that there is a bigger problem that reduces access to credit. And this could be maybe infrastructure, access to markets, the trade policy, which we also need to address so that SMEs can find the market, can obtain inputs, and can fairly compete with other categories of enterprises in the economy. So if we top up what Professor Kodongo has presented, with what I have presented, I strongly believe we would solve the problems that SMEs face in terms of access to credit. Thank you so much.
Thank you, Peter, for adding to the discussions around SME financing and the options that we have. I was just looking at something that we have tested. We have tested and tried and has proven to deliver some results. We, as you may be aware, KBA has a Inuka program, and I think even Prof mentioned about it. Now going to 6 years of implementation, and we did an impact evaluation and established that of all the MSMEs that we have been able to train, just as a result of the training alone, about 10% of them have been able to access credit. And that triggered a conversation at KBA that what do we need to do to enhance that access to credit amongst those that we have trained. So we moved ahead to say perhaps we need more specialized training in cohorts so that we identify a smaller group and do deep dive trainings. So this year, last year in October, we launched the Accelerator program, which is really now to do, out of the Inuka graduates, we now get a smaller cohort and train them over a longer period of time, 12 weeks period. So actually the first cohort is undergoing training now, and they will have an opportunity to meet various experts in various fields. And then, so this is a model we are testing to just check the possibility of, can we now carry those that have been trained on the basic issues to move them to advanced training, mentorship program, expose them and have them have linkages with banks. By doing that, would we be able to convert many of our trained SMEs under the INUCA program to access more credit so that we move them to scale their operations in a faster way? So we are doing that, and in fact we are creating even more dedicated and committed institutions that then would be able to do this, leveraging on the partnerships that we have with other institutions. And in fact, last week, we launched the Center for Sustainable Finance and Enterprise Development, again, indicating our commitment to support enterprise development in the country. So all that would really go a long way in supporting the extent to which the interventions we are doing for SMEs can translate into access to credit, because that's the bottom line. For them to grow, they need credit. How do we move them from informality to formality? And even once they are registered, how do we enable them to scale their operations? So there is, as one of the recommendations from Prof, around investing more in capacity building, I think it's aligned to what we have tested. And soon now we'll also be able to see results from the accelerator program that we have launched. There's something that I wanted to throw back to us, even the bankers in the room. There's one interesting recommendation that Prof has made. 2009 agency banking regulations published by the central bank. Third-party agents that have been doing the transactions on really typically just taking deposits and enabling customers to withdraw. If that was to be converted into the agents become appraisal agents for loans, because I'm imagining the agents in the centers that we are in, they know the people. So he talked about soft information, and they can say, "Huyu jamaa anakuanga hivi hapa," and so there is some assessment, some softer assessment, because when you ask me to come and present myself for a loan appraisal, there is a way I will act that will enable me to get the fund. But if somebody is independently watching my behavior and can actually comment about me without necessarily even engaging me directly, do we think that model can work? And to what extent do we then need to train them, particularly on the bank internal risk policy, so that even as they assess these customers, they are also not, they are aware about the indicators to look out for whenever that's open. We'll be keen to know and feedback from the bankers in the room whether the agents we have that we have used for deposits and withdrawal services, teller services, can be converted to loan appraisal agents. And so I open it up for comments before we progress. Any views on the recommendations that have come through? Prof, any other bankers? Yes, Lucy, Madam Tuse. So we could start from the extreme end as we come. Mike seems to have a challenge, please.
Thank you.
No, just a minute.
Yes, sir. Thank you. Maybe I can add a thought on that recommendation on dealing with the agents. I believe the agents that we are using, they are the ones who are closer to the SMEs on those locations. So it's easier for them to understand the nature of those clients. And once they're given, if they're given a mandate to do the pre-screening, it's easier to use the agents as now a conduit to connect that SME, who by then, it's possible they don't even know there's an opportunity at a certain institution where they can get solution to their financial requirements. So if they're given the mandate, then they can be used as some kind of, could be the marketing agents at some point, because now they'll be the ones giving information to the SMEs within their locality that there is a bank that can provide this for you. And I say this based on the experience. I've seen it in one of the countries out there where the agent was actually the one sharing the information about the bank products as well as the insurance. So he was like guiding the client who was there to be served in terms of the balances, that with this balance, I don't think you'll be able to reach to the month end. So maybe if you wanted to withdraw 100, can you reduce to 50? So here is budgeting issue. And then while we were there, he was actually convincing that client to take an insurance cover. And I've noticed you don't have an insurance cover in your account here, because I think in their country they have this monthly, daily insurance cover. So you don't have an insurance here. What if you get an accident? How are you going to be covered? So if they're well utilized, I believe agents could be used as interface to the banking sector where they are, where they meet the community out there. So I believe, and I agree with the recommendation that they can be empowered to do something more like pre-screening of the clients. And then the bank will be actually easier because now they know there's a client there, a potential client. I can engage and see how best we can empower them. Thanks.
Thank you. Thank you. Very insightful. Lucy?
Good afternoon once again. I'd look at it from credit assessment being both qualitative assessment and quantitative assessment, whereby now we are leaning more to these agencies to give us more details on qualitative assessment for customers so that we can reduce the risks that come with information asymmetry, because they seem to know more about the customer than maybe the bank would know. Then the bank would be able to use the quantitative assessment and lean more on the agents to give qualitative assessment of the customers. And probably that would also bring the issue of moral hazard. They can be able to advise about the behavior issues of the customers. To deal with certain risks, it would be good for financial institutions also to outline the risks that can come with it so that they can mitigate for those risks. And one way would be to empower these people by training them so that they are held accountable for decisions that could be coming in, and they're not good decisions that could cause loans maybe to go bad. That's my view.
Thank you. Thank you. Quite insightful. Let me throw somebody under the bus. Andrew, Andrew Njeru. In your presentation, you had something to do with reliance on third-party sources of information, and to what extent do you think we can rely on the agency model to support in credit appraisal?
I think you have some experience with one of the bureaus who offered the services of doing the background checks, and of course it worked well, only that of course they have the capacity issues. That can help, although I don't know whether some banks will be comfortable disclosing a lot of information about their customers to a third party, because that also creates a lot of competition for the same customers, because the same agents would actually now easily go and sell the same information to another bank. But it is a model that can work. And in terms of even third-party information, there are quite a number of providers who can help you to get a lot of data from non-bank data providers and telcos especially. And I note most of the larger banks are not using them, but they are very rich and they synthesize the data for you. You can easily know who is a good customer, because obviously, you know, these days most customers don't keep money in the bank. And it's actually the channel for receiving the money and sending out is mostly M-Pesa, even though mobile banking still exists for, but there's a huge opportunity there as it has been noted. Yeah, third-party agents can help a lot. Yeah, not just platforms, but actually people who go out and meet these customers to validate. Some banks thought of having a third-party check just to check like a secondary check to validate what has been collected. And you also, as you said, rightly said, they can have better insights and even more time to look at the customer as opposed to an official from a financial institution, largely because of the structures, how they are. They may not have all the time that a third party might have, but it's something worth considering.
Okay. Thank you. Hand up by Thomas.
Thank you. Thank you.
Mic is not...
Testing. Thank you. Thank you. Thank you. Yeah. Thank you. As you have said, my name is Dr. Thomas Ongalo of Kasalome Consultancy Limited. Now, what is coming out clearly here on the SMEs financing gap is that, yes, the gap is there, and it is like it is going to stay with us for so long before we actually get the solutions. Nevertheless, I'm proposing that even as we struggle to find ways, because recommendations are very good. The recommendations that I've been getting right from the discussion in the morning is really fantastic and is correct. But then I think we should appreciate the fact that, like Mr. Wamalwa has asked a very good question on a fundamental question on the asymmetric information, that a well-behaved lendee or a well-behaved borrower, how will you know that you will continue behaving well? Now, the answer is yes, he may continue behaving well, or no, he may not. But what are the factors that is, contributing to this? And that's why I would recommend that as we do research on this, we should also be considering the variable of external factors like economic conditions, social factors, because this lender who is behaving well, I'm very sure he starts misbehaving, it is as a result of the external factors. So why don't we also, collaborate the external factors as a moderating factor as we continue to find out and also see why this asymmetric information is a key factor. Thank you.
Okay, thank you. Thank you for your contribution. As Prof was making his presentation, he hinted on something about the possibility that borrowers could also be discouraged. Now we have a full paper on discouraged borrowers, and Josiah is bringing us this paper on discouraged borrowers and access to finance, evidence from Kenyan MSMEs. So I want to invite Josiah to make his presentation, and then we listen to a discussion by David Duiga from NCBA Bank.
Thank you very much, and good afternoon once again. It's really always a pleasure to be part of the KBA Annual Banking Research Conference. And I think I want to appreciate the discussions and the presentations that we've had yesterday and today, which generally have broadly looked at the subject of SMEs and access to finance. But this presentation, or rather my paper, takes a step back and examines two critical dynamics within the understanding of provision of finance to MSMEs. And I think the presentation by Professor Kodongo Dongo and the discussion by Dr. Wamalwa was a precursor to some of the insights that are coming out of this paper, that there are borrowers that today are invisible to us as financial institutions because they don't present themselves to the banking or to our institutions for assessment. And these are the discouraged borrowers, which is a subject of this paper. So these MSMEs are invisible, and they'll continue to be invisible because the existing infrastructure doesn't really allow us to have sight of these MSMEs by virtue of the fact that we still predominantly are on non-digital enabled infrastructure. So with that said, I want to perhaps at the outset indicate that I also want to pick from the analogy that Hilary shared of the two villages, the banks or financial institutions on the one side and the MSMEs on the other side, and their view of the river. So in fact, I want us to look at the discouraged borrowers from the perspective of what is it that they see and prevents them from accessing or even presenting themselves to the financial institutions. So that is the gist of the discussion, and I think I must admit that this paper is highly descriptive, and for the audience that are attuned to econometric analysis, I must apologize, because I ascribe to the school of thought that there's a lot of insights to be uncovered from descriptive analysis, and consider econometric analysis more or less as a complement and not a substitute of the analytical work. With that said, I know it's been a long conversation, but I want to set my presentation along 5 areas. The first is just to introduce and motivate the paper. I'll skip the theoretical and empirical literature because this is a subject that Professor Kodongo Dongo and indirectly Peter Wamalwa has spoke to at length. Then I'll present the data and the preliminary findings from the paper, and some of the conclusions and policy implications. But before I lose you, I just wanted to highlight perhaps 3 key points that you may want to carry out from this presentation. The first relates to the fact that whereas most of the MSMEs identify access to finance as a constraint, and this is not new to us, it's something that we've consistently had from the presentations that we've had. The financing gap is not driven by financial institutions' rejection of the applications of the MSMEs. In fact, I will, along the discussions of my paper, demonstrate that for the MSMEs that seek credit, approval rates are high. So it's a case of self-exclusion by the MSMEs, and which is why I say these discouraged borrowers is something that as financial market actors need to pay attention if we are really to achieve an inclusive financial ecosystem. The second is really to again reiterate what we've had from previous discussions, and I think a point that Jared Osoro aptly put across yesterday. around the non-homogeneity of MSMEs, that MSMEs are not alike. They vary in so many respects. And in this paper, I show that 75% of the MSMEs do not apply for credit. And for those that apply for credit, approval rates are as high as 80%. So it's not really a case of or the perceived challenges that really matter, but really drilling down into the data. And lastly, the third point that I want you to carry, shouldn't you follow through the conversation, is the fact that any intervention to unlock constraints in MSME financing, in my view, must first target the demand side, especially alleviating the self-imposed constraints rather than the real constraints that we as financial institutions are cognizant or rather aware of. And I think this speaks to the point that has been made by previous speakers, that strengthening financial literacy and capacity building are critical for addressing the self-imposed constraints. And this will therefore translate to more firms accessing credit. So with that, three key things that you need to keep at the back of your mind as I make this presentation. I think, again, the introduction and motivation of the paper and continuing to reiterate that access to finance, not only in this part of the continent, the global south, remains to be a very big constraint. And as a result, this impedes SMEs or firms' ability to invest, expand employment, as well as move up the productivity ladder, because finance in itself should be key in driving productivity of the MSMEs, and we all are already aware that MSMEs play a significant role in supporting our respective economies. In terms of the financing gap, and I think just to bring to your attention some of the statistics, around 5.7 trillion US dollars a year is what is estimated to be the MSME financing gap, with about 40% of the formal MSMEs unable to obtain the needed financing. So this credit gap, which is also part of what I consider those that apply for credit and are not able to get the credit, or those that self-select out of the credit market, becomes then important to focus on. So the research questions that we look at in this paper is threefold. One is just around how do firms or MSMEs define their perception of access to finance as a constraint. I think we've consistently talked about access to finance being a constraint, but do we see divergences or heterogeneity across the SME characteristics? And if so, what should financial institutions do to address this constraint? The second really is about focusing on SMEs that need credit but choose not to apply, which is the case of discouraged borrowers. And in this sense, we investigate why SMEs discouraged from applying credit. And this really helps us understand the infeasibility of the SMEs that do not present themselves to us for purposes of credit appraisal and even lending. And lastly is for the firms that present themselves for credit appraisal or for purposes of seeking credit, do they receive the credit in full amount, in partial, or are they outrightly rejected in the process? And as a result of this, we are also looking at the variations across the various MSMEs. So these are the three fundamental questions that this paper tries to address itself to. In the interest of time, I'll skip the theoretical and empirical literature. I think it's a subject that we've, for the last 2 days, been deeply thinking about, and we'll move straight to the data and the methodology that anchors this study. So this paper leverages on farm level microdata from the 2018 World Bank Enterprise Survey for Kenya. And the survey really targeted 3,178 MSMEs. And out of that, 1,001 completed the interview. So the sample size in this case is 1,001 MSMEs. And as I already said at the introduction, that it's to a great extent a descriptive paper that looks at the financing obstacles, the credit application patterns, and the loan outcomes disaggregated across the farm characteristics of age, size, the ownership, that's male or female owned enterprises, as well as transparency. And transparency in the sense that their financial management records are sound, in the sense that they have the financials audited or not audited, and that is the working definition of transparency in this paper. We also do leverage on econometrics approaches, and more fundamentally use probit just to look at the propensity of access to credit among the MSMEs, but the details of the econometric analysis is in the paper. I want to share the descriptive analytics, and especially given the audience before me, that it's more important to understand the kind of SME that we are dealing with. And just to reiterate again, the econometric analysis, in my view, is a complement and not a substitute of the analytical work, and at least that's the school of thought that I subscribe to. Now, looking at the perceived financing obstacles and the divergences across the various MSMEs, I think we do all acknowledge that MSMEs identify access to finance as a constraint. But the constraints are either real or perceived. So this table looks at the MSMEs' own assessment of access to finance as a constraint. And what you will notice is that there is already some level of self-imposed perception that access to finance is a constraint, looking at the overall sample. 24% indicate that access to credit is a moderate obstacle. Major obstacle, 20% of the MSMEs in the sample, and only 3.6% identify that as a major constraint. When you begin to drill down across the various farm attributes, you realize that the age of the farm, which is an indicator of the stage of growth of the enterprise, also matters in their own assessment of where the access to finance is a constraint. The same applies to the formality status, whether formal or informal, and how that plays out in their perception of access to finance, and transparency of financial records. And I think the point that I want to emphasize here is that majority of the SMEs perceive finance as a constraint, regardless of the categorization that financial institutions would be keen to look at age, but are more prominent in some categories than in others. For instance, younger MSMEs, and when I talk about younger MSMEs, I'm talking about under 3 years. And this is a self-constructed categorization just to demonstrate the life cycle of the MSMEs. Face disproportionately higher barriers, underscoring the role of stage in growth of the MSME. The other point that I want you to take from this slide is the fact that financial management, and more importantly, the MSMEs having audited financial records, are seen not to reduce their own perceived constraints on access to finance, pointing to the importance that not only does financial records and management play a key role, but I think there's more to do to educate the public that outside of even having their records in place, there are other interventions that are required just before you access credit, And I think it's a phenomenon that I have quite for some time thought through deeply. Why do MSMEs consider formality or informality? If the net benefit of formalization is not to their advantage, then there wouldn't be any incentive. So I think the packaging, and I think Professor Kodongo Dongo did talk about the bundling of services so that MSMEs better understand that the things including formality is not really a direct gateway to access to finance. The table here looks at credit applications by firm characteristics. Again, what is clear here is only 25% or 1 in 4 MSMEs apply for credit. This is quite profound. In the first instance, we see most of the enterprises are indicating that access to finance is a constraint, but only 1 in 4 enterprises apply for credit. There's already self-selection, or enterprises choosing not to present themselves or to even take the decision to apply for credit. Credit rationing in play, discouraged borrowers in play, and these are the invisible MSMEs in the perspective of our financial institutions. You look at the MSMEs by age, formality, ownership, and audited. The same result really plays out. And I want you to have at the back of your mind the fact that only 25% of the MSMEs are applying for credit, because that would be critical for us to interpret what the cross-tabulation of the insights in the next slide tells us. Now, speaking to the credit rationing dynamics among the MSMEs, the survey asks questions around what are the reasons for not applying credit. So this, again, is their own self-assessment of why they don't apply for credit. And 59%, well, 60% indicate that they do not have sufficient funds, or there is no need for a loan. Have this at the back of the fact that they have self-identified that access to finance is a constraint. But here, they are indicating that they have no need for credit. They also indicate that the interest rates are unfavorable. That is 11.7% of them. Still a self-assessment of interest rate, but we say that sometimes it's not really the cost of credit that matters, it's the access. I think we've perhaps in the past heard of stories of entrepreneurs or firms operating in Muthurwa market that they require working capital, and it's not really the cost of credit that matters to them. They know they will get their supplies, they will sell, have their margin, and repay back the loan. Yet here, we are seeing that there is a view that interest rates are unfavorable. We also do see that constraint requirements are too high is also coming out strongly, with 5.6% of the MSMEs or SMEs indicating that it's one of the reasons why they are not applying for credit. So when you rank the reasons for not applying for credit, it's really the absence of the lack of the need for credit for MSMEs that drive them not to apply for credit. When you look at now those that applied for credit, which I'm looking at, I'm considering them as the loan outcomes category, those that get their credit applications are fully approved is around 80. So 8 in 10 enterprises that apply for credit actually get credit. So the notion that access to credit is a constraint seems not to hold. Rather than it's the choice not to apply for credit. It's the self-exclusion by enterprises that's really driving the fact that they don't get credit. So that the numbers that we see in the various reports that we come across is really a story of those that choose to access our credit. And I think we need to have a broader conversations on how do we bring those SMEs that choose to self-select out of the credit market so that we increase the pie and have more lending towards that segment of the economy. Now, looking further at the dynamics of credit non-application among the MSMEs, that again reflects what I have highlighted before, but I think the point that I want to just speak to in this slide is the fact that because most applicants succeed, the interventions that we as an industry should be looking at is reducing the self-selection or the self-imposed constraints in access to credit, and therefore encouraging most of those discouraged borrowers who are indeed viable to apply. And I think the previous presentation had highlighted some of the interventions that can really address this, including the strengthening of the credit information. And I think Dr. you did point to the fact that the existing infrastructure, including the agents network, could be leveraged as part of strengthening the credit information infrastructure so that we have a whole view of the MSMEs that we are dealing with. So this still talks about, again, outcomes, now disaggregating it by the various farm characteristics, and the same story emerges. So in the interest of time, I'll quickly just summarize some of the conclusions and policy recommendations from the paper. One, around the hidden constraints that are self-imposed and not feasible to us as financial actors, that most applicants are approved, by the real financing gap lies in discouraged borrowers who self-exclude due to high interest rates, collateral demands, and fear of rejection. We also see significant non-homogeneity across enterprises if you're looking at the various farm characteristics. And from the analytical work or the discussions in the paper, I bring out one area of policy priority that in addressing all the constraints, perceived or real, there is a need to think about instruments towards reducing cost. And I think yesterday we did have conversations around the role of credit guarantee schemes in addressing some of these risks. And I think when we are looking at these instruments, it's important to appreciate the various stages of growth of these enterprises, promoting financial literacy as well as behavioral barriers, or addressing behavioral barriers that discourage firms from applying becomes also something that should be top of our minds as we ensure that MSMEs are supported to access credit and therefore invest in their enterprises and continue to support the economies in the growth agenda. With that, thank you, and looking forward to the comments and feedback.
Thank you, Josiah. And we again see a consistent trend in heterogeneity, the unique features that differentiate firms playing some role in either enabling them to access financing, the approval being determined by age of the firm. And it actually makes sense to a great extent. I mean, age. You know, an SME, they walk to a lender, they say, I've been doing this for the last 8 years. Meaning, if I was to go down, I would have gone down. But I've gone through challenges and still stood up high. So that's a proof of resilience, age, and continuity of a business through the challenges. So age is can also be interpreted in terms of I have experience in how to maneuver challenges. that may come. And if I've gone through all the cycles of the economy, then I've built in some resilience in it. Then another issue coming up in terms of not the cost, it is access, is the issue. So, and that's why I think even as KBA, we strongly propose that the premium K should remain flexible, because sometimes it may not necessarily be the price, it's the access that is more important. And customers have a view. If I have a pending return of 50%, even if I'm paying 20% on a facility, you can see I'm still in business. So our whole idea is, can we allow those that can be priced at a higher rate to actually also access the funding and not exclude them from the market. So interesting findings. I want now to invite the discussant, David, who has also agreed to keep it brief and to the point. Thank you.
All right. I have to make some remarks here, self-exclusion as well. When I was told to discuss this paper, Josiah and I have worked in the same institution, the same department for a couple of years. So it's a bit difficult to discuss your former colleague's paper, but nevertheless, I'll try to be diplomatic so that I also keep the work relations. So when you look at this paper, it has its uniqueness because all the papers we have presented today and yesterday seem to be focusing on MSMEs which have visited a bank more or less. But the uniqueness that I get in this paper is that it's focusing on unobserved borrowers. These are people who never sometimes apply for credit, and perhaps we'll never get to see feasibility of them to that extent. So I'll dive into the areas of improvement. I think the other comments I'll write to the author and also through KBA as taken. One thing from the survey that you are dealing with, Josiah, would you tell us whether these the survey, the response by these MSMEs, is it through experience or is it through hearsay? Let me just reframe the question. When these SMEs, they say that we don't need to apply for SME loan from a bank, is it because they had applied for the loan before? I don't know whether the service tools captures that. Is it because of the experience they have had with previous application? Or is it from the stories they have heard from their fellow MSMEs? The next area of improvement is I find it this paper, when I read it, it's more qualitative analytics, which actually give more gist than even complicated econometric analysis. And therefore, to the analytical, that is descriptive analysis, my proposal would be there's need to offer more detailed discussion on the following. One, why is the loan application with withdrawals more elevated in some sectors, such as the chemicals, pharmaceuticals, and private and plastic sectors, as opposed to other sectors? And secondly, why is the same, that is the loan application with withdrawals, more elevated in some counties as opposed to other counties? Number two, the older firms, when you look at the self-reported obstacles, the older firm seems to face less self-reported obstacles than the younger firms. Why would this be the case? And similarly, the same for formalization, male ownership, and audited financial firms. So it's just a matter of just offering detailed discussion on the same. The study also report a significant proportion of self-exclusion from formal credit. As Josiah has alluded, 75% do not apply, 26 or 20 quarter thereof do apply. My proposal is you could go further and tell us, since the E75 do not apply, then where do they get their financing from? So I don't know that the survey was able to capture that. And you can also correlate the findings with the existing FinAccess survey of the same, because that is a 2019 survey. Perhaps you would use FinAccess of closer to 30. I don't know, it's 2017? 2016. You can check 2016 and 2018. You see whether those, because FinAccess survey comes after every 2 years. So that on the supply side, you would argue that actually 75% don't apply, and therefore this is where they self-exclude themselves, and therefore this is where they're getting their financing from. The other thing is that on the reasons, you have a very good table on the reasons of not applying for those who self-exclude themselves, whereby there is a number. The issue is high collateral requirement, the loan amount, and what have you. So from the supply side, you would perhaps try to check from the FinAccess which tally with the same year or a couple of, maybe 1 or 2 years after the survey or before the survey. What is the possible explanation for this collateral requirement, the reasons they give? Is it based on the experience, again, from the first question, if they have ever applied before? And if not, then what would inform this? Is it the issue of information asymmetry? I think yesterday we heard the issue by Stephanie when she made a comment that if a female-owned enterprise, the owner goes to a bank and applies for a loan, even before the customer relations staff ask any question, they are just given a form, like a check-out form to first of all fill in. And therefore the question is, why would, what informs these reasons? And therefore that would actually go a long way in helping solving this issue of customer discouragement. The next issue on applications, the loan applications, you do make some following that young firms are more likely to apply for external financing than old firms. And female-owned firms also are likely to apply for external financing as compared to male-owned. And the other thing is that SMEs facing major obstacles are more likely to apply for the external loan facility. My question is, why would this be the case? And perhaps that you would offer some more insights around that area. As I conclude, discouragement appears to be more elevated, with discouraged SMEs citing no need for application as the main reason. So if you look at that table for the discouraged borrowers, for the reasons they give, quite a number of them, the bigger proportion, they are giving no reason for application. So perhaps this is just a comment. This would inform one of your policy suggestions, because if someone is not applying and they don't have a reason, perhaps then there could be a policy suggestion on how to come up with an incentive to cure that. So then as I close on the propensity to access the loan, that is where you are running your profit model. I did find that you are reporting an inverted U-shape for the access of the loan, whereby it means the very youngest and the very oldest firms actually suffer disadvantage in accessing the loan. So it's just a checkup you could try. I know that you are using the log of age, but you could try also without taking the log of age, when you run the age on its own and the age is squared. So perhaps that would also try to justify whether you are, again, you try to check whether that you are inverted U. I don't need to dwell to this because you already know why we use age and also why we would want to use age squared. Then on the location of these MSMEs, you do note that the location is a bit insignificant. But for all those locations, I do believe Nairobi was the control category at the location, but you can correct that because I did not see it in the regression. But for all those counties, two things come up. One thing come up, the SMEs in Trans Nzoia County, they seem to have a positive premium in terms of access as compared to all those counties. And you do give the reasons, possibly cooperative movements and also any possible government, both the national or county government intervention. My proposal is recheck the data on the farms which are operating within Trans Nzoia County. And for the ones which are within Trans Nzoia County, check the sector of operation. And then you look at the main economic activity within the county. Then perhaps that will lead you, because if you find majority are in the food and agriculture, then perhaps then you would go and check on the supply side, who are the main financials of MSMEs or businesses around that area. And perhaps then that you would get a reason as to why Trans Nzoia seems to, the SMEs within Trans Nzoia County seems to enjoy a premium advantage. And then lastly, is a finding that we did report yesterday for the NCBA paper. When I looked at this result for the profit model, they are showing that the SMEs in food, that is which food sector, which is agriculture sector, and tourism sector, they do face risk aversion in terms of, and that would come with the issue of a moral hazard and also the issue of challenges in NPLs. Is that right? So that is the same finding that the NCBA paper found. And at least I was excited to see a finding that we did find another paper which is using a different data set. Does find the same. So I know, Josiah, you're not in when we are presenting that paper, but the explanation we had is that if you look at those two sectors, the food sector and the tourism sector, they suffer from two types of seasonalities. They are seasonality in terms of weather dependent. You know, tourism is weather dependent. You know, some of the issue of summer, you'll have inflow here when it is summer and it's winter on the other side. But also here, more inflows will be when it is not raining because of possibilities of the national parks. If you look at the agriculture on the other end, is highly weather dependent. And then the other thing is that we find that the two sectors suffer from what you call inherent risk. That is the risk that is outside the control of them. For example, if the weather is not favorable, whether it's an old farm or a young farm which is doing horticulture farming, you suffer the same loss. Whether you have enough assets for you to be able to, you suffer the loss and inability, you will have a shock in terms of the loan repayment. So at least that's something I needed to mention, because we did find the same in our paper, and it seems to, when you use the World Bank 2019 MSME survey data, you are delivering at the same. Otherwise, the paper was well motivated. I think I needed to concentrate on the areas of improvement. Thank you.
Thank you, David. I think we now open to the first 3 hands maximum. Ruben, that extreme. Okay. I have a good problem. So, okay, no problem. Keep it brief so that there are 4 of us who want to comment. Ruben.
First, I liked the paper. My comment is around the statistics that we do not see. Because from the table that you show us, I know we would all be interested to know those who don't apply for the loans. We probably want to have a view whether if they applied, they would have actually, their loans would have actually been rejected or accepted, the applications. And I think we have, so what I'm just thinking is, since you already have statistics on, for those who applied and they were accepted, so it's more like conditional probability of acceptance given that you applied. And we have things like, we know the proportion of who applied in terms of like probability of applying. I'm just thinking using the same way we do like, conditional probability math. I think it can also give us a view into the intersections of like, what is the a priori probability if you actually apply and are accepted, which are these numbers that we do not get to see of those who did not apply, which could also maybe help to enhance the narrative around discouraged borrowers. And this is a conversation I'm happy to take with Josiah on the side. But I just wanted to mention that because I think we have hidden statistics which we could bring out with the conditional probabilities that we already have. Thank you.
Okay, thank you. Ada.
Okay, good afternoon. My name is Ada from the Credit Information Sharing Association of Kenya. And my comment is particularly on the age factor, where we have self-exclusion, even also from the younger MSMEs. And I'm just going to look at it from a human-centric perspective as a recommendation to your paper. So in terms of financial literacy, I wonder, do they know how to properly prepare the necessary documents to actually access financing? Considering they're younger, they're probably just getting into the business. Is there grassroots financial literacy for them to ensure that even as we say that there is self-exclusion, they're actually aware on what they need? Because most of the time, they do not even know how to present their case, so there is a fear of rejection even before the race for financial access begins. So that brings me to the next point, which is in terms of financial inclusion as well. When we are in rooms like this, I think the people that we are actually studying, who are MSMEs, need to also take vital space in such rooms, so that as we study them, they're also aware that they're actually not applying for these loans. Are they aware of what is out there for them so that they can participate in such conversations so that we know how to actually close that financing gap? So I think that's probably more of a recommendation. Thank you.
Okay. Thank you.
Can I have one question? Just one.
Okay, you're number 5. Okay, we can get to you.
Yes, thank you, Chariot, for the presentation. 2 quick questions. If I read your work and I read the FSD, the World Enterprise Survey work, what is the difference? Or what is the contribution of the paper? I don't see it coming out, because if I read that World Enterprise Survey report and what you have done, I'm not seeing so much of a contribution that you might be making, but you can try to make it a bit better off. Then I was also expecting to see the probate that you said that you did something, but I think you just summarized. You didn't give us the result to see how it goes into the model and then how it looks like, but you just discussed the result. Then the last one, in table 4.2, I would have been interested to see the N, because like table 4.3 and 4.4, you put N. But table 4.3, there is no N. So when you tell me the, let's say the age distribution, so I want to see N. How many people answered this question 1? They answered the age below 35. How many people are in that category? So that I see how it is being distributed. Thank you.
Okay, thank you. Davis?
Okay. Thank you so much, Josiah. I think this is a very interesting paper. So I just have additions to the paper. As suggested by the discussant, we could try and triangulate that data with the FinAccess survey, so that aspects to do with discouraged borrowers, we could also try to look at financial health, related to financial health, that is debt distress of those MSMEs, and also look at resilience, so that part of the recommendations that we could give is enhance the resilience of especially these MSMEs that appear to be discouraged when it comes to borrowing. So thanks so much, and I think I will also try and maybe input more in terms of bring the aspect of resilience into the discouragement of maybe MSMEs, yes. Thank you so much.
Okay, thank you, Davis. Jen?
Good afternoon. My comment is on the period of study, which is at the height of, that's the post-cap, because it's 2018-2019. And we know that from previous empirical studies is that the approval rate was low for lending to SMEs. But from your findings, you're saying that indeed the approval rate was high at 80%. Maybe clarify on that or bring out why the contradiction from previous studies. Thank you.
Thank you, Jen. So I want to invite Josiah to briefly give his feedback.
Thank you very much. I want to appreciate the comments from plenary, and more so the comments from my discussant. I think I take the good comments to improve on the paper, but I think I'll want to respond to a few of the comments that have just been brought to me. And I think the last around the approval rate being high at about 80%, even though we know the study period was in 2019, shortly after the rate cap. So, and I think I'll want to zero in on the fact that there is the self-exclusion and an indication that a majority of the firms don't apply for credit. In fact, more than 3/4 of the firms don't apply for credit on account of potential or their credit not being approved. But I think for those that apply for credit, they get credit. And the point that I'm making here is that whereas we continue to talk over access to finance being a constraint, it matters whether enterprises are really applying for credit. So the understanding of the fact that whereas the general public and some of us do agree that access to finance is a constraint, is not the case when we look at the data, and insofar as the 2019 World Bank Enterprise Survey is concerned. I think those are the facts that I wanted to invite us to begin to look at these discouraged borrowers and have them visible from the perspective of financial actors in the market. So that statistic is correct. And I think for those that will have a keen interest in the paper once published, you can still look at that. And I think to Ruben's comment, I think it's an invitation now to me to speak as an econometrician, because I have sight of MSMEs that access credit and those that do not access credit. And I think to the point that Silas had made earlier, that it is a question of impact assessment. What is the conditional probability that those enterprises that didn't apply for credit would have accessed credit? So it's a conversation around, for the SMEs that have the similar characteristics or profiles, would they have accessed credit? And I think there are quite a number of techniques that are very useful in extending that conversation. And I think I take that comment and would see how to incorporate that in the paper. To the question or comment by Silas, I think it's just more less on tightening the loose ends in the paper, but I appreciate all your comments. Thank you.
Okay, another round of appreciation to Josiah. I was just thinking, even in an African setting, what happens when you self-exclude yourself? There's an African saying that says that if you don't speak up, you can easily celebrate other people's successes. And there's even another version for men that says, usiposema kitu utachota maji kwa harusi. So thank you Josiah for bringing us that presentation and the discussion that has alluded. So now we progress to the last session of the conference, which is actually a methodological session. That this session does not have a discussant. It has only presentation. All of us are discussants. It's an information session, and it's presented by the Credit Information Sharing Association of Kenya. It comes in two parts, but all combined in one. It reflects the findings of a study on MSME loan performance analysis of credit data on MSME reported to one of the bureaus in the country, and this is data spanning the period 2019 to 2023. And also it reflects a component of Bayesian-based model for scoring MSMEs using alternative data. So I want to invite Lemuel to take us through this presentation, which we anticipate that should not take more than half an hour. Thank you.
Good afternoon, everyone. So thank you, Dr. Chiyongo, for the kind introduction. And I'll just share some of the insights that from a report that we did or released early in the year on MSME loan performance. And this is on data that was submitted to one credit bureau, notably Credit Info CRB. And I'll be sharing some of the insights. But just to start us off, CS Kenya focuses on, has 4 focus areas. One, which is data quality, and this is what I'll be speaking to. There's a second element on capacity building, third on legal reforms, and the fourth one on public awareness. So we are excited as CS Kenya to contribute to the body of knowledge on MSME credit access. And in terms of the agenda, I'll be looking at one thematic area, which is de-risking MSMEs, focusing on data quality, risk-based credit pricing, and support to credit guarantee scheme. And lastly, also looking at the next steps. So from a data quality perspective, I'd want us to look at data, especially on a sectoral lens. And I would just actually want to point out that we are doing quite well in terms of data quality. In the last about 14 years, acceptance rates have improved from about 65% to 95%, but we can actually be able to do better and to get to a point where we are able to possibly get to 99.99. So on the charts that's showing, I just wanted to point out that as financial institutions, we need to get more granular in terms of categorizing the different sectors, for instance. So you note when we look at trends by number of loans, other services tops at 19%, and here we are looking at volumes or the number of contracts. Second is trade at 15%, agriculture at 6.5%, and government at 4.49. So in this regard, if we had all the sectors populated under other services, it would also give a better defined or a better feel of the MSMEs. I'd like to move on to the credit information providers and just highlight on a number of areas of what we're doing in this regard. So the chart shows the number of credit information providers from 2010 to 2023. So for instance, it indicates that in 2023, we had more than 2,177 credit information providers. And we know of these, we have 39 of them being banks. So in terms of how many financial institutions or credit information providers actually submit data, we have one bureau which receives about 800 or data from 800 institutions, and the other two are receiving less than 100. So this is a huge disparity, but equally saying in the spirit of data reciprocity, the banking sector is missing out on visibility from the rest of the market. And I'll speak to some of the interventions or initiatives that we're undertaking as CIS Kenya. And maybe just to highlight, in terms of segmentation of the MSMEs, the DST, that's the data specification template, which could be considered as a constitution or a Bible in this regard, has a list of values of 11, or provides 11 options for the categorization of MSMEs, while the KESIC, that's the Kenya Standards Industrial Code, provides for 26. So this also provides us an opportunity to actually have granular visibility of these MSMEs. And speaking of the initiative, the Central Bank of Kenya approved the data validation and submission tool, rightly called the Validator. And this will enable the industry actually, enable credit information providers easily share credit information with the 3 bureaus on a single click. And I'd like to just point out in terms of the different credit information providers. So we have banks, SACCOs, MFBs, digital lenders, or these days rightly known as non-deposit taking credit providers, and the microfinance institutions, which have now been, in a way, covered by the non-deposit taking credit providers. So for the solid lines, that shows how the different entities submit data to the 3 different bureaus, and the dotted line shows the high-level statistics, the metadata that will actually be shared with CIS Kenya, just to ensure proper market conduct and ensure a level playing field in terms of just giving us visibility on who's sharing what information and whether they are sharing that information on a timely basis. So in this regard, there have been calls, I think, by a number of banks who also wanted assurance in terms of the predictiveness of the scores, and I'm happy to also highlight that there was a study done earlier in the year, and from the study, it noted that there were a few discrepancies which were occasioned by the level of data access, and I believe that's why, or that's one of the reasons why the central bank equally approved the tool. So looking at supporting, I think, individual consumers with information in terms of transparency, looking at the total cost of credit. So we have Kesonia, then including the risk premium, that is K plus other fees and charges. And I believe for these financial institutions, what they would be really keen on is the risk of the borrower. And that's where the score validation exercise began. I would also want to point out that in terms of data quality, that financial, or banks rather, are accessing granular information from the bureau. So one, for instance, instead of laying or having a cutoff, they are able to aggregate data from different, their internal data as well as bureau data, to be able to come up with the variables that are included in the model. So I think this is one of the other areas that is coming in handy. And I would also want to point out on the report or findings of the survey that was released mid this year by the Central Bank of Kenya, just looking into the adoption of AI by the banking sector. And quite some insight is that of the 50% of institutions, and this, in this case, institutions are the banks, of those that are using AI, 65% of them are actually deploying it for credit risk scoring or for credit scoring. So these are real use case for data and adoption of AI and ML solutions. I'd like to speak to credit scoring. So I think as highlighted earlier, or yesterday by Andrew, we have 7.4 million MSMEs, but out of the 7.4 million, we have 1.4 which are formally registered, and about 800,000 of these formally registered MSMEs have a profile at the Bureau. And to the second point, and I think this also looks to addressing the 6 million who are in between, who are individuals but are still running businesses, for instance. So how do we meet them in their current unregistered manner of framework as is? So we've noted that there's an aspect of commingling of funds, and there's need for differentiation between business and personal loans. And just to point to some of the initiatives that have been taken by one telco, they introduced the Pochi La Biashara just to try and separate the individual from the business at a granular level without formal registration. And I believe the same is equally happening for the banking sector. I'd like now to move to the scores specifically, and looking at the chart, this displays the number of contracts and the distribution in terms of the different score bands, with a majority being in the middle range, that is 550 to about 750. And to the far right, you'll note that there's also quite a number of contracts with quite some low scores. And this is where possibly alternative data could help bring them into the fold. To the third focus area, we would also equally want to see how credit information can support the adoption of credit guarantee scheme or credit guarantee scheme. And it's at different levels. One, from a product level, from a sector level, or from a channel level. And we know that many MSMEs actually access some of this credit digitally. So in terms of security, I think most financial institutions, or banks largely, they actually require cash collateral cover of between 93 and 112 or 121% thereabout. And for these particular initiatives, I think there's still more that should be done to encourage or support banks in extending unsecured facilities to these MSMEs, most of whom lack security. So in terms of recommendations for research, and this is all about this conference, I would like to point out on three areas. One, or maybe the overarching aspect is championing for availability of secondary data from the bureaus, so that more studies can be conducted, especially on MSMEs, secondly on assurance of scores, and also carrying out or supporting longitudinal research that's tracking user loan performance over a period of time. And we are happy that this report has actually been cited by a number of authors, and also that KBA has raised the bar in terms of accessing granular data for the Wi-Fi code project. So in terms of background of study, just to demonstrate the files that we were actually looking at, just giving it a summary, because I think the recommendations are what are most important. We looked at the non-individual file. As I'd mentioned, we have the 6 million who do not have their businesses being formally registered. We have the non-individual file, which is more of the companies, business names, and other entities. We have the guarantor information file, which was looking at, for instance, for companies, the directors would actually need to guarantee the firms which are actually taking out credit. Then there's the stakeholder information file. This was really critical in terms of just getting the gender disaggregated data in terms of ownership. I think there's not much in terms of leadership of the such MSMEs. And lastly, the collateral register information file, which basically has details on security. So that's how we went about it. That's how we went through the research. And lastly, in terms of the roadmap, one, I'd like to commend the banking sector for taking leadership and the initiative to adopt the validator tool. And right now, more than 20 banks have successfully piloted the tool. And this will create institutional inertia to have the rest of the credit market also adopt the tool. And then this, in effect, will be able to have visibility of who's sharing credit information and who's not. There's an aspect of deepening of the credit information mechanism. So we are moving towards real-time submission. So there's an aspect of timeliness as well. And to the last point, in terms of modernization of the credit infrastructure, right now the tool is actually using APIs to both, that's for the communication between the financial institution and the bureau systems. So this is another milestone that we've actually been able to cover. So lastly, I think that brings me to the end of the first presentation, just giving highlights of what we are doing as an association to power better decisions for the credit market and to ensure that we have more reliable credit information. So thank you very much. So in the interest of time, I'll move on to the next presentation. So we've been working on the MSME front as well. Okay. So while I was seated, it was interesting to just have a look at the paper and at the different papers. And this particular paper proposes a Bayesian-based model for scoring MSMEs using alternative data. There's a little bit of a highlight in terms of just the background and introduction. I think we already have this, and I think my previous authors referred to the same in terms of the financing gap and the trends in the banking sector. Actually, over the last, is it 2 years, that's 2022 and 2024, there's been a marginal increase in terms of disbursement or active loan accounts. Looking at the distribution of banking MSME loan accounts, and I believe maybe this also informed the initiative KB undertook to double access to credit, especially for the micro sector, and it was great to learn that they already surpassed that target. So in terms of impacts, micro constitutes 80% of the loan accounts. In terms of value, it's usually a little bit, it's actually lower, and just looking at the CBK MSME survey of 2025, the book stood at 83.54 billion, with the small and medium standing at 200 billion, and for the medium at 473. So looking at the problem statements, I think we are trying, or this paper addresses the lack of collateral or adequate collateral, which makes it difficult for them to qualify for credit facilities. So just quoting the National Treasury on the same. Moving on to the specific objectives, one was to build a prototype for scoring MSMEs using alternative data. Second was to review the existing scoring models based on alternative data as well. And third was to develop a Bayesian-based model for scoring MSMEs using alternative data. And the model is more of an engine in a vehicle, right? Because it's the one that processes most of these decisions. And lastly is on the validation of the effectiveness of the model. In terms of justification, I think that's also been rightly captured. As earlier indicated, banks and microfinance banks, and this is from the data from the CBK MSME survey, require between 93 and 112 collateral, 112% in terms of collateral cover for the loan facilities. And it would be a great opportunity to actually track maybe in the next 2 or 3 years whether these figures will actually drop. For this particular paper, I would like to define the term alternative data. And in this regard, I'm looking at it from a bureau lens. And so just referring to any information that is not typically contained in traditional credit reports. And alternative data falls into 2 main categories. There's financial data and behavioral data. So for financial data, it could include payments as well as, for instance, current assets, current liabilities, and the like. So for behavioral data is more of how they possibly use their devices and much more. Moving on to the literature review, and I'll just make highlights on this particular one. 5 areas. One is on the legal and policy framework. I think there's an aspect just looking at the different sets of acts of parliament and regulations as well. There's an aspect of data portability, and this also focuses on the Data Protection Act. There's a requirement that if a user requests for data, it should actually be submitted within 30 days. But with technology, I think this could be happening on a real-time basis. Moving on is on the mobile penetration and internet connectivity. On the demerit sides, there's an aspect of digital divide that we equally need to be careful about. 4th item is the use of machine learning for credit scoring. Also just falling back to the survey that was done by CBK on the adoption of AI within the banking sector. And lastly, the effects of COVID, which speaks to the resilience of the MSMEs. That provides the conceptual framework in terms of the data storage, pre-processing, all that to the use of the data through a user interface and how data feeds into the model. I'd like to look at the methodology and design. So for this particular paper, we used quantitative methods. The population was rather small, over 1,000 MSMEs. So it was the entire census. In terms of data analysis, we used we used pandas for manipulation of the data. That's for the independent and derived variable. In terms of the system development, we employed rapid application development or prototyping. In terms of the system analysis, equally employed functional and non-functional requirements. For the system design, made use of use case diagrams, sequence diagrams, class, and a database schema. So moving on is in terms of still within the methodology, the environment, we actually used Google Colab for the same, MySQL for the database. For programming tools, is largely on HTML, CSS, PHP, and Python for the data analysis and running the machine learning models. Moving on, in terms of pre-processing of data, and just to highlight on this particular one, it takes data scientists roughly 70% of the time cleaning the data. And this, again, builds on the data quality concerns. So if, for instance, we had better quality data, guys would actually be spending less time cleaning the data, since it would actually be more reliable and ready for use. So there's an aspect, a number of aspects, which is one, removal of the null entries. There's a second one on imputation of missing values. Standardization of data formats. So again, building on the data quality aspect of it. Went further to do some feature engineering in terms of just calculating, for instance, the lifetime of the MSME. So we are given dates, we need to calculate the actual age. For the system implementation, I think in terms of just describing the data, I had a total of 36 variables. And for these, we narrowed down to 12, which were used in the model. So in terms of the model description, we had the credit reports as the target variable, and the 11 independent variables were actually also included, and this is more of a classification problem. So we had the MSMEs either classified as low risk or high risk, with the median credit score serving as the threshold. Then moving on, in terms of evaluation of the model, I used accuracy and area under the curve to actually assess the performance of the model. So on this particular chart, we've indicated the number of models that we ran, and the optimized Bayesian net having the best performance with an accuracy of 90, or call it 91%, and area under the curve at about 94%. Moving on, I'd like to maybe just touch on some of the recommendations, and one that I would actually want to highlight on is we're in the second phase of the Kenya Credit Reporting and Strengthening Project, which has a number of work streams, 3 in total. One is on score validation, second is on adoption of alternative data, and there's a third of increasing the credit referencing parameter, which I think we are doing well as a country. So I think in my next slide, I'll just demonstrate that in the data specification template, we only have annual turnover or revenue as a financial metric, and I'll be speaking to that in a few. Then second recommendation is on establishing collaborative data ecosystems. I think the Central Bank of Kenya has also commissioned a diagnostic study on the adoption of open finance in Kenya, and it would be really interesting to see how this fits into the free. There's also a second aspect of that the banking sector and payment companies have adopted the ISO 20022 ISO standard, and this also provides a great opportunity for adoption of payments data in the data specification template. I think as also discussed by other authors, there's an aspect of promoting digital literacy, so such as adoption of digital bookkeeping, and which would equally increase the or improve the data quality for data that is actually used for scoring. So as indicated earlier, on this particular slide, I've just gotten a screenshot. So to the left, there's the data specification template, and I think for researchers in the room, you'd actually be able to go through it and just check on what data is available at the Bureau. To the right, I've gotten an extract of the non-individual file, which is largely for companies and business names. It has about 59 fields, and as highlighted, annual turnover is on the 13th row, and it's a mandatory field, which means that the financial institutions have to provide data on annual turnover on the MSMEs. So I think in the previous paper, when we were conducting the study, we didn't include annual turnover because the data quality was not as good, and it would therefore provide, in a way, some misleading information. So these are some of the aspects that need to be refined, and we need to find a way of validating income, for instance, so that it can now then again be adopted in the data specification template, and the bureaus would then go ahead and use it for scoring. So on further recommendations, I think there's an aspect on credit guarantee. There's an aspect of minimizing collateral requirements. There's an aspect of also considering collection scorecards. And a key aspect that I would actually be looking at is on MSME onboarding. And that leads me to the demo. So this is more of an interface, just showing you how I would be going about it. And I think it's one of the ways through the Inuka program also that could be considered in terms of having this information together. So I just want to show, it's a quick one, less than a minute. I believe you're able to, so this is the graphical user interface. Having home, we have a tab on scores, just indicating the score, and also giving an opportunity to the credit officer. And I think this would be mostly would be great for higher ticket facilities where relationship officers actually interact with the client, and they would actually be able to key in the information, after which they would actually be able to push this. So the model is actually stored as a pickle file. So once the inputs have been included, the model is called, it processes that information, and then relays the score and details about the MSME back to this particular page. So that brings me to the end of the presentation, and I would be happy to share more information and also invite you to actually test the platform. So thank you very much.
So thank you, Lemuel, for bringing us this presentation. This is not a presentation with a discussant. It's an information session on what's available for us to use in credit markets. Ladies and gentlemen, we've come to the end of our conference, and as we mark the end of our conference, allow me to thank all of you for making time and your contributions during this conference. We want to encourage all the bankers who have followed us through this that should you have an idea, we can take the journey together. We usually have a call for papers as early as March, and then we take the journey of developing the papers together up until the conference in September. So you have an idea, reach out to us, the Department of Research and Policy at KBA, and we can walk the journey together. So as we end, I know we are constrained of time. There's an event in this same room at 6 p.m. today. And allow me now at this point then to invite our CEO to give us closing remarks and his best wishes for us. Karibu Raymond.
Okay, good evening. I was just asking why Sam was asking me to come. He's better placed to be able to do the conclusion because he's been in, I think, each and every minute of the conversation. So he's able to determine whether we've had success in the two-day discussion. So my question is, do you have hope? Is there hope that, is there hope for the MSMEs after all these two-day discussions? Because we are looking at risks, opportunities around the small and micro businesses. So can we confidently be able to say there's hope for MSMEs accessing finance? I think that's a question we need to be able to answer. I think what we are all agreeing is MSMEs are risky. That one we are all in agreement. However, from the statistics, we've been able to see MSMEs are 98% of all the businesses in Kenya and even across the region. The statistics are around that area. So, kwa lugha ya mtaa, and the good thing we have our brothers and sisters from Tanzania. But this is Kenyan Swahili, not Tanzanian Swahili. So, in our marketplace language, our MSMEs, they're 98%. So the question they're asking banks and financial institutions is, "Nisisi ndio tuko." So if you don't have a plan for us, you are not in business. So we need to reflect, be able to see, even be able to rename how we call these businesses, because maybe when we call them MSMEs, it's a taboo. It brands you in a particular way. It makes financials shy away from you. So what is in a name? We may even be having a problem with the name. That's why we are not serving the 98% of the businesses. Because the critical thing is, who are we waiting to do the conversion of the 98 before we pick them up? Because babies have to grow and they have to be nurtured. So is there a process as to how we need to grow our small and micro businesses to be able to be medium, and we can be able to do sustainable businesses with them? But happy that we have been able to have conversations, including even this afternoon. I was pleased with a comment by Dr. Peter Omala from CBK, where he indicated that might we also be able to push further and ensure that these micro, small businesses get organized into self-help groups, small micro cooperatives, to be able to attract banks into that ecosystem. It's a good proposal, so we'll be able to carry it to the Ministry of Cooperatives and MSMEs, be able to see how that sits together with the program that we are running as private sector and government under the MSME Connect. So it's an area that we need to explore, be able to see how that can be able to move the needle and reduce the 98%, because we need to grow them. They need to grow into bigger brothers and sisters so that we can be able to serve them better. Also happy with the conversation we started yesterday on grade guarantees, and it was a coincidence in that we delayed our start because we were deep into discussions as to how we convert the credit guarantee scheme into the credit guarantee company, with banks playing a very, very central role in it. So let's take advantages of these opportunities, including the revised risk-based framework. It's an opportunity presented to us to be able to play a bigger role within the credit market, because what has been opened up is the fact that we now don't need to be able to do one-size-fit-all categorization of our customers, but we now need to be able to look at the customers, customer-specific, and then also have a chance to improve their credit quality and serve them better. I'll not stand between you and the networking session. So to thank you all, starting with all of us who are in this room, because we've been here yesterday, today, but also extend the gratitude to those who are with us yesterday, including our chief guest, the governor of Central Bank, Dr. Kamau Thuge, our own chairman of KBA, Paul Russo, all the CEOs who are here present, and special thanks to the CEO, Madam Tuse, from Tanzania Bankers Association. You have sat through all the discussions up to this point. We really appreciate. As we move here, let's strive to be able to take action and ensure that next time we meet, we need to have reduced the 98% so that the MSMEs need to be reducing so that we get to have medium and large corporations, but they'll all come from the small, micro, medium that we currently have. So with that, I'm pleased, and I can confidently say that we've been highly successful with our 14th KBA Research Conference, and wish to bring it to a close and invite all of you to a networking session. I hope there are drinks around. So the only thing we need to do is to move across from this wing to the other old, not old, to Ole Sereni. We need to move to Ole Sereni. The good thing is it's a walking distance, so you're welcome to Ole Sereni, the other wing, the other side, on first floor. We will be able to continue the discussions without the microphones. Thank you.
So as we exit to ground floor, and then we cross over to Ole Sereni. And thank you.